stock.
Yeah, and if you take a look at the chart on DTE over the last several months, Oliver, it's been gyrating between about 115 and 125, so that consolidation helps a little bit. And it got downgraded by B of A today, down price target down to about 119 bucks. So how do you take advantage of maybe more consolidation in this name around that $120 level, which has been, basically the midpoint of that. 20 puts. The April's expiring about 30. You're buying this risk-defined put calendar to the downside, paying roughly about a 90-cent debit on that particular trade. And if you pay a 90-cent debit on that, that's the entire risk on the trade. And you can see from the risk profile here, you've got a nice wide range for the stock to trade in over the next 39 days between about $112 and about $127 to be profitable on this type of trade. Now, if the stock does slide back down towards 120 and volatility expands, that's also going to expand the price of this calendar spread. But as you get closer to that March expiration in about 11 days on your short strike, you should start to see time decay work in your favor because the March options decay at a faster pace than the April options. There's no weeklies here, so you've got to keep an eye on this one over the next 11 days. But this might be the way to play it if you think it's going to start remain in consolidation mode around 120.
Okay. So basically you're looking for the stock to remain contained. I mean, it doesn't have to rally. You don't have to get any big push from here, just as a place for stability during some of this volatility. And it'll be interesting to watch how utilities show up this time, because in theory, the utilities don't do well when rates are going higher, but utilities have really been unchanged and are doing better. The market here is a lot more worried about rates for the NASDAQ than it is utilities, which is pretty fascinating, speaking to perhaps how expensive those tech stocks are, more sensitive than utilities to rates. That's pretty amazing. Tom, let's talk about the XLE overall. You're going to go contrarian on us this morning. That's fine. Sometimes that's okay, but, Tom. Even though the big rip has been energy focused, you're looking at a bearish trade on XLE.
Yeah, it's slightly bearish, and if you take a look at XLE on a chart, I mean, it's overbought on a couple different levels. It's up, what, nearly 20% year to date, and if you expect maybe a little bit of semblance of pullback here, this might be the way to play it, a relatively inexpensive way to get bearish over basically a month time frame. So I went out to that same April series, 39 days till expiration. And I'm looking at an unbalanced butterfly where I've got no risk to the downside, all profit on the downside, where I'm going to buy one of the 53 strike puts, which is slightly, you're just at the money, and then selling two of the 50 strike puts in that April series, and then against it buy one of the 49 puts. So you can see it's unbalanced a little bit. I'm buying a bearish $3 wide put vertical and selling neutral to bullish $1 wide put vertical. If I pay roughly about $1 debit for that, that's my entire risk. My break even is a buck below, or that $1 debit below that 53 strike. So $52 even is the break even. So if you expect XLE to maybe pull back here just a little bit over the next month, this might be the way to play. It's inexpensive. At the apex of that profitability on the risk profile there is about per spread $200, right? So you're risking $1 to make 200 if it settles at or near 52 at expiration. Now, if it continues to move lower and goes back down towards 50, you're still going to remain profitable because you're buying a bigger or a wider bearish put vertical here to the downside, creating this unbalanced put butterfly.
Okay. So this is looking, again, it is bearish, but you're not looking for a huge downdraft. I mean, obviously, once you get down to 50 bucks below that, you're shaving off some of your gains. So that's really where you want to hit, and then maxed out down at 49. Doesn't seem too far away. 50 bucks you'd think might be a little support, given that we had some back and forth there at the start of the month before we broke out. Tom, thanks for the trade. Interesting look here at utilities and energy. Thanks, Tom. When we get back, hour 2 of the show, we're going to be trading. We're going to be looking, of course, at the markets back and forth. Target got just annihilated after its earnings, but it's seeing some love this morning, up 2%. There's an upgrade out there, and it's a pretty bullish one. We'll talk about it next.
If you have questions about retirement planning, then you don't want to miss Investor Education Day hosted by TD Ameritrade. It's a full day of free insights from TD Ameritrade education coaches and experts who can tell you all about honing your retirement strategies. And the best part, it's all online. So technically, you can enjoy the webcast from the comfort of your retirement pants, also known as sweatpants. Register for Investor Education Day at tdameritrade.com/education day.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade network.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on ThinkOrSwim for the full Options for Volatility course and a whole lot more.
Welcome back to Morning Trade Live. We are in hour 2 of the show. Equities still back and forth. The NASDAQ back in the red. We've got a lot to talk about here. There's not a lot of economic data until Wednesday, but we're going to check in on a few numbers with Ben. We're going to be talking about the upgrade in Target that we mentioned as we see a bounce in the stock after running into a wall after its earnings. Then we're going to take a little sidestep. Even though there's a lot of drama about stimulus in markets right now, we're going to have a little fun and talk NFTs, non-fungible tokens. If you don't know what they are, then clearly you're not on the internet because it's the latest crypto craze. And we've got a really interesting guest joining us to make the case for why they're not just Crypto Kitties Part 2. You probably don't even know what those are either if you don't know what NFTs are. So just hold on, we'll get there. Chartmaster's got a couple upgrades and downgrades for us from the sell side. Let's go to Ben Lichtenstein, host of Futures and Midday Movers. Ben, we don't have a lot of data. We've got some wholesale trade inventories. Is there anything notable there?
No, nothing really, Oliver. This isn't a market mover. They did come in a little bit better than expected, so it is another area of strength we're seeing in terms of economic conditions because keep in mind, replenishing inventories actually does contribute to or feeds into GDP. So, but it did come in at 1.3%, Oliver. They were looking for, well, in line with expectations for 1.3%, better than the 0.3. This number's been on the rise here, though, for the most part, this Oliver, since the end of December of last year. We've been seeing increasing inventories, which again is a good thing and does support or feeds into that economic conditions bettering narrative.
Okay, all right. So that narrative here is showing up, I think, again, as we've got yields moving higher, Ben. The dollar is firm this morning. So we've got that relationship we discussed at the top of the show holding. My view is that we shouldn't, by any means, use the NASDAQ as our benchmark for gauging whether or not the market views stimulus as positive for the economy. It seems it should actually be the opposite, and I think NASDAQ down is probably, according to lately, the relationship, a sign that this is about economic growth building up.
Yeah, well, I think, Oliver, when you're talking about tech right now, first of all, I think one thing to keep an eye on is the FANG names in terms of this sell-off. A little bit less of a broader representation, so that can give you an idea in terms of some of those social media names and how much they've been taking a hit. But certainly with the rates on the rise, there's a lot of focus on valuations. These big names, these big tech names are coming under scrutiny now, and you can understand why. I mean, rates on the rise here have investors questioning some of the riskier assets, I guess is the best way of putting it.
Okay. Hey, Ben, as we've got the dollar firm this morning, gold is down again. 80 basis points this time. It just is not getting any love. GLD down 0.5%. The chart went right through the area from 1775 that was there at the end of last month, now down to 1680. Ben, we went through like 5 months of sideways grind from April into the summer. We did that in like 3 days here as gold broke down.
Yeah, Oliver, you called this move. I mean, I think it was about a month ago,
thanks,
a couple weeks ago, I think you tweeted out gold, rest in peace. And since then,
it's tweeted that about 10 times.
It's yet to look back, Oliver. Let's take a look here. You can see the 60-minute time frame, the move, the lower highs, the lower lows playing out here. And this really goes back to the beginning of the year, Oliver. You can see a little bit of consolidation around this 1850 level, but the recent breakdown coming into play and the steady move lower now. As mentioned, we did talk about the strength in the U.S. dollar. And, Oliver, the dollar really just started to kick in gear. This move in gold has been coming off for a while now, maybe more reflection of what's been playing out in rates. Maybe, you could tie it back to some of the premium in gold headed into the election. There was certainly a lot of premium in gold with these stimulus measures we were seeing, but it has diminished, as you can see. This is going to be an interesting relationship to watch. But gold, the selling that we've been seeing, I would think it would accelerate if we were to continue to see some strength in the U.S. dollar here.
Okay. Very interesting. Hey, correlations, traditional ones have broken a lot. I mean, look at the way the dollar has rallied with crude oil. So who's to say maybe gold couldn't finally get a bounce even if the dollar's going up? I mean, if we do actually have inflation coming, then in theory, if the yield move slows down and inflation picks up, then maybe real yields can actually stabilize or move lower as opposed to going higher. Maybe that would be, bullish for gold, but forget all that. I mean, technically, Ben, shouldn't we get some support somewhere around here?
Well, Oliver, at this point here, let me just pull up a little bit of a bigger picture in terms of gold, because if we take a look here at the 200-day moving average, Oliver, there really isn't a lot in terms of support. We're actually breaking down through the area of support right now that I had my eye on around the 1720 area. So you've got the lower extreme where we consolidated back in last spring. We're talking April of last year, all the way into June, where we started to see that run up come into play to the all-time highs up to 2100. But yeah, I guess if you were looking for support, this would be the one area to kind of expect to see some come into play. But we've been ripping through these moving averages, Oliver. It's been a bit of a falling knife. I'm not sure exactly what we're going to find at this point here to support it. Maybe if the dollar would lose some momentum to the upside. But what's interesting though, Oliver, is that some of the other precious metals certainly have held in there a lot better, whether you're talking copper, silver, in terms of that feeds into that discussion, that narrative as far as the industrial tie, and a little bit of less of an impact from some of the strength we've been seeing in the U.S. dollar there with all the stimulus and expectations and more to come.
Okay. All right, Ben. Thanks for the update here. Interesting for gold. It's definitely not encouraging, the chart that we see. Maybe if we don't immediately break down through that support you're pointing out and we stabilize here possibly. But definitely still an ugly one. Thanks, Ben, for the update. Let's talk some post-earnings responses from Wall Street. Pat Mullally has got his eyes on an upgrade at Guggenheim on Target with the $200 target. Pat, that's a pretty good ways back to the highs, seeing as how we got blasted after the report. So give me the details here.
Yeah, so 200, that's the all-time high. That's the January highs, Oliver, as well. So there's some tailwinds and you got some headwinds. So let's take those tailwinds on and, maybe take a deeper look into what Guggenheim might be looking at here. Customer acceptance of curbside pickup, 500% increase in November. Deliveries as well. Target's forced acceleration of those services to take on Amazon. They're coming online pretty strongly with those. Going to open up some more distribution centers, step into that area. Stimulus checks as well. Post stimulus checks, new stimulus checks coming, and then we hear Michael Fiddickle, I'll never get his name right, robust increases in shares and dividends. So those are some of the tailwinds besides back-to-back strong earnings and revenues. And then we have these headwinds, and that's the negative price reaction, which is probably more short-term as we're seeing today. And, they're going to invest for $4 billion a year for several years, $4 billion a year for several years to accelerate that shift into those distribution centers, that e-commerce, to take on Amazon. Now, of course, like everybody else, they declined to give guidance. That's also a little bit scary. But after an 80-some% run, from the COVID low in last March to where it was at the beginning of January, seeing seeing it drop from 200 to 170, not necessarily a horrible thing. We'll see if it can consolidate in here. The next resistance is just above where price is right now, at right around 180, and then we'll see if we get some clear sailing up into that $200 area. We lost a lot of momentum in this pullback and went oversold on the RSI. So a higher probability, as we're seeing right now, once you get in that oversold area, that we'll get a near-term bounce. Where it ends, nobody knows, but the justification for that upgrade may be there with all the things that they're doing and the acceleration of the process that they had in place before the pandemic.
Okay. Pat, I like the technical look at the chart too. Even with all of the big expansionary plans and the way they plan to capitalize on being one of the core places to get basic goods during the quarantine. Obviously, if Target wasn't a staple already, it is now for many, but now maybe that's working against it a little bit as the market throws out some of these quarantine winners. So Target getting mixed up in that right now, but a solid bounce on this report from Guggenheim this morning. Thank you, Pat Mullally. Good stuff. Nice work, our contributor from Salt Lake with the update. Let's shift gears. Let's bring in Alan Nuckman, who's got a trade for us and some thoughts on the market as always. He's a chief market strategist at St. Paul Research. Okay, Alan, first let's talk markets. So you impressed by this response to the stimmy, $2 trillion? What is this? We're talking basis point moves, Alan?
Well, I'm impressed by the market action last week. What we saw the Dow and the S&P go from sharply negative to close positive on a weekly basis. That's impressive. Now, tech has tumbled and hasn't come back yet, but the action from Friday was very positive. The fact that it was much lower and came back and closed positive on the session, it's got to build on it. That's true, but that's a very healthy sign. We're finally seeing some capitulation in tech after this tumble. But there's been many, many times we've been down 10% over the last 5 years, and guess what? Each and every time they've rallied back and made new all-time highs. Okay.
So until proven otherwise, go with the trend.
Right. You want to be buying dips still. It hasn't changed into a sell rally market. It's definitely still buy the dips. Now, let's get to rates because I know we want to talk about that. And I did look at the markets. The markets are usually right. If you look at the Eurodollar futures, if you look the 2023, 2024, and 2025, pricing in a half-point rise each of those years, that would bring it to 2% in the short term. Okay, so the markets are not pricing in any short-term hike in rates, even though we're feeling like it could happen sooner as opposed to later. So, usually the markets are right. Let's see if this is just a rate recoil here, a little bit of a rally and a little bit of a spook as we saw in 2018 when everybody freaked out on that fake out breakout when you saw the 10-year yield get back above 3%. Let's see.
Okay. Well, Mr. J. Powell eventually turned around and caved the markets. It just took a little bit of carnage first in an inverted yield curve. But that's a longer conversation. Alan, just for the buy the dip part, what about for the NASDAQ? We've been selling rallies for a couple of weeks. What will become convincing as potential trend establishment to the downside? What are you looking for us to notch another lower low, to break below that September high? What to you would change the game for the NASDAQ?
I think we tested and made new multi-month lows and then rallied back last week.
That's correct.
So if that can hold, 13, lucky 13 is my number. 13,000 in the NDX is a pivotal number. It's the halfway point of that drop from the top. And typically, if you give above that halfway, if it more than a 50% retracement, guess what? We rally all the way back. So we've seen that time and time again. Apple still can't find a bottom. So psychologically, I think that's what's holding the market back. But people can quickly change their sentiment when you see Apple on the move again. Again, let's remember last quarter they made an $18 billion profit for the quarter. That's more money than most companies make in a decade.
Okay. Alan, let's talk about your trade today. You're going outside the U.S. You're going to China to trade a social media stock, Weibo, WBs.
Yep.
The ticker, it's pulled back from the highs after a lot of these Chinese tech companies ripped at the start of the year. My guess is you're buying the dip.
Yep, buying the dip. Now, looking at this, it obviously has less exposure to what's happening with interest rates here in the United States, but technology has tended to stall, obviously, here in the last weeks and months. Now, looking at WB, this stock had rallied 100% off its May's lows to its December highs. Since that time, it's relaxed, and we've seen a profit-taking pullback, and it's down 15%. Now, if you look at that chart, 45 is critical. That was a double top that it broke out above and rallied to those extreme highs. So I'm leaning on that 45. I'm looking at the April 45 calls. They're trading for about 9 or 10 right now. They're deep in the money. They're going to have a delta of about 80%. So it's a stock substitution strategy here. And it's a good value here at these levels from a risk reward standpoint. You get yourself some time, but what I'm seeing is smart money is starting to accumulate big positions on the bullish side in WB, and we've seen this play before, and it's rallied. So I'm willing to jump on board one more time.
Okay. So you're looking at support from old highs, so some traditional kind of technical analysis saying, hey, we've been here before, and then the strike that you're looking at with the 45 calls, this one looks even more deep in the money than usual for you, Alan, as we go $5 away from 52.
Right. It's because it's got a degree of volatility, and because I'm buying less time. I'm buying an April option. If I was buying a May option, I might not go as deep in the money. So there's always that balance there. But what I'm looking for is typically something between a 75 and an 80% delta. So it'll act like the stock. That's the key on the upside. So if we can get a little bit of an upswing here, from our lows 50, it had a nice reversal on Friday. It needs to build on that. And so from 50 to 65, so somewhere around the 57 level, if it can rally above that, then that'll be a very, very positive sign. And if that happens, that option it'll start to gain in value very, very, very quickly. And that's the key. A modest move in the stock turns into a big return in these deep in the money options. That's just the math.
All right. Appreciate it, Mr. Nuckman. The K is silent. The chief market strategist at St. Paul Research. Good stuff, Alan. Always like to trade in the details. Let's take a little diversion from the highlights of the morning, which are about stimulus and the market's response. Bond stocks, put it all to the side. We're going to get a little weird next. We're going to talk non-fungible tokens, NFTs. For many, it is the highlight of a speculative fervor in markets overall, but our next guest will make the case that it's art like anything else. The NASDAQ almost back positive.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on ThinkOrSwim for the full Options for Volatility course and a whole lot more.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on ThinkOrSwim for the income investing course and a whole lot more.
Welcome back to Morning Trade Live. The NASDAQ goes positive, but we're taking a break from the stimulus whipsaw this morning to talk some crypto, where the latest craze is NFTs, non-fungible tokens, which certify digital scarcity using the blockchain for icons like cyberpunks and videos like basketball Top Shot from the NBA. Joining us, James Wang is a former analyst at ARK Invest. He's an NFT investor. Here to make the case, James, you're on the side that this is just like any other art, basically, but with better tools to understand where they come from, and it's not just another speculative crypto craze. So walk me through, what's the first thing we need to know about NFTs from your point of view?
Hey, Oliver, it's so great to be back. The
Thank
most important thing I think people need to understand about NFTs is to kind of think back on Bitcoin 2010, Ethereum maybe 2018. Lots of people, very smart people, treated those things as speculative bubbles, as things that had no intrinsic value, and did not care to understand them, and were on the other side of the trade. And now I think we clearly see that they were on the wrong side of the trade. So I think the first thing people need to do is at least to be open-minded about them and not just to write them off as another crypto gimmick. If you want to understand NFTs kind of for what they are, essentially it is the first time we've had software that will ensure digital scarcity on the internet. We've never had that capability before. So it is a genuine technological invention, not merely a gimmick to kind of bid for the highest thing. Although people will do that. People will generate bubbles on their own. But investors and people who are technologists really need to separate the kind of speculation component and the technological component.
Here's, James, where I immediately kind of run into trouble with the logic here of some of the prices. Again, as far as digital scarcity for things and the potential use for NFTs as kind of as a vehicle, it seems like there's some interesting cases. But in this moment, we've got people paying millions of dollars for these crypto punks. I can copy paste a video of a basketball clip that I can see on YouTube. How are the prices moving so quickly if people are not getting ahead of the potential demand? So this unique thing you're describing, how do we know if we need it? It seems important. It's definitely unique, the technology, but how do we know if we're really going to need it over time?
I think there's definitely a little bit of a short-term speculative bubble going on right now because it's so new and because the prices are going up so quickly. And of course, lots of people have been minted kind of crypto millionaires due to the recent run with Bitcoin and Ethereum, that they're just looking for places to kind of speculate even harder, if you will. So it's not to say that there are not certain bubbles right now. Whether you need it or not, whether you want to pay, $10,000 for a CryptoPunk or a few $100s for a Top Shot kind of clip, that is entirely up to you. You don't let other people set the prices for you, but do not write it off. As for why are they worth this much when you can just copy a version, you can download the same clip. You can go to the Louvre and take a high resolution picture of the Mona Lisa and hang it on your wall, and that is not worth anything. But it could give you the emotional satisfaction, but it probably won't either. The Louvre's original Mona Lisa is still worth that much because of proven authenticity. We can prove authenticity in the real world, in the world of atoms. Today, we can, well, prior to NFTs, we could not prove authenticity in a decentralized manner for digital items. Now we have that mechanism, and I think the whole world, any company that has unique IP and unique content is going to figure out ways to actually use this to sell things uniquely, digitally on the internet. This is a far larger opportunity than just NFT tokens and art and things like that. Take, for example, Disney. How much content do they have? They probably have the largest treasure trove of content of any company in the world. Think of your favorite Star Wars character, your favorite Marvel character. There was no way to buy them digitally before. You could buy the toys, you could buy the DVDs. You could not buy anything digitally. Now they can sell it digitally, and it can be guaranteed, authentic, traceable, and unique copies.
This is where I think it's interesting because it's, you know, a kid who collected cards, right? Now you've got this Top Shot thing going. If we think about buying characters or buying clips or, you know, buying representations of certain moments, it's interesting, James, but I also wonder from a digital side, how do we share these things? Am I just gonna, like, you're gonna come over and I'll hold up my computer and sift through things and show you? I mean, when you had cards, you'd sit and you'd put them and you'd show, and I've got this thing, and if you don't have it, you can't see it. If you come over to look at my basketball cards and I've got the Michael Jordan rookie card, you can see it there, and you can't unless you go to the store and look at it. Even if I do have this clip or whatever representation, you don't need me to have it to see it, right? You can just look it up. So to me, it seems like the Top Shot and other things is just difficult to compare that to something that is physical. Same with the painting, right? I can take a picture of it, but nobody's gonna pay me for the photo of the Mona Lisa. They're gonna wanna look at it. But if it's something else, like the crypto punk, they can look up the same thing online.
Mm-hmm. Oliver, you can see the Mona Lisa online right now. It would take you 2 seconds. You still want to go to the Louvre to see it. Of course, there are some resolution differences and, you know, tactile differences, but all this is coming. How do you see crypto NFT content? You can now. What's interesting is the latest sales from artists for crypto art now come with displays. They will actually ship you physical displays. The latest drop that happened on Nifty Gateway on Sunday, they will ship you a physical display if you still hold the art 2 weeks from now. And it's a very nifty kind of acrylic, very, very nicely presented display. So you can literally hang it on your wall. And when your friends come to your apartment, you can show it to them and tell them the whole story of how you bought this thing. Okay. And it is the original copy.
Okay, so now we're kind of, it's like you've got the backing for it, but you've also still kind of got the traditional art. Jack Dorsey just sold his first tweet, or I don't know if he's actually sold it, but the bidding's like going up into the millions. For stuff like this, James, I buy a piece of art and I work with the artist and I know how much time he's put into it and his techniques that he's perfected over years of studying under other artists. For this, it's just a guy tweeted something. I mean, isn't at the end of the day for art in general, there's work that goes into it? I mean, these cyberpunks look like they just set an algo to churn them out and they're selling at 50, 60, hundreds of thousands of dollars. I mean, there was the effort and work behind. Isn't art supposed to have something like that behind it? I sculpt, I take months to sculpt and I sell it?
Definitely art should have such intentions, but debating art merits is also obviously a very slippery slope. I think it's better to view Jack Dorsey's first tweet as a collectible, right? What is a collectible? You could say a collectible is something that is both scarce and that has perceived value. And the first tweet ever on the whole Twitter network, I think definitely falls under the category of being scarce and, you know, desirable by some people. And you only need maybe 100 people or a handful of people who desire it for there to be a market for this thing. It's obviously a low liquidity, low supply market. So the fact that, you know, a handful of people are choosing to bid this to $1 million, you know, it's up to them. I'm not going to pass judgment on it. I'm not interested personally in that tweet. I might be interested in other things. Another framework you might use that kind of helps you wrap around the kind of NFT concept is think of it don't think of it from the buyer's perspective. Think of it from the content creator's perspective, the artist or musician's perspective. They have lots of fans. And today fans often try to tip or try to show some kind of support for the artist. And all they can buy is some merch for $12. How do I actually tip a musician or an artist $50, $100, maybe $1,000 worth of something to show my support? There's no mechanism. and the artist has no way to give them anything off that value just like on the fly. NFTs is basically, you could think of it as a way for people who really are fans of the creator to tip them in exchange for something of symbolic value back that also is scarce and maybe of value in the future. So there are many, many ways you can creatively apply this. We're literally in the Stone Age. We're day one. And there's a speculative bubble day one, sadly, but don't get lost in the bubble. This is going to be big. It is going to be persistent. It's going to be very important 3-5 years from now.
To me, James, it seems like a lot of this kind of hinges on how much we live in a digital virtual world, because the idea of using this tech as a way to give back to an artist or show that support. I mean, I can also go to the merch table at the concert, right? And in many respects, it's very similar. I mean, I'm going to use fiat currency to buy something, but in this case, I'm just going to use a cryptocurrency to buy something digital. I mean, is a lot of this kind of hinging on us living in a digital world, and is there a risk that that has been overstated after a year where everybody's been stuck inside? I mean, I'm a gamer, I think as much as a lot of other people out there. I play too many games I'd rather, admit to. And I can kind of think about how in some of these games, you can collect certain items. I can show you my cabin in Skyrim or whatever, and I can show you all the things I've collected, right? But that requires us to live in this sort of virtual world. Is there a risk that we've overstated the pace at which we're going there?
We're not understating it. We're not overstating it. We're understating it, Oliver. Virtual worlds are the way of the future. We're not meant to just be stuck in this world. We've been creating virtual worlds since the days of Homer, because the current world is painful, is limiting, and we cannot travel faster than the speed of light. That's why we create virtual worlds, to escape the bounds and the limits of physics, and it's highly desirable. If you just plot the percentage of time we spent in, call it, virtual environments, whether it's the kind of the verbal tales of Homer to the full VR realities of VR worlds, that share is increasing, will only increase with time. Now, Corona's was a step function, push higher, but it's not this one time that will go back to normal. We're not normalizing back into more and more physical. Virtual is simply going to eat up the share of kind of the mind share of reality we have. NFTs is kind of another phenomenon of that. There's the whole phenomenon of course, software eating the world. This is kind of internet GDP eating physical GDP. That's Stripe's motto, and NFTs are probably a huge super booster for that trend.
Okay, for the GDP part, I'm still curious about the productivity. James, before you go, real quick, are there any NFTs you own you want to tell us about? Or if there's a viewer interested in this, where do you point them to? Where's the marketplace to go and buy something if they want?
Don't treat this as an investment, right? Treat it only if you like it. Nifty Gateway is the platform I've been using to collect some art from my favorite artists. Mad Dog Jones is one. He does fantastic art, kind of futuristic impressions of Tokyo. I really love his work, but go check it out on your own. If you're an artist, try mint an NFT. Learn about this space. Don't just write it off.
Okay, all right. Appreciate it, James. Thanks for joining us.
Thank you.
Case well made. James Wang is a former analyst at ARK Invest. He's an early NFT investor. When we come back, let's get the chart master in here. Back to reality. The stocks with products we can touch. I guess reality is perspective. There's a virtual one, a physical one. These companies make physical products. They're in the U.S. stock market. We'll be right back.
(24/7) access to diverse global markets. Right here.
That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready.
Well played.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series
Federal Reserve support and the reopening of the economy, it speaks, to us as an expanded economy. And I also think, the increasing rates could mean a buying opportunity and create more room for value stocks to do better and to have a more sustained rebound. Long term, I think if interest rates increase at a steady pace, that investors like myself will be able to adapt and rebalance into investments that yield increased income. But it's really hard to predict. But I think long-term investors like Chicago teachers, there's really no need to panic, but really to continue with the asset allocation policy, the strategies that we have been doing. And right now, the portfolio is equally balanced between value and growth. And we really rebalance back to our targets on a monthly basis. So any increase in interest rates or, a shift to a style or a cap size favor really should have minimal impact on the portfolio in the long term. It just, for me, rebalancing, it speaks to which stocks I need to, or which managers I need to trim, and which stocks I need to add additional funding to. So that's kind of how it helps with me. But I think the message for institutional investors is that now is the time to remember that a diversified portfolio with a disciplined rebalancing strategy is key.
Yeah, just to dig into that a little bit more, Angela, I mean, I guess along those lines, just all the volatility we've seen, all the gyrations in the market as of late, is that an opportunity? Is that something you expect to continue? And is that where you see the opportunities in terms of that strategy and that idea around rebalancing?
Yeah, I think the volatility is going to increase, and we watch it very closely because we are an underfunded plan. So we have to make sure that, we are not liquidating at, a downtime or, a low point. So it really just signals to me where I need to liquidate and what I need to add to. And right now, because we are diversified, I am trimming some of that growth and some of the success that our growth managers have had. And as a way to really increase the value stocks and to provide the cash that we need to really pay our pensioners. So I think it's wise for me right now to really just set stakeholder expectations that we may be in for a bumpy ride, as the economy recovers. I think volatility is something that we have to tolerate at various points to really get to a stable market environment.
We talked so much about ESG investing, Angela, and we showed a full screen a little bit earlier in this discussion, looking at your allocations. What is your methodology? How are you applying that in terms of an investment thesis? And as we are seeing more companies come to market in more ways, is there more supply out there for you to choose from?
Yeah, I mean, there is so much for us to choose from. And I think ESG for us gives us the data that we need and the research that we need on not only choosing stocks that have good risk management, but also choosing stocks that will have better returns because of the sustainability and because of the ESG measures that they put into place. So it is across all of our public stocks as well as our private markets that we look at ESG, and we look at what the managers are doing to have a more sustainable organization and more sustainable strategy. So it does increase, what we have to choose from.
Fascinating to hear you talk about it, even as we're seeing things like the transports now at an all-time high. Angela, it's great to see you. Thanks so much for joining us. We'll see you next time.
Thank you.
Well, Carl just mentioned it, but as we head to break, we are watching the transports today, trading at record highs, outperforming the broader market pretty significantly, up about 1.7%, led by gains in the airlines as the TSA says it screened almost 1.3 million people this past weekend. Shipping and logistics stocks also holding on to some solid gains here this morning. We'll be right back. Stay with us.
technically the way you've got it drawn, Ben, it is possibly a change.
Yeah, absolutely. And if you look at the longer term trend here, this is still, if it bounces here, a higher low in the context of the longer term trend. Maybe not intermediate to long term, but certainly if you were to draw a trend line, you could make the case for this making higher lows off of those March lows.
Okay. Ben, last one. Let's talk SEAS. For those that don't know, this is a little business called SeaWorld, specializing in aquatic attractions. But we did already talk about Disney today, Ben, and the park's getting ready to open up. SeaWorld, okay,
yeah.
A little reopening play, a little Shamu action to the upside.
Yeah, absolutely. And that's certainly what it looks like at this point. Although he's not quite leaping out of the tank entirely yet, but there is a little bit of a bull flag rally here. We get the gap up on earnings. It pulls back into this flag support right around that 44.30 mark or so. But we get a bounce up to this previous high right around the 51.25. Now, you can see where I've projected that flagpole target, and that's a big target, and it may take a while to get there. That's up around the 62 mark, and Shamu's just breaking his nose above the surface here, right there at that 51.25. If we can see it continue above that level, then I think you might see that flag target come into play. But combined sentiment is flat and converged up and overbought. I would actually, honestly, much rather see that sentiment indicator down in the lower portion, down near oversold with the potential for it to turn up, rather than being up in this area where sentiment is already high and has been there for a while, Oliver.
Okay. So maybe a little bounce here. And, this is not really a company that's on many folks' radar, but, if you're looking for, the go out and back to normal trade, I guess SeaWorld is not a bad one to do it. Citigroup says it's too much, though. They downgraded them to neutral. They had it at buy. They got it right, but they didn't think it was going to go past 34 bucks. So they've put the price target at 52, which is a little bit above where we are, basically where we are right now, but they're saying not to buy it at this point. So that's one way to look at it. The analysts over at B. Riley say it's going to 65. They say you can still buy it. It's still got room to run here, another 15 bucks. So there you go. Another room to run, another room to swim. I don't know. I get uncomfortable about the SeaWorld puns and the Shamu stuff. It didn't end well. All right, Ben, appreciate it. Thank you, Chart Master.
You bet.
With the technical update here. It's market meetup time. When we get back, let's talk a little stimulus reaction. Get our guys in here and talk some charts.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I added futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it.
I'm Maria Schrader. Here are a few stocks moving this hour. American Airlines announced a private offering of $2.5 billion senior secured notes in 2026, due in 2026, and $2.5 billion due in 2029 to eligible purchasers. It also announced an additional $2.5 billion senior secured term loan credit facility. Proceeds of the offering will be used to repay the outstanding balance American Airlines owes to the U.S. Treasury. American Airlines is up 4.5% today. MKM Partners upgraded Peloton to buy from neutral, maintaining its $130 price target. The analyst says Peloton's 34% decline from February 4th highs creates an attractive buying opportunity, and that supply chain investments are driving positive results. He's also positive on the national U.S. rollout of the Tread model in May and medium-term growth initiatives such as the corporate wellness programs and B2B sales efforts. Peloton is up over 3% today. DuPont announced it will acquire Laird Performance Materials for $2.3 billion in cash. The transaction is expected to close in the third quarter, and DuPont expects $60 million in cost synergies. Laird specializes in electromagnetic shielding and thermal management. DuPont also announced a $1.5 billion share buyback program. DuPont is up around 2%. This has been your TD Ameritrade Network Market Update. Now back to Morning Trade Live with Oliver Rennick.
Welcome back to Morning Trade Live. It's time for the Market Meetup panel. Stocks back and forth for the NASDAQ, but now adding up green across the board. Michael McCurr joins us, Senior Institutional Strategist of Trading and Education. We've got Tom Weier, contributor here on the TD Ameritrade Network as well. Guys, good morning. Mike, let's start with the charts. Where do we stand on the S&P 500? How you're looking at the stock market after a nice close Friday and a little bit of a bounce this morning?
Yeah, so Friday's plunge and reversal was pretty impressive. But one thing that I noted is that from a statistical standpoint, there's no real edge in following what we saw on Friday. So I don't want to make it seem like just because we had this massive reversal, the S&P was down over 1% and it closed up nearly 2%. It's nearly coin flip odds anywhere out to a month. I think the most important thing is that we continue to hold some of those key intermediate support levels, specifically didn't get down towards that 100-day moving average. Momentum did not get oversold. If it did get oversold, that tells us that there's a change in character going on in the market. But the most important level that I'm looking at is going to be the near-term inflection point on the S&P, and we're testing it right now on this retracement higher. It's right around that 3860 level. It's going to be the 21-day moving average, and that's going to be that green line. You sort of see how it acts as it goes up and down over the course of the last year. So that's the level that bulls want to see the market get above. Right now, I'd say that the bears nor the bulls really have the upper hand, which is why I think we're going to see this push and pull or volatility or this choppiness continue this week. I think a lot of which is going to be tied to what's going on in the interest rate market. You've got some key reports that are coming out. But overall, I think the market continues to have a level of constructiveness that bulls are continuing to view positively.
Okay, I like that. Nothing conclusive on who's in the lead right now, and it does seem to resonate from my much less sophisticated technical interpretation, Tom, which is that the NASDAQ has basically been sitting at that September level. That's kind of been where I start with my analysis is where are we relative to that, given that it was an important point in the past, and we're basically right there, finding a little bit of support there. But, you know, to Mike's point, it just, there's not a lot of clarity here on whether we're establishing trend to the downside or if this is just a dip per normal. So, Tom, if it's a dip per normal, though, then we've got an issue with bonds, I think, in that case, because that there is something new, and that's where the story keeps hitting a wall for the tech story to bounce, because every time we try and bounce, rates just keep going up.
Yeah, and I think that's the key, Oliver, is the velocity. We've talked about that over the last couple of weeks, is the velocity that we've seen yields rise. You know, the equity market can go up in a rising rate environment, but the velocity and trajectory that we've seen in that 10-year yield spike has caused some consternation for equities, especially that tech-heavy portion of it. The NASDAQ actually still down negative on the year, and I think that's going to be a concern moving forward. Will we get some consolidation around this 1.5, 1.6% level for the 10-year? I think that's going to be the telltale sign and drive the direction of equities in the near term. Is it going to be choppy? Yeah, most likely it's going to be choppy. But if we can get some consolidation, maybe a little bit of a pullback in those the downturn in treasuries to where we get those yields maybe falling a little bit and hovering around 1.45, 1.5%. And then I think you can see the bulls come back in and some beaten down names. I mean, you look at names like Apple and some of the chip names today, Microsoft finally making a move to the upside. So I think you're going to have to watch the interest rate environment here to catch what type of trend we're going to see in equities over the near term.
Okay, now, so if the question hinges on bonds, then let's go back to Mike and let's talk about the bond chart, Mr. McCurr, because there are a lot of folks trying to figure out where the 10-year yield can go. And I'm more increasingly becoming like a bit of a zealot in my view, Mike, that we should look at it as just price action, because the whole Fed thing, at least it's not adding up the way the experts have said. They have said that, well, rates are going to stop moving higher because Powell was going to calm the market. The logic never really made sense to me, and it didn't work out last week. So when we're looking at rates in particular, what should we have in mind? Is there anything we can derive from the ascent in the 10-year yield that tells us where it might go, where it might slow, et cetera?
Well, I think the major pattern that I had pointed out with you over the last few months since I think the date specifically was December 15th, the 10-year yield on its one-year daily chart showed a multi-month bullish ascending triangle pattern.
Okay.
Long story short, that's just a massive period of consolidation that creates all this energy, and when it moves, it's going to move powerfully, typically in the upward direction. And we got exactly that. It was creating a measured move of about 50 basis points, the way that a technician would look at this pattern, and that took us from 1% on the 10-year, that was the horizontal resistance, all the way up to that 150 level. So technically speaking, the pattern hit the level that it was typically supposed to hit. From here, you have to extrapolate where can it really go. So from a Fibonacci extension point, it could get as high as, let's say, 175. That would be the 161.8% Fibonacci extension. But I think really the market is more fretting, not the move in the belly, which is the 10-year, or the long end. Those rates are rising because the expectations for growth are increasing dramatically as we get these vaccines distributed. The move in the equities is more fretting the fact that the short end, and this is my opinion, so the move in the short end has been far more violent than it has in the belly and in the long end. You look at where front end Eurodollar futures are from DEES 22 out to DEES 24, we're already pricing a full interest rate hike by the end of 2022, yet the Fed, based on its latest economic projections in December, is not forecasting even the first hike until at least the end of 2023. I'm not surprised that Powell didn't say anything last week. It's just simply a paid speech by the Wall Street Journal that he was talking through. They're not going to communicate or push back very hard unless it's at a meeting, in my opinion. This isn't last March or April when they needed to really put the bazooka on the table.
Okay.
They're not really concerned because they want long end rates going up, and ultimately they can't control the long end, whether they think they can or not. I'm more concerned about what's going on in Eurodollar futures. You've got an interest rate hike priced in by end of 2022. You look at DEES 23 Eurodollars, rates are pricing 1.5%. That is a huge disconnect between them and the Fed.
Hey, Tom, so if we're not hearing from Jay Powell until the next Fed communication, which is on the 17th, I believe is the day, then should we just assume that the relationships we've been watching are going to continue, higher yields and lower stocks, and the tie-in between those two until something different comes and they maybe talk about buying bonds?
Well, I think you've got some inflation data that's coming up that's going to maybe rile the market. So those are going to be closely watched to see if, we see a spike on that level. But if you look at it, you know what? In a trending bullish market, which I think we're still in the long term, you still have to, realize that, hey, we're not out of it yet. And if we get some consolidation, that's going to be good for markets, both in the treasuries, yields, and also equities. And I think that's going to be the telltale sign. I think Powell's going to keep his his mantra going, Oliver. I don't think his rhetoric is going to change anytime soon, even though the market is predicting something different.
Okay. He didn't seem super eager to push back on any of it. So, all right, guys, we got to go. Thank you, Michael McCurry, Tom White for the thoughts. Let's go to Alex Coffey. What's going on in fast market? Alex, hit me with the preview.
Well, Tom White's sticking around, so lucky us to start the show on Fast Market. We're going to talk some Tesla. A little bit of volatility in that name, a lot like its prior trading action. It's been a volatile stock for many years, so no surprise there. But then we're going to talk some earnings. We're talking Stitch Fix with the team from Folio. Jenny Horn's going to join us.
Okay.
And then Kev and I are going to close out the show talking some Dick's Sporting Goods.
All right. Finding the earnings where they are. Thank you, Alex. Fast Market's up next. Thank you for joining Morning Trade Live. Hope you had fun. See you this afternoon for Market on Close.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on ThinkOrSwim for the full Options for Volatility course and a whole lot more.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Good morning and welcome to Fast Market. It's Monday, March 8th. I'm Alex Coffey. Take a quick look at where things sit as we near the 10 o'clock hour here in Chicago. You have a bit of a mixed bag for equities, but generally trending higher here as the S&P 500 is now up almost 31 points to the upside, 3870. That's up about 0.75%. The NASDAQ remains weak, down 0.5%, but well off its lows, down 27 points right now to 12,644. The Russell 2000 way out in front, 1.67% to the upside, 36.5 points. And the Dow Jones nearing 32,000 is up almost 500 points, about 1.5%. Yield still moving higher. Crude oil has been all over. It is now down, and gold getting slammed. To help me break down this action and more, I want to welcome in Kevin Hinks, the co-host of Fast Market, and sticking around from the panel is Tom White. Tom, a contributor across the network and the unofficial third member of the Fast Market team. Good morning to both of you, gentlemen. Happy new week of trading here. And Tom, so many headlines, a flurry of them over the weekend, yet you don't see a bunch of movement here in terms of the equities. We're working higher generally, but again, I know the viewers and market participants, they don't like the oversimplification of rotation, but that's kind of what we're seeing, isn't it?
Yeah, and I think the market's kind of on edge, right? Comments out of David Tepper from Appaloosa this morning totally and completely turned the market. Even though yields didn't do anything at the time, they came off of their highs a little bit, but you're seeing these comments out of him saying that, hey, it's okay to buy stocks, and a lot of people heed that type of advice. But at the same time, if you look at the divergence between some of the movements and individual names, you know, we've got Apple still down negative. We've got NVIDIA, AMD down pretty hard. If you look at charts of Walmart and some of the retailers, we've got Target rebounding a little bit today on an upgrade. Costco's up a little bit higher. But you look at some of those things, and if you were to say, hey, we've got a $1.9 billion stimulus package coming out, or is it 1.9 trillion? Sorry about that. Coming out. Who's going to take advantage of that? It's going to be the retailers. And if you look at some of those names over the last month or so, they've been beaten up quite a bit. But you figure that, hey, if we get money out into the hands of people, that they're going to spend at these retailers, and there's probably some opportunities there. But if you look at the other side, maybe there's opportunities in tech too, because they've gotten beaten up due to those rising interest rates.
They certainly have, and it is an interesting question to be asked. But Kevin, I want to get your opening thoughts here. The first thing that sticks out to me is the NASDAQ actually has about 60% of the names higher today, about 58 of the 103. So let's say at 50-50 in terms of higher, lower. You have the NASDAQ down, and so much of this is just because Apple's down 2%. We know the importance of these mega cap tech companies, particularly Apple, and an outsized down move is enough to drag on this indice.
Yeah, good morning, guys. You know, I was on with Oliver Rinnick early this morning, about a half hour before the market opened, and I said to him, we've already had a big trading day. You know, these futures opened up at 5 o'clock last night, and the futures sold off hard, led by the NASDAQ. And then, like Tom White just mentioned, David Tepper made his comments this morning. But I thought it was really interesting. Anyone can say, oh, you know, stocks look cheap here. We get a lot of that on these shows and in the market. But I thought why he said it was really interesting, in that the spread now between the U.S. rates and Japanese rates make our bonds attractive to Japanese buyers. And that's why he thinks there'll be a big flow into our bonds from Japanese buyers. And with the commitment of traders and the short positions in bonds right now being pretty large, that could, you know, move interest rates either stable or lower from here. So I thought the reasons that he gave why rates were going to stabilize and then stocks could look attractive were really compelling. It really caught my attention. And I thought, and Tom is exactly right. The market turned on a dime when he said that, from week to at least 3 of the 4 indices going positive soon after that, guys.
And Tom, I have the NASDAQ futures, the time frame going back to that open last evening, and that's effectively the high. So for the NASDAQ, to Kevin's point, we gap up 12,757.25, and then it was a steady but sure downtrend all the way until the wee hours of the morning, and now we're working our way back higher. So it's almost like, you know, Kevin's point, we've already had a full trading, day of trading action. But really, this has been the chart of the past few sessions. We've had volatility intraday. We've had volatility in the overnight sessions. We've had some pretty massive dips, some pretty vicious rallies. And it's been a tug of war back and forth. Is there anything that leads you to think that this is, you know, going to change soon, or should we get used to some of this intraday volatility?
I think we should definitely be prepared for more of a roller coaster ride as far as equities go. And to that point, you know, the action that we've gotten over the last couple weeks, we've finally gotten that point where they're still buying dips. And we saw that this morning on those headline comments out of Tepper. But at the same time, there's finally some people that are willing to sell the rips a little bit. And anytime you get a move higher, they're going to probably start, you know, taking some profits, maybe getting out of some of their positions due to the rising interest rate environment that's causing that consternation that we're seeing in portions of the equity market. Now, cyclicals are still in their upward trend. They're still doing well. Financials, with these rates rising, are doing well. I believe the 2 10-year yield spreads up to 1.44%. I mean, that's the widest levels we've seen in over a year. So that's good for financials. So you're definitely seeing money getting put to work. But I think that overlying sentiment that, hey, if these stocks go up quickly, there's still the underlying tone that, hey, maybe I don't want to own these things right now due to this rising interest rate environment. And that's really taken hold in tech. With this snapback rally back, and you're not seeing AMD and NVIDIA up, Apple still negative, you know, that's still a concern, I think, for a lot of investors out there.
It's a great point. And Kev, when we're talking kind of news and digesting stories and reacting to it, but you don't want to overreact, I don't think we have to cover crude oil, the Brent contract in particular going over 70. And as more information comes out, oftentimes you get more clarity, and the first move isn't necessarily always the ultimate move. And you saw a pretty vicious gap higher in crude oil, particularly in the Brent contract, as I said, on the headlines of the attack on the storage facility. And as more information came out, the attack was intercepted, output was unaffected, and so that fear dissipates and you really see the repricing take place. How important is it, Kevin, to keep our eyes on the news wire? But, you know, you never know when the story is the story. It's so difficult. Is that why we have to have a plan going in for exit, both on winning and losing, so that we aren't making kind of rash decisions based off headlines?
Yeah, you know, there's a different philosophy or mindset with trading futures rather than trading stocks and options and other things. And I learned that from trading the grain markets and the grain futures. And some days you have a core position, possibly, right? That's either bullish or bearish or neutral. And some days, let's say right now you're bearish crude oil and this news had come out. Well, you have to trade the market that's happening in front of you. That doesn't mean you don't keep your core position, but for that day, you may have to trade with a bearish core position, but a bullish tint for that day. And one thing I've learned is that the fundamentals will eventually come back into play, right? Eventually it will be supply and demand in crude oil. Right now it isn't. It's rising demand and holding supply firm. Then a microeconomic news flash hits the market, causes it to spike up. But as the news evolves, Alex, and you are becoming an old, crusty trader like the rest of us, Alex, saying that first move is wrong. That's an old, that's a veteran trader speaking right there. So, you know, fading that first move, that's the panic. Doesn't always work out, but yeah, crude oil's really interesting trade today. News story and now lower on the day. Very interesting.
Yeah, Kevin, the crude oil story is important too, because had there been some type of damage, it may have been a bigger deal. I mean, a substantial, like 7% of the world's demand could be stored at that facility. So it could have had a pretty significant impact if there was damage, and that's why that's why you saw crude oil move. But Tom, kind of as we close up things here and we transition to some talk on Tesla, I think Kevin makes a crucial point. I want to get your thoughts on it. Kind of this concept of trading around a core position. He, of course, kind of talked about how that relates to futures traders, but I think that you can take that one step further and kind of talk about, you know, so many of our viewers, both investors and traders, they may have long-term portfolios that are, you know, the significant portion of their overall portfolio, but they're trading on the side. They're taking a smaller portion of their overall net worth to try to generate additional alpha. And I look at that as your core position is that long-term portfolio, and you're trading around it, maybe using some of these strategies that we talk about to empower yourself, to learn a little bit more, improve cost basis. But ultimately, you're trading around your core position. How important is thinking about it that way when you're making investment decisions?
Well, I think it's everything, because that core position or your long-term portfolio allows you to have that account that you can trade in, whether it's based around those core positions, maybe hedging some of your directional bias. on the positions that you hold in your long-term portfolio, or just speculation. But it's only a portion of what you have in your overall portfolio. Maybe 10, 20% of your core holdings are going to be allowing you to maybe speculate or hedge existing positions, or do earnings plays, regular trading where you might have an assumption based on whether it's a day, a week, or a month. And I think that core basis is what you should have before you start getting into the speculation. And we've seen the opposite happen lately, guys. And I think you guys would all agree that you're seeing a lot of speculation out there without that big, huge core holdings or retirement portfolio. And that's probably not the best way to do it, because you should only have a portion of your allocations for speculation and hedging and trading on a daily basis.
Yeah, and each individual, of course, is different, and that's an assessment for them to make. But Kev, let's talk some Tesla here. I'll give you the first kind of statements here on this name, because we've talked about gold being a bit of a heartbreaker. Tesla, in many ways, has been that for both short sellers and market bulls. It just has some vicious moves, and we're in the midst of one right now. Stock traded up near $900, is now sub 600 in just a matter of weeks. Incredible volatility in this name.
Yeah, live by the Tesla sword and die by the Tesla sword, guys. I'm going to give you a little chronology of Tesla's events. On or around November 16th of last year, they announced they're going in to the S&P 500. That day and the next open, Tesla moves from $408 to $440. Then, between then and December 21st, the day it goes in, it moves up to $649. On the 18th, it's there. The 21st, it's $649, down from $695. Then January 25th, it reaches $900, but closes that day at $880. So you can see the speculation, the hype going into the S&P 500, what it did for the S&P 500 along the way. But now Tesla's in the S&P 500, and it's lost about 33% of its value. Let's round it from 900 to 600. So really, you live by the sword in Tesla, you die by the sword in Tesla. That doesn't mean there's not opportunity trading this, though, guys.
Tom, one thing that's always astonished me about this name is kind of the master, maybe it's Elon, maybe it's just the PR team at Tesla, but they seem to control the narrative that just seems to always be positive. And when you're reading headlines, like I read some of the headlines that come out on a daily basis on Tesla, and every time I'm like, is the stock up $40? Like, this seems like a huge story. But because of that, there's so much optimism priced in here. There's so many, huge fans of this name that are going to hold their shares, whether it goes up, goes down. They're going to add more when it goes down, possibly. Loyal fans of Tesla. In many ways, that's a huge, I guess, burden, but it's also a bit of a floor for this company at times too. But talk to us a little bit about some of these headlines that have come out. And are you surprised to see the stock down $3 today, given its move and given the nature of some of these headlines?
Yeah, it's a little surprising after the slide that we've seen in there. And if you look at some of the headlines, whether it's Kathy Wood at ARK Invest, piling into more Tesla on the slide that we had Friday, they're pretty transparent as far as positioning goes for their funds. But then you got Ron Barron, who's been a Tesla bull from the beginning, actually selling some of his shares because his position got too big, not because he wanted to. So that's a concern also. And then if you look at maybe the price cuts that they've seen over in China, maybe the competition that's coming down the road, whether it's from Volkswagen, Audi, Ford, GM, this is going to be a crowded market, and not everybody's sold on the electrification in the near term. I think longer term, you're going to see it, by 2024, 2025, where, maybe half the vehicles are sold are electric. But I think there's some growing pains right here for this stock. And, it's not only just the cars parts of it, it's the power grid. They just came out with a new a story today that said they're getting into the individual home power grid, right? Down in Texas, they just released some details that they're working on something there. After the big storms that we had their power grid was close to going, offline. And that was a concern. Now you've got Tesla working on that. So the new factory, gigafactory in Germany that's going to open up, possibly getting into India. So there's pluses and minuses. You have to look at the valuation, and you have to look at the stock as maybe you don't have all your core holdings in there, but if you want to be involved, there's ways to get involved, and it's better than it was about a month ago, guys.
Yeah, and Tom, kind of setting this up because I know you have an example trade to look at. There's not very many $500 billion companies that move as much as Tesla does. The stock has, as Kevin pointed out, sold off roughly 30% from its highs, yet it's still up nearly 600% from the beginning of last year. So it's extraordinary, the move we've seen. Obviously, there's a price split in there, a stock split in there as well. But the stock is, even with that split here, Tom, nearly $600 even at the current moment. It's not the most accessible name from a capital standpoint. It's expensive. It's hard to trade these shares if you don't have a sizable amount of money to contribute to it. So talk to us a little bit about how, maybe we can take advantage of some of these potential bullish cases going forward in a strategic way, in a more capital efficient way, and in a risk-defined way.
Yeah, this stock is a great example, and I think Kevin will agree, where you don't trade the stock. Because it's capital intensive and it can rip everywhere. The option market, this is a great example of using the option market to take a directional bias and know your downside risk at all times by, doing risk-defined strategies. I always say, don't be a hero on specific trades or specific positions. And this is one of those names I always look at, like, if I'm neutral to bullish on a name like Tesla, or if I'm neutral to bearish, I'm selling verticals in there because we've got implied volatility that's at elevated levels, it seems like, all the time. And you can get decent credits. But being able to sleep at night when you put a trade on is what I always go by in volatile names like this that maybe I want to trade. And the example that I looked at, guys, is, don't be a hero type of position, where if you're neutral to bullish on Tesla, an example might be selling it out of the money put vertical. And I've looked at the April 1st weekly series app, Alex, and selling the 530, 520 put vertical. It's $10 wide. And if I can collect over 250 on that, it defines my risk. If I collect 250, I've got 750 per spread at risk. But I'm giving myself that cushion with a higher probability of success because my puts that I sold are out of the money by about 60 bucks.
And so, Kev, it's trading about 270 here, $10 wide vertical. So let's call it a little bit over 1/4 the width of the strike. So not far off from our guidelines that we use of about 30 cents on the dollar. That would be close to $3, or about 1/3 the width of the strikes, which would be somewhere around 330. In this case, it's quite a bit out of the money, over $60 out of the money to the downside. It goes out a fairly short amount of time, going out to April 1st, so a little bit under 1 month. And this is your pretty standard, as you put it, kind of your fundamental building block trading strategy, the out of the money put credit vertical. And we're selling this here with a break even close to 527.30, depending on where we're filled. And anything above 530 at expiration, we just keep our credit and move on. So we're still looking for a stabilization or even a move higher in Tesla, but we're doing so in a way that if we're wrong slightly, we can still be profitable.
Yeah, it's ironic that we're talking about a spread about $65 out of the money, but it's a pretty aggressive put vertical. Let's face it, it's only a 65% chance of being of finishing out of the money at expiration, and that's what you get in a name like Tesla. So, big moves are there. So what Tom mentioned about controlling the risk is vitally important, and getting paid for your risk as well. So take this fundamental strategy of high probability, collecting theta, risk definition, and take your account and maybe move the strike up, maybe move the strike closer to at the money, maybe move the date closer to get that theta number a little higher, maybe move the date out so you get a bigger premium, all those choices and trade-offs are available in Tesla. And one great thing about Tesla, extremely liquid in terms of its option trading. Big numbers trade every day. So this is a textbook, little aggressive based on the overall move in Tesla so far, little on the aggressive side, even though, like I said, it's $65 out of the money. So yeah, this fits into all our criteria, guys.
Yeah, crazy to think that over 10% below the current trading price for 24 days is considered aggressive, but that just shows how important volatility is to the story. To your point, Kevin, about a 66.2% probability of finishing out of the money at expiration. And we always talk probability of touching as well. I think it's important to look at that one because in this case, 63%, Kevin, that tells me a little bit over half the time this is going to be tested a little bit. And so you have to know that going in. That needs to be part of your plan, and that's why we use risk-defined trading strategies. So if we do face a little bit of heat, we're comfortable in that situation. Tom White, it was a pleasure. What we're going to do here is we're going to work 3 of these, and we're going to work them at 270. The stock sold or rallied actually a little bit since we were talking. It's down to 250 midpoint. We're going to work it above the market in case Tesla takes a leg lower. We may have to adjust that. Actually, it looks like we are filled on the demo platform. So we'll take the 270 and we'll run and we'll see what happens here in the life of this trade. Look forward to talking to you again soon. Tom White, TD Ameritrade Network contributor. We're going to take our first of 2 short breaks here, Kevin. When we get back, we're going to talk some Stitch Fix. Jenny Horn's going to join us. The team from Likefolio is going to join us. Stick around. We'll be right back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do.
Visit your online broker today to learn more.
Welcome back to Fast Market. I'm Alex Coffey, joined by Kevin Hinks. Kev, check in on the markets here quickly. You have the S&P 500, largely where we left it, up 34 points. That is nearly 1% now, 0.9% to the upside. However, the NASDAQ 100 remains in red territory. It's down 0.5%. That is where we left it, about 26 points to the downside. The Russell and the Dow continue to lead 1.8% and 1.5% respectively for those 2 indices, with a little bit more of a cyclical bent to them. The Russell 2000 2232 up 40 points. Pretty incredible move here as the desire for these small caps continues versus its big tech peers. Kevin, any thoughts here on this trading action? as you have gold lower, the bonds lower, but it's pretty quiet.
Yeah, 10-year yield holding below 1.6 after spiking above it this morning. I think everyone's watching bonds and their relationship to stocks. I think how that plays out for the next few days and weeks is going to be the driver of this.
We absolutely need that treasury yield to go back down. It will help the stock prices, also help with mortgage rates. I understand it going up slightly over time. Should not go up that dramatically that fast, which is really what's affecting all of the stock prices here over the last couple of weeks. So GameStop up 26% right now. It's backed off to 175 from its peak of 196. Oh, and now it's dropping quite a bit. Let me check this out here real quick. Yeah, it's dropping pretty significantly here in the last couple of minutes. I'm not sure if there was some news. Let me check the news here. I don't see anything that really signifies any big change like that. So it's probably just correcting for some of the people that maybe owned it at 150, 175, just selling it off, maybe making a profit. I think that's what we're going to see a lot with GameStop, cost, AMC, all these on these days where it's high, is you're going to see it go up, and then you're going to see it hit a level like this right here, and then just sell, because people, they've been holding it for 2 months now at maybe 150. And then, so when it finally gets up there to where they're making a profit, they just want to sell and get out. So that's why you'll see that at some of the milestone numbers, like maybe 199 or 175, because that's maybe where they bought it, and then they put in a limit sell order at that number. So that's probably what we're seeing, because you're seeing it's hovering right at 175 now. So there's probably some sell orders in there, and then maybe a few more people buying back in, wanting to get back in. You can see the volume of the sales over here. Not any huge ones. There's ones for 100 shares, so not any massive volume sales going on with GameStop right now. It's really just a handful of smaller ones. It's really probably what's driving the market up like that. Naked Brands is also doing pretty well today, up 16.9% today. So not bad. It had a really, really bad drop the last few days. Let me see if I can make this a little bit larger. Sorry, just trying to get 5 charts on one screen at the same time. It was up 1.2, 1.3 hovering there a few weeks ago, and then it dropped down to 0.8 there last couple of days last week, and so now it's back up over 1. This is one of those where it was part of the Reddit group, but also it's just benefiting from some good business opportunities. So this one should probably still keep going up over time. It was a little down when it went back down to 0.8, 0.9. Cost is going up. They actually had a surprisingly profitable quarter when they reported a couple of weeks ago, but I really don't think that's a great long-term hold. I think AMC and GameStop have a decent opportunity long-term. I don't know if cost does. So you'll probably see the same thing that you're seeing with GameStop. You are seeing it today, where people are it's going to spike. They're going to hit a certain limit, sell off their shares, and you're going to see it fall back down. AMC, I think, has a decent opportunity to have a long-term strategy still for the next, I don't know, few years. But to really make money in AMC, you're going to have to hold it for a long time and hope that a lot of good things come that company's way as we get out of the pandemic. So you'll see I do have some sell orders in on some of these. I have some limit orders, just like I was talking about. So see that on my screen there. So we'll see.
And their sales, they're expecting to grow 13% to $512
Stitch Fix,
million.
yeah. So I'm actually
lose money. And they would have lost money
Stitch
last
Fix.
quarter. And if you look
I don't
at their history,
personally
they lose a lot
love
of
their
money
business
every
model.
quarter. So
And
the
I think that
question
to me, I personally would not buy
they've
from
got
them.
a
I'm not a
huge
customer of
expected
theirs.
move in this
But
name. So there's a
I
lot
like
going
their
on here.
stock. I like how
I
they're
really want to see
positioned.
what Likefolio has to say with some of their data,
I think it's
because
a good
I think
investment.
this
I
stock,
just
where it jumped up to
personally,
on
I'm not
that
a
earnings
customer.
beat, that positive earnings
Now,
report
could
last
they
quarter,
use
and
their
then
momentum
with all the shorts
to
and everything going on in there,
grow
I think
into
there's a lot going on
offering
in this name right now,
other
guys.
ways where people can purchase clothes and the technology that
I
goes
agree
along
with you, Kevin, and I'm looking
So,
forward to that as well.
and then, you know, they can
Jenny,
go
great
ahead and
setup here for
replace
us. As always, have a great
big,
rest of your day, and thanks for joining us. As we say goodbye to Jenny, I want to
some of the
welcome
big
in
clothing
Megan Brantley, the VP
retailers
of
all over
Research
the
at
world. But
Likefolio.com.
I think that's
And
a
so,
very
Megan, whenever you're
optimistic
talking
opportunity.
about a
I just
business,
don't know if
doesn't
it's going
have
to
to be
happen.
in the apparel space
So
or the
we will
software. It can
see.
be anything. If you're a
But
subscription-based
I still think
business, there's
Stitch
two
Fix is
really primary goals: get
okay
people to sign up
investment.
and keep those who have
I
signed
just
up.
don't know if
So
I'm going to be a customer.
I know you have some data on purchase intent, which will
That's
be
about it
one
for
of
now.
those kind of key
But that's what they're
drivers, which
talking
is
about.
people talking
I
about
think calling
signing
it
up
the
for this
Zoom
company.
of clothing is
Yeah,
interesting.
so
I think
whenever we
Zoom
look at Stitch Fix, this
has
is an
too much
interesting
of
one,
a
and it's going to be
ridiculously
fun to
good market
unpack
share.
because the
Zoom is going
chart
to
is a
be,
little bit
in my
counterintuitive
opinion,
to
a
how our earnings signal
fantastic
is setting up.
stock
So when we
for
listen
many
to those
years.
mentions of people
They're
signing up
going
for
to
Stitch
ride
Fix or
this
using the
for
service,
a long
we
time.
see
The
that
industry is
growth
going to
kind of
mature.
slowing down. I
There's going
think
to be a lot
Jenny
of
kind
other
of alluded to
players
this
get
in
into it.
terms of that revenue growth
I
just
don't think
slowing
it's
down
going
a
to
bit. But
what Zoom
one,
has
I guess,
created.
positive note that you'll see whenever you look
So
at this chart is that
I
we're
really feel
started
like
to see that seasonal uptick
I feel like
earlier
buy the
this
dip
year.
right now. I think
So
Zoom,
whenever we look
the stock, I think
comprehensively at people who are
300.
talking about updating their wardrobe or,
What is Zoom
buying new clothes, starting to say like,
Yeah,
I
325.
can't be
Yeah,
in
that's
yoga
cheap.
pants
That's
inside all the
so
time.
cheap.
Those
I mean,
mentions are up about
that's half of what it
26% year over
was
year in
here
2021. So
a
thus
few
far.
months ago when it
And
hit its
you can
peak.
kind of see this on
I
the green
cannot
chart. You
believe
can see this green
it
line,
sold off last
these
week
purchase intent
after
mentions, they
its
start
earnings
to tick
report.
off
It
right at the
spiked
beginning of the
after the
year.
earnings
Usually
report
we
from
don't
about
see this
400 to
happening
450,
until, heading into
and then
March.
the next
So
day it just
this is partially
crashed right back
informing a
down to
slightly bullish earnings
370.
signal
I
for
did
us on
not
Stitch
see that
Fix.
coming. I
But
thought,
as you can
but
see,
of course
this
that was
isn't
also
a
crashed on the
remarkable
tail
growth
end of
story
the
by any
correction,
means.
right?
So when you look at this isn't the
So
most
it
beautiful
didn't crash
growing.
just
You
for
like to
fun.
see this
It
chart
crashed
up and to the right,
it
and that's
crashed.
definitely not the case.
If
However, we are
everything was
seeing that
great
uptick
that
in
day
demand
after
a little bit
Stitch
earlier
Fix,
this year,
it probably
and so that may be a
go
positive side for
possibly
guidance
to
as
475.
consumers are
I don't
starting to
know.
update their wardrobe.
I think it's
Stitch Fix
I
is a
still think it's a
natural
great stock.
beneficiary of this shift.
If you're not in it, buy it at 325.
All right, Megan,
I
let's
would buy it
treat
at
this
325.
interview today, you and me talking, like
To
I'm
give you
Oprah
financial advice, it's like
and
what I would
you're
do. I would
the
buy it
royal
at
family.
325 if I
Okay,
was
let's
in
treat
it.
it like that.
And
Here's the question that I have for you,
I
Megan.
am in it at actually at
Are
398.
women,
It's my average price.
is
But
there
I've bought and
pent-up
sold them many
demand
times over the past
for
year. So
clothes
our
other than
long-term
yoga
gain
pants
on Zoom
that is about to take
very
off
big. I've made
in the
quite a bit
women's
of money on
sector
Zoom over
of
the
this
past year.
economy?
My
Is there,
current holdings is at
because
398.
they're talking about their existing customers are growing, their new clients
think
are growing.
that's a stock
Is
that
your
could
data
be
showing any people talking about, I need a
that's
whole
a
new bunch of
multi-hundred
clothes
billion dollar
if this
company,
economy
in my
and the
opinion.
business
And
world
now
is going to start
its
to
market cap,
reopen? Is that
market cap right
lingering
now
out
is
there?
95
Is
billion.
that a reason why
Or
this
trillion dollar
company is
company,
going to
they
continue
diversify
or
a
at
lot.
least
It could
keep
be, I
growing
suppose,
and doing well?
if they go to
Yeah, I
lots
think
of
that that's
different
probably one of the main
communication
tailwinds or one
tools,
of the
the way
main
they
reasons
roll
that
it
Stitch Fix could
just
be well positioned heading
so
into this
they
year is
have a
because
liquid
we
fund,
are
but they
starting
don't
to
do
see
a
that
whole
uptick.
lot more, right?
We talked about this a little bit, I think, with
Kind of what
American
Rick
Eagle last
Central has
week,
done,
that
Ring
people
Central,
are
I don't
starting to
think
buy
it's there.
jeans, that there's this new
And
fashion cycle that's
why
emerging. And so
since
people are
he
having
uses
kind of update, because last year there wasn't really an update, so closets have gotten kind of stale. So if you're Stitch Fix, you should be drooling over this, and that's definitely something that we'll be watching into this year. Another interesting thing that Stitch Fix has going for them is this personalization aspect. We're seeing, an increase in mentions of people who are talking about, wanting to buy things that are custom for them, and that's one thing that Stitch Fix prides itself on and kind of differentiates itself from other traditional, e-commerce platforms, is the fact that it has this really sophisticated team and algorithm that uses data and human stylists to help people find clothes for them. And so I think that this is partially why Stitch Fix's consumer happiness is so high. When we look at happiness levels for this company, they're 82% positive, and that's extremely high versus competitors. It's definitely higher than other competitors like Trunk Club that we see, or even Urban Outfitters version of this subscription service. So I think that is a positive check that Stitch Fix can see, but we're definitely want to watch to see that purchase intent tick up, because as you saw on that chart before, that wasn't extremely booming yet. Not to say that it couldn't. It is starting to uptick though into the new year, so that's definitely could be a positive sign for guidance.
And Megan, I think that's a crucial point you make regarding the consumer happiness here being over 80%. That's basically 4 out of 5 are satisfied with this experience. And when I think about a name like Stitch Fix and the business model, to be one of the greatest sources of marketing, I guess, potentially is just going to be word of mouth endorsement within social circles. If someone has a good experience, they're likely to tell their friends and maybe encourage them to sign up as well. And so that's a really important, part of the execution, I think, for Stitch Fix going forward, is to not only keep their consumers happy because then they'll stay on their service, but because they're going to tell their friends about it and maybe get them to sign up as well. But forgive me if you've mentioned it. Do you have any data about people talking about leaving this service, whether that's around the reopening, or it's too expensive, or they don't have a good time on the experience with Stitch Fix? Is there any data on cancellation mentions?
Yeah, we do. We listen for that. That is not a very large sample size for something like Stitch Fix. In fact, a lot of times the mentions that we're capturing are actually recommendations, just like you were talking about, that word of mouth. So, somebody saying, hey, I need new clothes, and another consumer jumping in and recommending the service as a styling service. So I think that is positive for Stitch Fix, that sample size is so low that, it's almost difficult to chart, for example. But I think that heading into this earnings, our signal is leaning about, it's a plus 18. So, we calculate these on a scale from positive 100 to negative 100. Anything in like plus or minus 10 is pretty neutral. So we are leaning, slightly bullish based on this uptick in demand that we're starting to see. But really, we want to see this continue into the new year. We'd expect to see this continue to grow if we really want to be bullish long term on a name like this.
Good stuff, Megan. Final question here. It's going to seem a little bit strange, but hear me out. When I think about subscription boxes and things like that, one kind of natural comparison, even though it may seem a little bit strange, is something like Blue Apron or HelloFresh, where you do something out of ease, but maybe because you're not very good in the space. So in that case, we talked about with your team from Likefolio about cooking, but then people learn how to cook. They can figure out how to buy the groceries at the store, and they kind of just learned everything they needed to learn from a Blue Apron or a HelloFresh, and then they move on from the service. To me, styling and finding where to buy different outfits may not be as easy as a skill, and maybe I'm crazy to say that, but is this a little bit more of a resilient customer base that's going to remain a little bit more loyal, because it's hard to recreate if you're not kind of used to doing this on your own already?
Yeah, actually, I think that's a really good analogy. It's one of those things where fashion is always changing. So if you're trying to stay in style, as soon as you learn what the style is, it's shifting into something else. And I think that fashion cycle, that is something that could be a really big tailwind for something like Stitch Fix, especially as they customize that algorithm and they get to know, your personal style, but also enable consumers to apply this to the big picture fashion scene. And so I think that that's partially why their happiness is so high. So that's going to be another really important metric to watch moving forward.
Good stuff, Megan. We'll leave it there. A little bit of optimism in the near term and some reasons to be maybe even more optimistic in the future. Megan Brantley, the VP of Research at Likefolio.com. Always a pleasure. Thanks for joining us. And Kev, here's the fun part now. We're going to talk some trading. Stocks down 2.3%. It's been all over the board to start the year here in 2021. I'll pull up the year-to-date performance, and you can see the stock's been on a closing basis too. So this is even taking into account the intraday swings, as low as 55.56 and as high as 106.41. And we're not even a quarter into the year yet, Kevin. So to me, that tells me that you got to be a little bit more nimble with this one and prepared for some swings.
Yeah, exactly. And that being said, Alex, the implied volatility tells you that, right? I mean, you and I do these every day. We do between 4 and 5 earnings plays or looks at every business day. And not very often that we get about a 17 or 18% expected move. That is massive for the price of this underlying, and that tells you that the volatility is in there. Now, there's two things that can happen. I've got two trades, Alex. Now, Likefolio's data was more or less pretty neutral, right? They said it was plus 18 on a scale of plus 100 to minus 100, pretty neutral. Now, so therefore, if you think that equates to neutral and you've got a 17, 18% expected move, the Iron Condor is priced expensively. So the 85.90 call spread, the 60.55 put spread is trading about $1.70, between $1.70 and $1.75. That's well above the $1.50 that you get. However, Alex, if you don't think it's range bound, you could just do the 1 week 60 put calendar as well. So either one of those, depending on if you're going to listen to Likefolio's data and think neutral, there's the Iron Condor that's fat in terms of its credit that you're taking in. Doesn't mean you're going to be profitable if it moves big. If you're bearish, if you're thinking about this, that they're going to swing from a profit to a loss, again, maybe the stock will work its way lower. The 60 calendar is trading under $1 right now, Alex.
So, Kevin, there's tons to unpack here. First off, you talked about the extraordinary range that's being priced in, plus or minus, upwards of almost 20% if you go out to the end of the week.
Right.
And when you're thinking about this, Kevin, the incredible thing is that means it's almost a 40% range in total, because it's 20% in either direction for this one. So just a massive amount of basically profitability window if we put this type of a trade on. In this case, though, it's right around 1/3 the width of the strikes at $1.75. If we were filled there, the 85.90, 60.60 or 60.55 Iron Condor here. But Kevin, what I like the most here in terms of how this lines up with what we just talked about with Megan, using kind of the information to structure a trade. Of course, whether or not you agree with that information is up for the individual investor to determine. But it's a neutral trade that is leaning slightly bullish. Look at that, +2 delta.
Yes.
And we're about $11 out of the money from the put side and a little bit closer to 14 on the call side. So this is doing basically that +18 on a scale of -100 to +100.
Exactly right, Alex. And so if you think that what the implied volatility is saying is, it's elevated and big, and that's as big of a percentage as you and I run into in these trades, you're still risk defying. You're not taking an inordinate amount of risk, but you're betting on that inside the short strike, at or near the short strike move on this name, and you're taking advantage of that, Alex.
And looking at the volatility levels here, Kevin, real quick before we dive into the risk and then send this off, you have volatility going out to June that's over 100%. And so while these options have 200% implied volatility, they're going to come in more than likely, but they're going to still be very, very elevated in terms of volatility after this announcement going into the end of the week. So there's probably still going to be some premium left in these options, even if you get that inside move with several days to expiration. So we'll come back to this one tomorrow. If we filled in $1.75, that leaves $3.25 in risk taking place if it moves above 90 at expiration or below 55. If it stays within our short strikes, we'll keep our credit and move on. At expiration, that's our max profitability at $1.75 or $175. Break even is $86.75 on the upside and $58.25 on the downside. Add and subtract from our short strikes. And Kevin, I'm going to work 3 of these at $1.75. It's slightly above the midpoint, and we are filled there at 179 there on the demo platform. But one of those that you probably want to work, a lot of strike selection, and maybe not the most liquid name. So work those orders and see where you can get filled. But we're going to take our final break of the program. We get back, we're going to talk one more earnings name here for you. We're going to talk some Dick's Sporting Goods. Stick around. We'll be right back.
futures to my trading strategy? 24/7 access to diverse global markets, like wheat. Can you say growth opportunity? We should probably harvest that.
If you have questions about retirement planning, then you don't want to miss Investor Education Day hosted by TD Ameritrade. It's a full day of free insights from TD Ameritrade education coaches and experts who can tell you all about honing your retirement strategies. And the best part, it's all online. So technically, you can enjoy the webcast from the comfort of your retirement pants, also known as sweatpants. Register for Investor Education Day at tdameritrade.com/education day.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on ThinkOrSwim for the income investing course and a whole lot more.
Good afternoon. A couple market updates, market moving stories this hour to keep your eye on. PayPal Holdings announced that it has agreed to acquire Curve to accelerate and expand its initiatives to support cryptocurrencies and digital assets. Curve is a leading provider of cloud-based infrastructure for digital asset security. Financial terms for the deal weren't disclosed, and PayPal said it expects to complete the buy in the first half of the year. The Vice President and General Manager of Blockchain, Crypto, and Digital Currencies at PayPal said, "The acquisition of Curve is part of our effort to invest in the talent and technology to realize our vision for a more inclusive financial system." Shares of PayPal have more than doubled over the past 12 months. A Jefferies analyst said he is increasingly positive on the digital ad industry amid the recent pullback in the group, noting that digital ad players should benefit from a further return of ad spending in 2021. He thinks Facebook looks attractive, trading at about a 40% discount to the NASDAQ, despite revenue growth that he sees accelerating to 26% in 2021 from 22% in 2020. He keeps a buy rating and a $350 price target on Facebook, which he continues to identify as his top mega cap pick. And an analyst at BofA said his monthly analysis of Steam gamers' GPU survey highlights a robust gaming environment with scope for further GPU upgrades. He said only 11% of NVIDIA gamers own a GPU with performance on par with the new consoles from Sony and Microsoft, and expects higher standards. The consoles from NVIDIA. The analyst reiterates buy ratings on both NVIDIA and AMD, given what he sees as the GPU upgrade tailwinds. AMD is up 78% and NVIDIA is up 98% over the past year. This has been your afternoon market update. Now back to Alex Coffey and Kevin Hinks in Fast Market.
Welcome back to Fast Market. I'm Alex Coffey. He's Kevin Hinks. Kev, let's do a quick market update and let's dive into some Dick's Sporting Goods here because the market has taken a bit of a leg lower. S&P's faded a bit, up about 0.5% now. The NASDAQ is down near 1%, 116 to the downside, 12,550. The Russell and the Dow fading as well. The Dow actually in front, so it shows that price-weighted nature of the Dow, the only 30 names making up the Dow Industrials, makes it a little bit more resilient to some of these swings if there's not an outsized move in one of those names. But let's talk some Dick's Sporting Goods here, Kevin. Want to make sure we have plenty of time. Stock is bouncing pretty sharply today, up 6.5%, $76.33. And it's had a pretty good start to the year, given that it's up 36% year to date.
Yeah, this appears to be a company firing on all cylinders, coming off a really strong quarter a quarter ago. It looks like their sales trends are all really positive. They're doing a great job selling athletic apparel. They've got, an omni-channel approach to business. You can go in the store, you can pick it up at the curb, you can buy online, pick it up in store. They've got a heavily influenced by Nike, big sections for Nike in each store. So they sell a lot of Nike products. This company seems to be doing extremely well. But that being said, the stock is, only $4 off its all-time high that it hit a few weeks ago. It's kind of softened into the earnings, but up strong, 6% today, Alex. So the expected move for today's earnings, healthy, $6.50 on a $76 stock. That's, approaching 10%. It's not there. It's probably, but in the 80s, right? So a good, strong move expected there. So how do we play it? Well, I think you play this because of the makeup of their options. The double calendar works here, Alex, and you can do both sides for under $1 total. The 83 call calendar, the 70 put calendar, Alex, and both of those together, added together, trading about 75 cents.
Running a little bit up to 182.
And building it out here for you, Kevin. Gotta love when there are so many strikes and you got to continue to open up more just to get to those levels. But it highlights the different kind of choices you have in strike selection, which is always a potential benefit, and also just how much volatility is in this name. Near a 10% move. And so, Kevin, looking at this double calendar, as you said, it's just under 70 cents. It's 66 cents here. Debit for the double calendar seems cheap, but is it cheap? Well, I guess it's where the market's valuing it right now. You still need the move to take place. And Kevin, we say it every time with these double calendars, we have our hierarchy of kind of potential outcomes. We prefer a move towards one of the strikes. So in this case, in this example, a move towards 70, our put calendar strike, or 83, our call calendar strike. So you can see, represented by our teal line here, there's still a potential profit zone on an unchanged move, as the volatility in these near-term options that we're selling, typically we would see that come in a lot more than we would see that 2-week option come in. And you can see that reflected also by these volatility levels. Kevin, the options that we're selling, so our strangle that we're selling, 100% volatility, the one that we're buying, mid-70s.
Those peaks in that profit graph are at the short strike, right? They're at $83 and $70, but those are also Friday's levels. Remember that. So one thing about a calendar spread, now you've got a nice level, about $30 in
can't deny the sales that have been taking place.
It's interesting listening to you as we show this clip over and over, and this idea that, the value is in owning something that other people can see, but that only there's a limited amount that people can physically own. It's such a paradoxical thing. And I'm wondering, in the sports world in particular, if the investments people are making on...
They're talking about NFTs over here on MSNBC or CNBC. It's NBA Top Shots. I understand, like, for authentication purposes, I think these NFTs have great opportunity for sports memorabilia and stuff. I think putting like autograph authenticity on blockchain using NFTs Yeah, that could be cool. I don't know about these types of things. Sports cards, yes. I think blockchain and sports cards are going to merge, and there's going to be a market opportunity. These NFTs related to like videos, I don't I don't quite see the long term in that. Maybe there is. I don't know. It to me it just seems odd because there's nothing too substantially amazing about it. Maybe I'm maybe I'm out of touch here. I love the idea that are coming from these NFTs. I don't I don't always understand each each one and what it is going to have as a long term effect, as a long term investment strategy. I don't know if I really agree with all of it. Again, I agree with it in the sense of having something that is an authentic creation from a certain creator or an authentic, like let's say there's you have a Pokemon card or a sports card or something like that, and you're authenticating that card on the blockchain, and there's only one that exists, then and it's a digital card. I sort of get that, and I think that's kind of what these videos are. But to me, they just don't have quite the same feeling as an actual physical sports card or physical product. And it just, but I do think that, so like I've got autographed memorabilia here. I do think that these autograph memorabilia companies can use the blockchain, use an NFT like thing to authenticate autographs on authenticate maybe like certain hologram um, properties on certain projects, like digitizing sports cards, and there's only one. I feel there's something there, and I'm just not seeing it though in a video of Giannis doing a layup. I just feel that's the same as a LeBron James rookie card that I have a collection of. So maybe I'm a little out of touch just for right now. And I mean, I could have said the same thing about Bitcoin, 5, 6 years ago. So, and that I'm seeing now. Maybe I'm wrong about it. Anyway, very, very interesting topic. Very, very interesting.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now. Welcome to Your First Trade. I'm Scott Connor, a 30-year veteran trader, and it is Monday, March 8th. Now, on our show, we'll be walking you through how developments in the marketplace can be translated into potential example trades. We've been looking at a lot of example trades based around earnings announcements, but as the earnings season is sort of trailing off here, we'll be looking at a couple names maybe with earnings, but others with maybe a little bit more longer-term perspective in mind. Well, let's take a quick look at what the four major indices are doing today. A little bit of a split, but mostly strength across the board. We have the S&P 500 up about 0.4%, and that's a gain of about 15 points. That puts the S&P at 3857. Now, the NASDAQ is the one of the four major indices that's down on the day. That's down about 1.2% or a loss of 153 points. That puts the NASDAQ at 12,514. Dow Jones up about the same amount, up 1.33%. That's a gain of 419 points. That puts the Dow Jones at 31,914. And the Russell showing some strength as well, up over 1%, 1.07, a gain of about 23 3.3 points, and that puts the Russell at 2215. Now, interestingly enough, we're seeing VIX to the upside. With 3 out of the 4 indices higher, we're seeing the fear index, or VIX, if you will, moving higher as well. It's right now up about 48 ticks, or about a 2% move, and it's holding at 2514. So not a big move in terms of percentage, but nonetheless to the upside. So a little bit of fear and uncertainty still lingering in the marketplace. All right, well, let's do this. Let's dig a little bit deeper into the sectors of the S&P 500 and see how those are faring relative to each other. To do that, I'll go to the Market Watch tab and quote sub-tab, and here we are looking at the 11 different sectors. And as you can see, most of them are up on the day. Let's start from the top, and where is the strength coming from? Well, materials up almost 2%, financials up 1.82%, industrials up 1.72%, utilities up 1.29%, and real estate up just over 1%. So some good strength out of those sectors. Let's drop to the bottom and see where we see some relative weakness. Energy's up, but not much, about 0.3%, but communication services down slightly, about 0.1%, or just under 0.1%. And finally, IT, information technology. And this is a sector that had been leading in the past, but has been lagging as of recent trading sessions. And it's down about 0.9% today. So really the only sector we're seeing with any weakness would be the IT section. All right, well, let's take that over to the Visualize sub-tab and take a look at the heat map and see if we can see some of that sector strength and weakness playing out here. And sure enough, your eyes do get attracted to IT, information technology, and you can see some of the big names there not doing that. Microsoft down only about 0.3%, but Apple definitely one of the stocks that's dragging down the IT sector. That's down almost 3% on the day. And as you can see, the chip sector, there's a lot of names there that are also showing some red. Communication services, a little bit of mix back and forth, but Alphabet down about 1%, and so is Facebook. Amazon also down, or actually just unchanged on the day. Tesla, a little bit of a drag down as well, down about 2%. But look to the right side of the map, and you can see financials, quite a bit of green there. We talked about industrials showing some strength, materials, real estate, utilities, lots of green in this area, and even healthcare has a lot of green in different pockets there. So really outside of the tech and the communication services, we are seeing quite a bit of green. So it's a pretty broad rally outside of those tech names. Now let's take a quick look at what happened overseas. International markets, Germany definitely showing some strength going into the close of their trading day before the U.S. markets opened up 2.6%. France up over 2% as well. The UK up 1.34%. But Hong Kong, we saw the reverse, down about 1.9%. And the Dow Jones Shanghai definitely showing weakness as well, down about 2.5%. So a big difference in the picture of markets kicking off the trading day globally, if you will, in Asia, and then turning into strength into Europe, going into the opening bell in the U.S. And for the most part, U.S. holding its gains. All right, well, let's quick look at the 4 major indices, what was happening globally, and how we're standing at this particular point among the sectors. Now, let's bring in your first trade contributor, Sean Cruz, see if we can dig into maybe some of the different factors that are impacting the markets today. Sean, welcome to your first trade, and good to have you here on this Monday. Kind of interesting, Sean, going into this opening today, obviously the news over the weekend was that we did get the Senate, Sean, of course, to pass the stimulus bill. It was completely partisan in the vote, but I'm not really sure that it surprised that many people. $1,400 stimulus checks coming to people, individuals $75,000 and lower, couples $150,000 or lower. But you'd think this would be some positive news, and I guess it is for some of the indices, but not all, Sean. What is your take here?
Yeah, I mean, I think it's really just more of what's been driving volatility over the past couple of weeks, and that is the industries that are kind of sensitive to rising interest rates, and especially just general volatility with interest rates are really getting hit the hardest here. But I think the industries, sectors, however you want to look at it, that are tied more to sort of that real economic activity are doing pretty well today. That is, the stimulus bill came out, that certainly helped. You also have the Fed just announced that they are going to be, and the Treasury announced they're going to be extending the Paycheck Protection Program to June 30th. So that's one thing that I think is also going to be pretty positive for businesses as well. I think you sort of put that together. It gives you a little bit of an explanation why the more economic sensitive equity names and indices are moving higher, and the indices that have really been taking the brunt of what we've been seeing out of interest rates lately are moving lower today. And I think it's interesting. And even if you're, a longer term investor, you could take a look at this and say, this is really why you like to have a well-balanced portfolio, and not just between, tech versus energy or banks, whatever that might be, but even, from large to mid cap to small cap, also thinking of that angle as well, because you've got the Russell up over 1%, and you got the NASDAQ down a little over 1%. It's almost on flip sides of that coin, but it's definitely interesting to see this playing out. And I think we're going to get a lot more news this week on the interest rate front, because one thing that's been driving these moving rates has been the shortage of 10-year treasuries. There's just not enough 10-year treasuries out there to meet all the demand, and we actually get more 10-year treasury coming into the market via auction this week. And I think that is, even if you aren't somebody who traditionally watches fixed income markets closely, by and large, a lot of traders, investors, portfolio managers, whoever it may be that I talk to, are actually really focused in on that 10-year to see if maybe that can help satisfy some of that demand, and at least maybe stabilize the 10-year rate, if not maybe move it lower just a little bit. So that's the big event for the week that a lot of people are watching right now.
Got it, Sean. Well, interest rates will continue to be on the forefront of everybody's radar, if you will. Sean, you were mentioning the 10-year yield and how that's affecting different sectors. I just went into ThinkOrSwim platform and went to the heat map and opened up the heat map for the Russell 2000, Sean. And I'm just looking at that financial section right now. And look at the sea of green that we are seeing in the financials. And again, we saw Russell up today. So that would explain why we're not, it's not seeing the big losses, if you will, or the negative strength coming from the IT. Now, there's a couple of red names there, but again, I don't see Apple. Of course, you don't have that, but that definitely is why we're seeing one of the reasons one of the big reasons we're seeing the Russell 2000 outperform the tech stocks today, or the NASDAQ, if you will. Well, Sean, let's turn our attention to economic data. You mentioned what we'll be watching the rest of the week, but we did have one number today, the wholesale inventories. Not sure this is a number we cover that often, Sean. It's basically the measure of the dollar value of sales made and inventories held by merchant wholesalers. Anything to take from this number today, Sean?
It came in largely as expected. It was up 1.3% month over month. That was more or less what a lot of economists were projecting, so nothing too surprising there. If you look into this report, though, it's kind of interesting to see where there's inventories building up. Durable goods, those are goods that are seen as, that's a washer or dryer versus a t-shirt, we're seeing as being up 1.2%. The biggest gain, though, was out of computer equipment, which was up 3.4%. So I think that's something interesting to note, is you're starting to see inventories building up a little bit. That might actually be a good sign, because as we start to get demand returning, and you're seeing more and more people maybe going out and buying different types of goods as the economy starts to reopen. I think it's good to see some of these businesses are starting to sort of stock up a little bit on inventories. And I think it's also worth noting in this report, there's this metric we look at, the inventory to sales ratio. And if that number is higher, that means there's a lot of inventory building up, but not a lot of sales. Last time we heard it, it was 1.29. It actually went to 1.24. So that sales component actually ticked up a little bit relative to inventories. And I think that might actually also be another reason why you're seeing a little bit more of a build, and you're starting to see them stock up. And that is, there's sales coming in to sort of draw down some of those inventories as well. And it'll be interesting to see if they can sort of continue to do that, because I think if you talk to almost anybody that family members, friends, whatever it might be, they'll tell you if they go out and order something, it might take months to get there. I ordered a new couch and it took 3 months for it to get delivered. So it certainly is a little bit of a bottleneck right now in the supply chain. And I think some businesses are trying to get ahead of the curve a little bit and start stocking up on inventory in anticipation of demand returning, in a robust manner here in the months to come.
Got it, Sean. Well, thanks for helping break down that data point. Now we will be getting a lot more numbers as the week goes on. CPI, PPI, those are some of the main things. And we'll get a good read on consumer sentiment on Friday to see how the consumer is feeling in terms of economic outlook. So that'll be interesting this week as well. Well, Sean, let's do this. Let's turn our attention to a couple stocks that you're following here today. Two names, I think, pretty household names. One's GE, and the other one being American Airlines. And these stocks, Sean, I was just looking at charts of both of them in the last couple of months. Each of them has had an over 100% gain. I'm just going back to like October, Sean. So what is it that that brought your attention to these two symbols, Sean?
Yeah, so a lot of these big industrial type names, one thing that there was a lot of concern over was their ability to service some of their debt loads. And GE, this is an issue that's plagued GE, before COVID, was even remotely on the radar or anything. This is something they've been dealing with over the past couple of years, is trying to pay down some of that debt, get a little bit more cash in the balance sheet. They've been selling off a lot of businesses to sort of raise capital and also kind of streamline and focus the organization into more of that industrial play. And they announced that they're going to be selling a chunk of their, or not selling a chunk of it, they're selling their aircraft leasing business to AerCap, and that's viewed as bringing in a good amount of money for them that's going to be used to service debt, pay back some loans that they have out there. And I think investors like seeing that. And you're certainly seeing not just the equity move higher, but even the bonds are improving today on the back of that news. American Airlines did something similar. They went out and are going to be issuing more debt, and it's going to be backed by their rewards program business, which is going to be used as collateral. They're going to use that to pay back some of the treasury loans that they took out. They're also going to be using that to service some debt and a few other business things. So once again, you're seeing, access to capital for these big industrial companies is certainly been a concern for investors. That's really hit a fever pitch over the past year, and see two big names like this go out there and they're able to, find deals, access capital markets, and bring in some more cash to service some of their debt loads is certainly a positive sign. And I think you're going to want to see that spread not just here in the industrials and transportation, but even some of those energy companies are starting to move in that direction too, of tightening up their debt profiles. So I think this is something that I would expect to play out with other these industrial or energy companies that carry high debt loads.
Well, got it, Sean. Well, we'll keep our eyes on these two stocks. Pretty impressive or significant moves since October for both of them. But again, I guess this is all part of the reason they're shoring up their balance sheets as in the ways that you just mentioned. Well, Sean, we're going to have to wrap it up there. Thanks again for helping us sort of put in perspective what happened today and what's happening in the markets, and any kind of news items that might be affecting markets. We look forward to seeing you again on your first trade, Sean. Thanks again. Now, coming up next, I'll be joined by John McNichol, and we're going to be looking at charts, not just from a standpoint of volume, but what else is important about breaking down charts? Well, we're going to be looking at combining volume with price movement to see how that translates into technical analysis. So stay with us. We'll be back in just 2 minutes.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access
short-form demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, ThinkOrSwim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to TDAmeritrade.com/webcasts and start learning today. Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Welcome back to your first trade. Now let's do another quick check on the four major indices. Right now, the S&P 500 up just over 0.5%, and that's a gain of about 20 points. NASDAQ still down on the day, down about 1.23%. That's a loss of about 152 points. Dow Jones, however, up 1.57%. That's a gain of 496 points. And finally, the Russell up 1.43%, also a strong gain of 31.5 points. VIX kind of holding right around the 2475 level, so only up slightly on the day. All right, well, now let's turn our attention to today's topic. And as I mentioned, we're talking about price, charting, and volume. Now, when learning to analyze charts, one quickly realizes the importance of price movement in the underlying stock, of course. But today, you'll learn how combining price movement with volume can help traders gain an even broader perspective. Now, you'll see how several ThinkOrSwim price and volume studies can be applied to stock and index charts as well. Now, joining me to help break down charting, price, and volume is your first trade contributor, John McNichol. John, welcome to your first trade on this Monday. And again, I always enjoy the segments when we do get to talk a little bit about charting and technical analysis. But I think for our viewers, before we even get into price, because we just talked about how important price is for charting, obviously. I mean, we have to look at the price movement of a stock. But I think maybe even back it up a step, John, and let's start with, what drives price? I imagine some of our viewers are wondering, all right, I see the price on charts, but, what is it that we need to know about how price is achieved? What drives it, John?
Sure. Well, it's great to be with you once again, Scott, on your first trade. And, when we talk about what drives price, ultimately it's going to be order flow, and specifically what order flow represents. So when markets are moving higher, we probably heard the comment about simply, hey, there's more buyers than sellers. But, what does that mean? What that refers to is when there's bullish sentiment is reflected in a greater flow or volume of buy orders. And in bear markets, or major downward moves, it's the reverse. But what's important is that we can measure the associated volumes of each and combine with that price information on the chart. So essentially, the two most important indicators on the chart, Scott, are price and volume. All the indicators that we'll be discussing are going to be derived from price, volume, or both.
Got it. And so by combining those two, I guess the technical analyst or chartist, whatever you want to call them, is looking for that flow or momentum that you're talking about, and they can get a deeper view by combining price and volume. Well, let's talk a little bit more about price and volume and combining the two, John.
Yeah, well, as we headline, volume levels and price movement have long been considered by technical analysts. And so by examining the trends, just like we can examine trends in price, we can also look for trends in volume in conjunction with these price movements. And investors attempt to determine the significance of a movement in a securities price.
Got it. All right. So again, it's kind of the significance, like you said, and the momentum. So by combining these two things, price and volume, what is it that chartists are looking to do? What's the benefit or the value of looking at these two, John?
Right. Well, the benefits of considering volumes on the chart, Scott, is comparing the volume levels with market direction. Kind of similar when we utilize any other indicator. Technical analysis attempt to identify the strength and momentum of that move. Now, typically, the higher the volume accompanying the price move, the greater degree of a momentum that is associated with that. seen as a crucial measure of confirmation on technical breakouts and price patterns. Now, these can tie into making time and price considerations.
Got it. All right. So basically, it boils down to the significance and momentum. Those are two key words I hear. And then the degree of both of those. And then once those are both in place, they can be used to sort of gauge, like you mentioned, the degree or confirmation of particular moves. And these are all important takeaways, I think, for anybody that's learning about charting and technical analysis. Because it's not just the volume of the price, but what does it mean? Yeah, exactly. Well, let's do this. John, let's show our viewers a couple of these studies that we were talking about.
Sure.
Price volume studies. And tell you what, as you go ahead and explain each one,
Yeah.
I'll go ahead and give a quick demo on how they can be found and displayed on the ThinkOrSwim chart itself. And I think one of the first ones we're looking at is something that ranks the price and volume. Right, John?
Sure, that's right, Scott. Yeah, we have quite a few price and volume studies on the platform. And so as we go through a couple of these, there's one called Price Volume Rank. This study is a technical indicator that's going to compare the close price and the volume with their previous values. If both the values are up, there's going to be a number 1 rank that's going to be assigned. If both are down, that rank is a 3. So you can kind of have a clear delineation there. When the price is up and the volume is down, the rank is 2. And rank 4 is assigned when the price falls and the volume rises. So kind of the first two would be examples of kind of confirmation. And the other two would be examples of what we call divergences. And we'll probably explore that more.
Got it. So I guess a way to think about that is you've got the direction of the stock up or down, right? And then if either of those directions is accompanied with more volume, it tends to mean more significant. So I guess the best thing would be to see a stock going up and good volume. The worst thing to see would be a stock going down and big volume, right? So I can see how they get the 1 to 4. So maybe a stock's going up but doesn't have great volume. Well, that's still good, but not as good as a stock going up with good volume. So that's that rank. Well, let's show everybody how they can find this, John. I'm going to jump into the ThinkOrSwim chart tab right now. I happen to have Apple in there. That's fine. And I'm going to go to the study and Beaker and click on that. And I'm just going to type in volume just to get this started. And what we're looking for now is price volume rank. And there it is. I'll highlight it right there. Okay, so I'm going to highlight that, John. Of course, as you remember, we always have to add whatever selected study we have. Click Add Selected. Then it shows up here in your studies and strategies. And then hit Apply and OK. And there we go, John. Now I'm going to widen this out just a little bit so we can just sort of blow up this price volume rank. And just like you mentioned, there's those 4 different levels. 1, 2, 3, 4, and you can see, when the stock has gone from a 1 to a 4, and then maybe to a 2 and a 3. And it does seem to be moving quite a bit, but sometimes it'll get to areas where like it's 4. So right now we're looking at Apple, which has kind of been on a downtrend. It's kind of interesting, John. I see a lot more of these 4 situations, which is not the good one. That's down with volume, as opposed to a 1, which is up with good volume. But we're not seeing a lot of those. So am I reading this right, John?
Yeah, no, absolutely, Scott. So, volume confirming price, on a downward move, that's pointing out towards that selling pressure. And then what some technicians may look for, as prices may move down to previous lows or a previous support, may look for a bit of a divergence. So actually we can see a little divergence right now. Now, how critical is the current price level where we're at? Does it line up with historical levels? Notice how there's a higher low on this indicator, implying that, there may be a change in that volume momentum.
Got it. All right. So far so good. This is this ranks the price and volume combined. Okay, so that's a good starting point. Now, what about the price and volume like trend? What if we just want to look at something that shows, well, what's this trend? Is it positive or negative, this combination of price and volume, John?
Yeah, so we have another volume and price indicator on the platform. It's called the price and volume trend. The study, kind of an acronym, PVT, considered to be a leading indicator for future price movements. There's a saying about how volume may precede price. And the main signal offered by the PVT indicator is a divergence in price. That's where technicians will look for. A divergence may imply a change in that price momentum.
Okay, John. Just want to make sure we didn't lose our viewers when you started talking about cumulative algebraic sums. But I think the takeaway there is, yes, this can kind of be used as sort of a, like you said, a forward-looking study. So let's go in and put that one in. I'm going to do the same thing. I'll leave Apple in there, and I'm going to go to the study beaker again. This time I'm going to go ahead and delete the other study we had in there. Okay, apply and okay. Oops, sorry. Let me go back to it. Now I'm going to go ahead and put price in again, just to start the search. Okay. And again, we're looking for price volume trend, and there it is. Nope, let's see, trend. There it is, right there, price and volume trend. So I'm highlighted it so you can see it, and we'll add that one, and then hit apply and OK. All right, so now we have, let me get rid of that other one, price volume rank. I'm going to go ahead and get rid of that one, so we can just look at the price volume trend. So we'll just look at one. Now I'm going to expand this one again like we did originally, and there you go. There's that 0 point, and you can see the price volume trend. It has been moving, I guess, to the upside for Apple, right? John, am I reading this right?
Yeah, that's correct. We can see that, comparing what the indicator is doing on the bottom, comparing to what price is doing on the top. And so, we can see during the much more bullish trend from the lows last year, rise in price, the indicator rising and confirming that. And then as we fast forward to more recently, we've seen fall in price, and we can see the indicator falling as well, confirming that. Now, unlike the last indicator we were looking at, notice this is still more of a confirmation. The indicator has continued to go lower following that price. Now, if this indicator was to start rising or making higher lows as that price was still falling, that would be a divergence, which may imply a potential reversal in price.
Yeah, I mean, you can really see this one, how most of the year as the stock was moving higher, because back in about January is when we started to see Apple take on some weakness. But yeah, absolutely, that first drop in price volume trend here was really starting to move lower as well. And right now they're kind of following each other. All right, well, listen, let's look. I think we have time for one more, and this one's a little bit different. And it's one of my favorites, and it shows volume a little bit different. Yeah, it's called. It's like a histogram. So let's go to that one, John, and we'll wrap up with this final study.
Sure. Absolutely, Scott. So this is called volume profile. It's a study that represents trading activity over a time period at specified price levels. That volume profile plots a histogram that's going to show price distribution over different price levels. And what a lot of technicians like about this indicator is, since it shows the volume at specified price levels, may look to kind of confirm areas of price support as well as price resistance. Now, that width of the histogram row is going to represent the number of actual transactions made within that price level. So when there's kind of more spikes in this volume profile, that's showing a bit of an inflection point at a particular price level. And this is what some traders refer to as a point of control.
Got it. All right, so let's do this. I'm going back into the chart again. I went to the beaker, and I'm going to bring up volume profile. All right, so there it is, volume profile. Click add selected. There it is. It's showing up now. And I'm going to hit apply and OK.
We are
Let's
seeing
take a look at it. And you're absolutely right, John. This is completely
GameStop making another run. It's up over 190.
When you're looking at Apple, and how this is,
so
of course,
I
the price movement.
do have a sell order in at 199.
In a histogram, but horizontally, like you said. And what's
And
interesting
my
about
plan
this
to
is you
buy
can see
back
for like
in
the whole
whenever it
last year,
dips back
you can
again.
see that the longest
So
histogram
interesting
is
to see
where
if it gets
obviously
up
the
to
most volume was at that
191.
price. So it's kind of an easy way to look back on the year and say, well, listen, there was a lot of volume right around this 114, 115
so you kind of see
level.
the entire
Matter of fact,
pattern.
that's that red bar you were talking
So
about.
this is where it's been.
And again, back earlier in the
30
year when the stock was
few days ago.
forward, you had a couple places where it found
So it's just
comfort,
been
where it was comfortable kind of sitting at these price levels.
and then
But
back
then
down.
not much volume at all until it got up to
We
the
using the technical term there, kind of, it's not quite like this cup handle type of thing. It's almost like a little hammer right here. So it spikes, sell off for those people, and then it's going to go back up. So, 199, 200 is a huge boost up to 197. Is a huge, mental barrier, I suppose. And so if it gets past 200, it could go up quite a bit. So one now, so man, I these shares I have might actually sell here at 191. So of course I want to be like everyone and play this full game and go up to 1,000, but I am over leveraged on my GameStop stock, and so I want to sell and then buy in again on the next dip. I don't foresee this going up over maybe 2 to 250 today. I don't expect it to go up to 1,000 today, but I think we're seeing a very good long and I think we might see later this week another decent dip down closer to 100 to 150, maybe close to 120. I don't think we'll see it crash back down to 40, and unless it spikes to 500. But I could see it going up to 100 to 200, dropping back down to around 100, and then making another run again. So I'm very, very interested to see if that's what happens. Move back down to 185. Peak at 190, so close to that sell order. But I've gotten into trouble chasing orders down, chasing orders up. So I keep my limit orders in, trying not to screw. AMC is also running up to 9.2, cost 18.7, all following basically the same pattern. AMC is a little more volatile than these other guys. Naked over here hasn't made a second. Nokia is doing okay today, but it's only up 1.2 today. So it's it's crazy low. Volatility is not good. I don't see this taking off. Look at GameStop up to back down to 194. I don't know. We'll keep an eye on it.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return.
Here it goes. 198.8, 197. Will this hit my sell order? My sell order on GameStop is actually at, it's at 198.99. Holy crap, I thought it was 199. So 198.99 is my sell order. This hit 198.8. Ah, Jesus. Watch it like completely crash down to $40 now. And I was that close to that sell order. Just like 198.42. Oh, did it do it? Did it hit it? It did. Boom. That sold 198.99. Sold my GameStop shares. I am kind of sad. So it hit 200, and it's just gonna like bounce off 200. I guarantee it's just gonna bounce off 200. 199.4. It's not gonna want to go over. Once it does, I think it'll go. I think it's a very, very good psychological limit. Man, I'm bittersweet and excited about that seller at 190.99. But like I said, if the next time there's a big dip on GameStop, I'm going to buy back in because I need to get in at a lower cost basis. That's the problem I have. It's too high of a cost basis, and sure, you can play the game of hoping it's going to go to $1,000, and after it's just not going to. I appreciate all of you guys that feel like it's going to, but it's just not. And when it does, it's literally going to crash back down to $100 within a couple of hours, if that were ever to happen. So, just trying to be optimistic and realistic and smart with that investing. GameStop, AMC, those kind of things. It's better riding the wave, getting in while you can, paper handing it would have been me selling when it went down to 40 or 50. I did not do that. So look at that Delta boat 203. It's running. It's running 204. Man, if it gets up, I can see it getting to 250 today. That would be fantastic. That would be an amazing day. I'd be a little bit regretful for not hanging on to those shares, but I'd be proud of people who stuck to that. And then, of course, it'll go back down more in mine. And when it does, I'll buy back in because I don't think we're done with GameStop.
Good to have you here on your first trade. And it's been a while since we looked at McDonald's. We've done a couple, I believe, example trades going back a while, but it has been a while. What are your takeaways for what the stock's doing in terms of chart action, Ben?
Sure. Well, Scott, McDonald's, as you mentioned, one of those widely looked at stocks and kind of the bellwether, if you will, for the fast food industry, but is also sensitive certainly to real estate and interest rates because one of their primary businesses is leasing land back to their franchise owners. But the stock itself has really been in this intermediate sideways trend with a little bit of a downtrend as far as resistance is concerned. So it's really kind of been squeezing, at least since this October high, back down into this descending triangle or descending
So
pennant since it's fairly
I'm going to
recent.
go over here to my charts here, and I'm going to replace Nokia because Nokia is just a dud right now. I'm going to replace it with Express.
That support level seems to be holding, at least
I can't
today. We
type
get
it.
a little bit of a bounce higher up off of
Express
that
because
low
I
down
have
over
a
the last
decent
4
hold
days.
on
But it
Express.
also seems to be
But I
squeezing
have
down
some
below the
that's telling me that
50
it's like,
period
what,
simple
it's
moving average, which is
7.49 again,
relatively
just
flat,
like
sitting
GameStop,
right about the
way over
$211
on
level.
Express. So
If price breaks lower,
I
though,
do,
than
I own it, or
203,
then I have a buy over
we
here
might
at
see it back
225,
down
but it goes
into
back
that
down.
190,
Sell it
191
at
level,
7.29, so you can
which
see
not
where the
only is the
spread
pattern
is on
target
my
that the
Express
descending triangle would suggest,
hold
but it's
here.
also a
I
level
mean,
of support
Express,
we
I
saw
think
them
of
back in the April,
main
May
stocks that I
timeframe
still
for
am
this
in the
stock.
game with,
If it
I'm probably
bounces
the
and
least
continues to move
confident
higher,
in
I
my
think you've got to
Express.
watch
I've also
for
probably
the
lost the
price to
most
break
on
up
my
above
Express.
the 211
GameStop, I'm not
range,
doing
that
much.
50 period simple moving
Cost,
average,
I'm
and
actually in
then
free money when it
above
comes
the
to cost.
213 diagonal downtrend
I'm
line. And
paying
here
off
you can see the 2-year daily
my
chart
gains,
will
and
really suggest that
so
this
both
203
these
level
could go
has
down to
been
zero, but
tested
I wouldn't
all
lose
the way
money.
back into June of
Of course,
2019.
feel the same way about
That was a
GameStop.
little bit of a
Remember that.
support level back then as well. And it's been support and resistance along the way. So we can see that that level seems to be an area where the price tends to find
So
a bit of a support.
Express,
The RSI is
it's
moving a
up
little bit
today,
higher, kind of double
17%.
bottom
Of course, it's
in
riding the same
this
wave as
kind
GameStop
of
and AMC
mid-range
and Cross
area,
are.
if you will.
And
Both
naked
suggesting
back
a lot
up
of
over one,
bullishness, but at the
17%
same time,
today. So a
not
good
really
day for
breaking
all the
down
meme
to new
stocks.
lower lows. So
But of course, that's following
watching
it.
203
Not the
level
greatest
as a
week,
solid
with the
level of
exception of
support here. And
GameStop
if it
had a good
breaks,
week last
we've
week.
got another level of support down around that 191. Scott?
So I need a run on Express, but we're going to get way cheaper so I can buy back in.
Break that down. It's
Those are
interesting.
my
You probably
spaces.
heard I was talking with John McNichol about we had the volume profile study up, and I was just looking at it on my chart, and boy, there is a big histogram right around that 210 level, 210, 211. It's like you said, the stock has been here for a while, so kind of interesting application of what we were talking about before. All right, Ben. Well, thanks, and we'll look forward to you helping us break down the charts for our example trades throughout the week. Thanks again, Ben. See you tomorrow. Now, let's turn our attention back to the ThinkOrSwim platform. And as I mentioned, I'm just looking at one last time at my chart that I had up with the volume profile. And you can really see where that volume histogram has really kind of corresponded where the stock has been for, oh my gosh, if you go all the way back to September, it's kind of been in that range Ben was talking about. So let's do this. Let's assume that a trader maybe is thinking this stock may be continue or will continue to stay in some sort of range or channel that it's been in for maybe the next 3 or 4 weeks. What would be a strategy that would align with that outlook? Well, maybe something like the iron condor, going above and selling a call spread, going below and selling a put spread. So let's go to the trade tab right now, and I'm looking at the expiration dates. Here's one, 32 days to go. So we'll open up the options that expire on the 9th of April. Remember, we always start with time and price on example trades, and time will be a month, about 32 days. Perfect. Price? Well, again, that will align this strategy with someone who thinks that, or a trader who thinks the stock might stay within a range. Now, what is that expected range going to be? Now, remember, on the ThinkOrSwim platform, you can always go to the right, move your mouse over here to where you have implied volatility, and it will actually give you a dollar value of that expected move with current implied volatilities and levels. And right now it's about $11, $11.50, somewhere in that range, up or down. Doesn't say which way, it just says that's the potential range and on that calculated number. All right, so just putting that in mind, let's take a look at where the stock is trading now. Like we said, about 209, something that's been hanging around the 210 level here. So 209, 210, which would be right about here and here. So that's the 210 level. Now, let's go up, if you will, about those 11 points, and that would take us where? Up to about the 222 level. I'm just looking somewhere around here, so I'll highlight that. So that's one possible area on the upside. And now let's go to the downside, a similar level, and that would take us down below the 200, maybe the 197, somewhere around this level. That would be a possibility. 197, and again, that is about 12 points to the downside, right? So it's kind of about equidistant from where the stock is above and below. Well, let's construct the iron condor. And how do we do that? Well, let's start off by selling a call spread. So we start off selling the 222.5 call. There it is, selling one of the 222.5 calls. Now we'll hold down our control key and buy the 225. So you can see that is a vertical spread. That's the call spread. And it looks like we're getting about 30 cents. I'm just going to round it for that call spread, 222, 225 call spread. Now, to add on to that, we'll just keep holding down our control key and move to the puts. So let's hold down the control key and we'll sell the 197 put. Okay, there we go. And while I'm still holding down the control key, I'm going to buy the 195 put. So in a sense, what we did is created a short call spread, 222.5, 225. And then down below, the 197.5, 195. And let me unlock that. Looks like it's giving us a credit of about 50 cents. Now, what's the most this can be worth? Well, they're $2.50 wide call spread and put spread. So the most the maximum value of any of these spreads could be is $2.50 minus the 50 cents. So that would be a maximum loss of $2. And the maximum gain, of course, would be here at around the 50-cent level, as you can see right here. So let's do this. I'm going to click on confirm and send. Oh, sorry, I double-clicked on that one. We already sent it out, but let's go to the working orders and actually let's take a look. Oh, we actually filled. We have a fill already on our McDonald's because I went to the activity and positions. You can see under filled orders, and it looks like we got a better credit for that, obviously, 59 cents. But again, you can see they have the order. It has gotten filled, so that's great. What we'll do is let that order sit in the position statement. And we'll keep our eyes on McDonald's over the next few weeks to see if it doesn't stay, again, above 197.5 and below 222.5. Pretty wide range, but again, that's still got 4 weeks to go. All right, we'll watch this trade as it goes forward. Obviously, the ultimate outcome for this one would to have the stock finish in between those goalposts, if you will, of 222.5 or 197.5. And that way the call spread and the put spread expire worthless, and the total gain is then realized. That right now it's a 59 cents, so that would be a $59 gain minus, of course, any transaction costs. All right, well, we'll leave it right there and continue to watch this example trade as we go. Now, coming up next, I'm joined by Your First Trade contributor, Mike Follett. And we're going to talk about something that's very important here on Your First Trade, the risk profile. Anytime we look at a strategy, we look at the risk profiles associated with it. And maybe we could even look at the one we just did on McDonald's. But we're going to break down the risk profile essentials with Mike Follett. Stay with us. We'll be right back.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity.
At 210,
Blockchain making transactions safer and faster.
look at all of these buy orders, I mean, there's quite a few sell orders. You have so many more green buys at 210, 210, 1, 14, 15, at all of this. So some of the sell orders are large, some of the buy orders are small. So many buy orders at 210. So that's interesting. I mean, I want to say that's optimistic for, and it's all at the same minute, right? So very interesting phenomenon. This 11:41:36. So many right at 210, and exactly at 210. All of these exactly at 210. It really makes you wonder if there was a some institutional trigger limit over there. And could that be a situation where we had some hedge fund call options? I really don't know. I mean, I'm not an expert at that, obviously, but that's what it means. One share all the way down to 11:41:36. 2 shares, 5 shares. And here's more. I mean, really, really crazy. And some sell orders like the one that you a bunch of those. Absolutely crazy. Anyway, just look, here's more. 1 minute in. Just absolutely crazy. Anyway, it's weird. I mean, I've been watching it all morning and I haven't seen anything that's that distinct at all these. 210, right on the dot. So 210 is a massive number. Right now, it's back down to 203. So, wow, just very, very interesting. So let's go back up here to the top. We can see the new ones coming in. You see, not nearly as much anymore. It's, very up and down. The numbers are changing greatly. But man, 210. Something was going on at 210. That's crazy. Pretty awesome. Crazy. I hadn't ever seen that before at a trigger like that. So I mean, obviously, tons and tons of limit orders were put in the 210 limit buy orders. But so many of them were such small quantity that it's just look at all these. There's some that are big. You see right here, you see a few, but so many others are just a small handful of shares. Like look at all these. Most of them are 1, 2, 4 shares, 10 shares. Not a crazy number. Right there, all within 1 minute of each other. So anyway, let's go back to live. Just something worth noting. Might be interesting if we get back down to 200. Something triggered like that. Very interesting, but you see a lot all those. I mean, is that some sort of manipulation happening? Getting it up to 210, just floating up to 210, and then you saw some larger sell orders in there. They must have missed. So could someone be doing that? It's smaller numbers to get it to 210 to just dump it up front. I don't know, because now you're seeing it go back. So it is interesting to see little things like that happen. We're back down to 199. So is it going to do just something like this where it goes back down, just floats back up in the afternoon? Or basically done for the rest of the afternoon? I don't know. But it'll be very interesting to see. I see Express running. Express is now up to 306. So that's awesome. 24% today. AMC is running a little bit, but not crazy. Cost is doing really well. It's over 20 again. If cost gets up over 30, then I might sell what I have still left in costs. And I'm in the free money range for costs, so I'm not worried about where it goes. I think just the next big spike, I might sell at least part of it. I have some limit sell orders in here. What at 49, 50, 69. I might split those down. I have 14 shares left, so kind of crazy, but 14 sold shares. I'm not sure if that's all of them.
Yeah, I like what you said, Mike. That word snapshot.
So anyway, hopefully you guys are enjoying just watching the market go on my TD Ameritrade account, and also seeing what limit orders I have put in on all of these, and hoping we can get to them. Hoping we can make them.
Their risk reward, like you mentioned. So I assume this is one of the major benefits or value that's added for traders who use this tool, right, Mike?
Sure, Scott. A better understanding of risk reward parameters associated with any options trade is essential. And now, on your first trade, we've learned how the Greeks measure different factors that impact an options price. And we'll actually use that plus build on that by learning to use the risk profile tools. A trader can play out different scenarios to see how profit and loss can change with the stock price movement, time in the future, and also implied volatility changes. So it's very valuable, Scott.
All right, well, let's dig into this, Mike. I'm going to follow along with you as you break down how our viewers can take a trade into the Analyze tab, and then we'll break it down from there.
Okay, so let's start by creating an option order on the Trade tab. Once we have that order created, we'll just go ahead and right-click on the trade, then select Analyze, and that'll take it over to the Risk Profile Analyze tab. Perfect. Now, once we're here, we'll actually use the price slices. So let's click that and open those up. And usually the default slices will be displayed, but if they're not, resetting those slices can be a good habit to get into. And that will actually show the 3 main default slices. Now, from here, traders can customize offset percentages of those slices, and they can even add or delete slices as they see fit. Now, any changes in the price slices will be reflected on the risk profile graph itself, Scott.
Okay. All right, so I followed your advice there, and I think that's really important. Whenever you open this up, it's just a good habit. Come over to the right, like you mentioned, and click on this, and then reset those slices so they're at their default setting. All right. So again, we have our trade here. I'm going to bring this down just a little bit so we can see. Now, by default, you're right, 10% up, the current stock price, and then 10% lower. Now, those are reflected when you look up here on the chart itself, and you can see that these slices of 10% higher and lower, which you can change, are reflected here. Here's the current price, here's the 10% higher, and here's the 10% lower. So it kind of gives you a nice graphic depiction of what happens if the stock does make a 10% move between now and expiration. And you can see, remember, the blue line shows your profits and losses on expiration. So we're looking at options that expire a few weeks out. But if the stock stays right where it is now, well, then we're at our maximum loss of $2.88 times 100. That's $2.88. But if it moves higher, 10% higher, look at that gain. Just like you mentioned, Mike, look at this blue number. That's your P&L number when you start moving things around on the chart. And I'll come up to here, and you can see that's about a $576 gain should it get up there. So what about changing these parameters? You just talked about that using the risk profile, Mike.
Absolutely. There are a lot of things that can be changed. And one thing to note is if you look at those price slices associated there, you can see that plus 10%, minus 10%, all the way to the right, you can see the profit and loss numbers on the day if the stock were to move to those levels. And also the Greeks are associated there as well. So the slices can certainly add some depth. And to continue with this long call example, we can see how that risk profile, that profit and loss will vary with those changes in that underlying stock price. And absolutely, you can see it right there with the slices. Now, the stock price can also be changed if somebody is interested in doing this by clicking and dragging on the price on the profile itself. And what you could do is just move that across the board and see the reflected changes in the profit and loss open there. So that's a very useful tool. In addition, Scott, a gear icon is available in the lower right-hand corner there. And if the individual clicks that, that will allow them to manually update changes in the stock price as well. And note this, that if a trader ever wants to go back to the default slice settings, they could just click the lockbox icon right next to the slice itself, and that will actually send things back to the default. But back to those other variables that are associated with the gear icon, you can see that the trader has the ability now to trade or to change the date and volatility levels to see how that might impact profit and loss as well. Scott?
Wow, so there's a lot of things we can look at here, Mike. But I like that idea of clicking and dragging the slices to see what would happen. I dragged it up to 124, and I could see by looking at the middle one, that would be a daily P&L of $300 to the upside if we got that kind of move. So, Mike, we're going to have to wrap it up here. This is a great tool, something we use all the time. I would highly recommend for our viewers to go into the paper money and play with this, create an example trade and learn to use this. We'll be focusing a lot of time on this. Well, Mike, thanks again. Look forward to you joining us again on Your First Trade. That's going to do it for us today. We look forward to seeing you tomorrow at noon Eastern Time to review our McDonald's trade and look for other example trades. Thanks again. We look forward to seeing you then.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our Active Trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
24/7 access to diverse global markets. Right here.
That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready.
Well played.
What do you look for when you trade?
I want free access to research.
Yep, TD Ameritrade's got that.
Free access to every platform.
Yeah, that too.
I don't want any trade minimums.
Yeah, I totally agree. They don't have any of those.
I want to know what I'm paying up front.
Yes, absolutely.
Do you just say yes to everything?
Well, I say no to kale. Yeah, they say if you blanch it, it's better, but that seems like a lot of work.
Now offering 0 commissions on online trades. We charge you less, so you have more to invest.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Good afternoon. Welcome to the Watch List. I'm Nicole Petalides. It's 1 p.m. Eastern Time, coming to you live from New York City. Thanks for being with us. Let's take a look at the markets. A mixed market at that. 3 hours left in the trading session. The Dow Jones Industrial Average up 1.8%, gaining 580 points, though the NASDAQ Composite is down 1%. The S&P 500 gaining 0.8%. Our top story, the Dow Jones Industrial Average hits a record high after the U.S. Senate approved the $1.9 trillion COVID-19 stimulus package over the weekend. The House is expected to pass the bill before President Biden signs it. For more on the stimulus bill and how it's impacting these markets today, Tom White is with us, TD Ameritrade Network contributor, joining us live. Well, watching the Dow hits a record. Tech stocks, though, a completely different story, dragging on the NASDAQ. What's your takeaway?
Yeah, I think, Nicole, that theme is continuing to play out, that rotation into cyclicals. We've got materials, financials, all up over 2% today. Real estate's doing well. Utilities are still doing well. We've got that 10-year at 1.6%, and that's still putting fear into those investors as far as the tech names go. But I think the pivot point was this morning, those comments out of David Tepper from Appaloosa, who said, this rising interest rate environment is probably going to peter out here. There's going to be demand for treasuries coming online soon, and he says he likes some names that have been beaten up. You look at names like Apple, down 18% from its recent highs. He likes Apple or Amazon also, but all the FANG names are down today except for Amazon. So it's it's that same theme, Nicole, that we've seen play out here over the last month or so, where the Dow names, some of the blue chips, some of those cyclicals are doing really well. And the fear of these rising rates and the pace at which they're rising is really starting to put some consternation into what investors are feeling. Are these tech stocks overpriced on a valuation basis as those interest rates rise? And I think you're seeing that play out right here. And I think the market's probably due for some consolidation, not only in yields, but also in that fall and in the NASDAQ.
Right, yeah. And, tell me about the reopening trade. So we're seeing some pressure there to some of the, the semis and tech, and I saw Apple is down 3%. And so NASDAQ's really out of favor, but the reopening trade, tell me about that as the vaccine rolls out, and airlines are looking good today, right?
Yeah, airlines are all up. Most of the major airlines are up over 3%, some as much as 4 to 6% today, based on that reopening trade, that demand that people want to travel again. TSA numbers, I think 3 out of the last 6 days were over 1 million passengers passing through TSA. And, that's probably on the back of the fact that we're getting the vaccine rolling out at a quicker pace, but also there's spring break going on. People are actually traveling right now as schools are on break, and people are getting more comfortable. You knew this trade would eventually start to come to fruition as the vaccine rolled out. It's pretty surprising that, if you look at it on a valuation basis, they're probably getting a little bit ahead of themselves. But with the backing of the government and that anticipation that more people are going to travel, and one of the first things they're going to do, Nicole, is travel for pleasure, right?
Interesting here. Look at GameStop. GameStop
CDC
down
just
to
came out with a mandate that said, hey, if you're
similar
with
to
a
what
group
I
of people
predicted.
that have all been vaccinated and you're indoors, you don't need your mask, right? So
I
it's
thought it
starting to
could
play
get
out,
up to 250
and these
today.
reopening trades
I
are
think that
really
particular range is going to get to 250.
outperforming, and you're seeing it not only
We
in
will
that
see
particular
how
space, you're
it
seeing it in the Dow
goes. It's
transports,
187.
you're
It's
seeing
kind of
it
stalled
in some of
right
the
now.
hotel names that have been beaten down. So
I could
I
see it
think this
kind
theme
of
is going to
dipping here at
continue
the
for
end
a
and
while
going back
as
one more
people
time
start
this
to
afternoon.
ramp up their travel.
I think it's got maybe one more
Yeah,
run
it's
at this
amazing.
afternoon.
The
That's
Sunday
and
checkpoint, to your point, on the
unless you see
TSA
something
numbers, the
magical where
highest since early
30
January.
minutes before the
So
bell,
people
it
are
just
rushing
spikes
to get
up.
out and travel and hug
People
their
trying to
loved
get
ones or
ready
get on that trip
over
they've been
something.
waiting for,
You
to
can
your
see a
point.
lot of these now.
And,
Once we're getting into the back at
this
the
is great.
80s,
The vaccine numbers
some of
are
these
looking good. Tom
buy
White,
orders are
thank
much
you.
larger.
TD Ameritrade Network contributor.
So
Thanks.
again,
Nicole
I just
Webb is
those numbers
standing
are so
by,
weird.
Senior
They're
Vice President, Financial
at
Advisor,
210.
Wealth Enhancement Group.
So
Nicole,
many
thanks
loan
for being
orders and
on.
such
So
small
what's your
ones is
economic
really bizarre
outlook
to look
here?
at.
Are you worried, or are you feeling really
Because now we're
optimistic?
seeing what I believe is normal.
I would say that we're feeling pretty
20, 30,
optimistic
50,
overall. It's
those
hard not to
500
feel optimistic
shares per order
when you
from
watch
money.
the money
It's kind of
supply
all
continue
different
to
numbers,
increase. And,
not right on the
I
dollar.
would say that the market reacted appropriately. It concerns
So that
about
was
those
strange.
recent builds
But I
seem
think
to
what we're
have
seeing, it looks like it
all
might be
too terribly
leveling
much
to go
to
back
do
up
with
189.
COVID-related activity.
Now
But
we'll see.
at
It
the
might go
same
back up
time, I would
towards
say
200.
Wall
I
Street
mean,
should fundamentally
you
believe
can,
that a lot of the spend inside of
I
this most
sold
recent stimulus package
those
was
shares for
necessary.
198. I could buy
It
back
was
in right now at
infrastructure spending that was
187
long
and
overdue. And so,
essentially save
I
myself
do
a bunch
think
of money.
that
So
the
that's
outlook for
why
the
I
rest of
sold
the
all that
year,
I
both
did.
coupling
I
with
wanted to
the
sell at the
return
low
to
to two
normal, the
threshold just in
vaccination
case.
numbers looking good,
I
listening
didn't
to
get over
Tom
that.
talk about
So
the
then
reopening trades.
I will again keep an eye on it. If
When you
if
couple
it
all of
crashes
that
back up
together, I
in the
think that
next day or two,
2021
I'll
has a
buy
lot of
back in because I
tailwinds
think there
left
is
in it.
a movement
And that kind of this
still. I don't think
recent,
GameStop
some of
has
this recent
completely
activity
seen
due to
the end
interest
of
rates
this
probably just
wherever it may
needs to
go.
be looked at in
But
isolation and not be made bigger
we
than
are
it is.
also seeing a good run.
Are you worried
Express
about different parts of the reopening trade? For
and still
example,
301. AMC is
we're seeing
a little bit off
airlines
of its
doing
high.
really well,
So is
right?
cost.
Today
So is
after those
Naked Web.
TSA
All
numbers
of them are still
hit some
looking pretty good
records
for the
this
day.
weekend. So that was some good news.
22%,
But it's not
13%,
everything that's going to do
27%,
well. It's my
15%.
understanding you've been
GameStop
focusing on
off
some of the
15%.
retailers, which you
So
don't think
a
will
pretty
do
good
as
day all
well.
around
Is
for
that
consumer
right?
stocks.
Yeah, there's certain retailers that I think, look, if we look at Gap last week, for instance, talking about and really giving guidance to investors
Let's go
that
back
they're
to
going to be opening multiple Old Navy stores and
here.
multiple Athleta
Bring that
stores in the
myself.
coming year. We haven't really had much guidance for the last few quarters. And so I do think that there's going to be some retail that does well on the reopening trades. But more specifically, when we look at reopening, it's going to be more about consumer experiences and then probably the materials that go into the restocking of all of the inventory that, thanks to kind of the shutdowns over the last few months, inventory sell-off really happened, and we're going to need to ramp that back up. And I think it's also really important to remember that we're going to see above average growth rates as confirmation that this was not a financial crisis, this was a healthcare crisis. And so again, we're going to see that just play out in the numbers of things as people realize, again, once we are allowed back out, as more and more people become vaccinated, there's going to be some stability again in guidance and growth.
And your thoughts on other areas such as technology, right? I mean, today we're seeing tech getting hit again. You mentioned growth. Valuations have been somewhat of a near-term concern for some folks. Especially for some of the names that have really run up. Today, I mean, it's worth noting the Dow Jones Industrial Average, the Dow Jones Transportation Average, both hit new highs today, but we're not seeing participation in tech. Your thoughts on some of the growth plays? Is it opportunity or would you stay away?
Yeah, I have a couple of things to say there. First, when we talk about interest rates, I think it's important to look at, we operate in a global interest rate environment. So we don't believe at our firm that, Japan and Germany are going to stay at 0% rates, and this trajectory in the U.S. is going to continue, and suddenly we're going to be at 6%. That just doesn't work in the balance of a global environment. So when we look in isolation at technology, for instance, this is not 1999, 2000. It's not that tech environment. So we do have to be mindful of these valuations in a more normal interest rate environment. So I think it's going to be momentarily painful. It's odd to me to see investors love Apple at 145 and not love it even more at 117 today. It's actually the number one holding in Berkshire Hathaway. So, investors like Warren Buffett really see it as a sticky ecosystem with a lot of growth potential left. And for those reasons, we still love some of these big names in technology looking forward.
What about financials as well? As you talk about what's going on internationally, I know that's something you're following so closely. And financials has been a big story, especially with the rising rate environment. And in fact, the regionals hit new highs today as a group. Your thoughts? Do you like this group?
Yeah, I do actually. I think the big bank financials, they really saw their comeback, if you will, about what was that now? Maybe a month, 6 weeks ago, when they were allowed their stock buybacks. Yes. But we're still really focused on kind of what we're going to see in terms of deposit activity on these smaller regional banks. And so really that small cap value sector, I think, still has potential for not having fully recovered on this rotation back into the post-COVID environment. So we've seen that play out in a lot of the broadening of the S&P 500 performance, but that broadening and that value transition still has some room left in the smaller company space. So still optimistic there as well.
And what's the final takeaway here? I mean, you said you are feeling more optimistic. Is there anything that you think is a major headwind, or is it mostly tailwinds at this point?
Yeah, I do think that the one tailwind that we still have to talk about, or the headwind we still have to talk about, is there still is a bit of a dislocation between what we're experiencing on Wall Street and what's happening on Main Street. There's a third of the population that is still struggling with underemployment or unemployment. There's a reason that stimulus checks are being cut in bigger and bigger denominations and going out into the hands of the American people. And it's because there is this large population of people who, are not in the same place that they were 18 months ago. And until we see that gap narrowing between those who are able to seamlessly transition from work from home, education from home, and companies, the American companies, global companies who have navigated this environment so well, but yet when we look to other areas, that just isn't the case across the board. And so we do need to see, employment numbers come back, and we need to feel like everyone is being spoken for before we can feel truly confident that there's going to be growth expectations. I think so much of what we're doing right now is a return to normal expectation, but we need to be able to grow from there, and that's the next layer.
Sure. Nicole, great conversation as always. Thank you so much for joining us today. Nicole Webb, Senior Vice President, Financial Advisor, Wealth Enhancement Group. Thanks, Nicole. Coming up next, JJ Keenan is standing by to join us as the February Investor Movement Index data has been released. What are people buying and selling? Well, in fact, we will discuss the catalyst driving the investors to sell some of the vaccine stocks. Later this hour, CEO of 3D Systems joins me right here on the show to discuss the company's latest earnings and its outlook for 2021. And we will preview Dick's Sporting Goods earnings. Those are out tomorrow morning before the market opens. And our panel, a big look at the big box retailers, the names you know and why they may struggle to meet high expectations for 2021. Stay with us right here on the watch list.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, ThinkOrSwim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
What do you look for when you trade?
I want free access to research.
Yep, TD Ameritrade's got that.
Free access to every platform.
Yeah, that too.
I want to know what I'm paying up front.
Yes, absolutely.
Now offering 0 commissions on online trades.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Yeah, I get it.
Welcome back, friends, to the watch list on this Monday. Let's take a look at the biggest movers in the market right now. The latest stimulus bill has retail and apparel stocks trading higher overall. Let's check it out. Hanesbrands jumping to a new 52-week high. The stock is now up more than 16% for this month of March and more than 40% for this year, 2021. During its latest earnings report in February, the apparel company highlighted its global champion brand, that business seeing ongoing momentum in the current period. Peloton is off its session highs after MKM Partners upgraded the stock to buy from neutral and maintaining its $130 price target. The analyst says Peloton's 34% decline from February 4th highs creates really an attractive buying opportunity, and that supply chain investments are driving some positive results. You see it at 104, so 130 gives it upside potential. Ross Stores trading higher after the company announced it plans to add approximately 60 new locations in 2021. Recently opened 4 Ross Dress for Less and 3D discount stores across 5 states in February, March. And here's a look at Disney, leading the Dow Jones Industrial Average higher to new highs. In fact, California officials cleared theme parks and stadiums to open at reduced capacity starting April 1st. Disneyland will be able to open at 15% capacity. The parks have been closed since last March, and the stock is up nearly 10% for this year. And a quick check on Bitcoin, as we do every single day. Let's see, we're 51,240, gaining about 3.5% at this moment as we speak. Well, it's here. TD Ameritrade's February Investor Movement Index is out. We always like to give you this proprietary data. We bring the pro in for that, and that's JJ Kinahan, Chief Market Strategist, Managing Director at TD Ameritrade, to discuss this data more closely. It's great to see you, JJ, on this Monday. So the IMX reading, what was the takeaway? What's the big news from February?
Well, first of all, thanks for having me, Nicole, and happy International Women's Day. I love the purple, and as somebody who's been a mentor to many young women, thank you for all you do on that front, and to all the women at TD Ameritrade. But with all that said, and with all that said, you know, talking about the IMX itself, really interesting takeaway, Nicole, and here's what it is. The buy the dip mentality and the bullishness of 2021 stays intact. And when you and I talked about the January reading, we said people came out ready to buy things to start 2021. We're seeing in February even more. We saw a month where you had the S&P 500 up about 2.5%. Yet we see the IMX up 9.26%. And again, as a reminder to viewers, what does this measure? This measures the trades that TD Ameritrade investors and traders are making. Every stock, every option, fixed income, mutual funds, etc. And what it's showing is that the clients were willing to take more exposure to the market overall. So it's pretty telling. Our clients were net buyers of things. They were net buyers of equities. And so we think about some of the equities they were net buyers of. A couple of them I'm not surprised about. What do I mean by that? Apple, Tesla. This buy the dip mentality, if we see a little bit of a sell-off, those FANG stocks and Tesla are stocks that our clients are naturally drawn to. They seem to want to buy those when these types of issues happen. Few other names, though, that were really interesting to me, Nicole. Number one, 3M. Haven't seen a name like that in forever. Qualcomm is a name we haven't seen in a long time, and Palantir. So, you know, those are three really interesting names on there also. Our clients are willing to take exposure, and again, it's one of those things where the buy the dip mentality is one that's worked for people for a while, and they continue to come into that trade. At some point it won't, and I know there are people sitting at home right now saying, oh my God, it will run out. I agree 100%, but for the last 5 years or so, it's worked pretty well, and I think people are going to go with the play till it stops working.
I think you're absolutely right, and that's exactly what we saw. We saw it with the market, and people would step in. Every time we sold off, they would call it a buying opportunity, and you know, this past few weeks, it'll be interesting to see the data and the readings, what folks did in the next one, because this wasn't as quick for the buy the dip of late, right? So tell me what they were selling. I saw that they were selling some of the vaccine stocks, which certainly brought a lot of optimism to the market, bringing the vaccine, able to get folks vaccinated, but at the same time, maybe people said, hey, I think I got my money's worth. I'm going to get out a little bit.
I think you hit it right on the head, Nicole. You know, you see Pfizer, Novavax, Moderna leading the way on this list. And so many people will say, why would you be selling those stocks with all this great news? I think there's a couple of reasons. As you said, people played for it. They you know, the stocks had some good moves to the upside. People may have gotten out. But there's one more important thing you have to think about. The stock market is a forward-looking entity. Because it's a forward-looking entity, you have these stocks that have put, and thank God they put so much of the company's energy into getting this vaccine. Well, what does that look like now 6 months out? What about their other products? Some are still doing well, don't get me wrong, as we've seen in the latest earnings. But now you have to kind of reboot in terms of where you're putting your energies, etc. I think there's a little bit of a transition factor that people are saying may take a little bit longer. And again, they've done us all a great service by putting all their energy into this. So we'll just have to see what happens going forward. And I think that's, you know, talking to a lot of people, I think that's a little bit of the fear going forward. Then the other stock you see in there, Zoom Video, which I find really interesting. You know, their earnings came out in February. Stock did very well on that one. But I think there's a little bit of this fear of, okay, have they sort of, you know, reached a peak overall? I don't think people are going to stop using Zoom Video, but the run has been absolutely amazing. And when we get back to work, and, you know, a lot of this is also forward-looking in terms of saying, okay, with the vaccines, we may have a chance where people are going back to work. What will still be the usage of Zoom Video? I personally, I think that we will still have a use for it because I don't know that going back to work is going to look like it used to. There will still be people at home, etc. So Zoom video has an opportunity there, but just the run up, as you know, you talked about Peloton there right before I came on. A day where it's recommended, it's down a little bit. These stay-at-home stocks have had such an amazing run up that I think the reality of keeping up with that may not meet the anticipation, and you're starting to see that tug of war come through right now.
Yeah, and you know, some people just say, I want to take my profits. And even if they do believe, like you do, that people will continue to use Zoom, I know there's competitors like Microsoft Teams and others that are in the same business, but people have become very accustomed, and some of these habits are not going to die off so fast, right? If you got a Peloton, you still love it. I also think, you know, I think the buy the dips mentality is an interesting one with Ron Barron, for example. He sold off some of the Tesla for his clients. I'm using rough numbers. He had about 6 million shares. He sold off about 2 million shares for his clients because he said, look, you know, I got these under $100 at $600. Let me get rid of some. But he's still holding it. And that's the point. I mean, even like a name like Apple, you know, Buffett loves Apple. And so maybe some people will buy the dips and others may sell it off like a day like today. So what's the final takeaway? Because I noticed in the IMX data, people bought technology, they bought healthcare, right? Some healthcare, I think, was in there. And though I know that they sold those other VAX stocks, but it does say tech, healthcare, and consumer discretionary. They were net buyers. So what's the takeaway?
Absolutely.
What's the best sectors?
The first one being, if you're going, what you said about Ron Barrett is the bulls and bears make money and pigs get slaughtered. So, you know, taking some profit off the table is usually not a bad idea. At some point, you can keep the core position on, so to speak. And you know, you're seeing what I find really interesting, Nicole. The one area I expected to see our clients be more net buyers of was actually energy. They weren't. I found that interesting, but yet they were in healthcare. So we'll see. If you look at what's happening in the jobs reports overall, healthcare usually being a stalwart of the industry. So I think the fact that it's been a little flatter also doesn't tell me we're losing healthcare jobs, doesn't tell me that it's a bad place to be. I just think that, you know, because we have different states being in different states of being open, unopened, so to speak, that as more offices and more things start to happen, you'll see perhaps a flood of jobs start to come back there and us get back to where we were, you know, even during the first part, so to speak, of the pandemic. So that's not what I'm as nervous about. And so I think it's interesting that people have just gone away. I think smart investing. I'm going away from just the vaccinations, which is just the headline right now. There are a lot of other areas of healthcare and still a lot of other, you know, diseases, et cetera, that have to be cured that firms are doing a wonderful job on. So I just think that that's thinking like a smart investor. That's thinking more like professionals think. And I love to see when our clients do that.
Yeah, and we had a great day at one of the those educational days where TD Ameritrade investors get to meet us all in person, and there's a whole day of education. Yeah. And there was a woman who came to you and said she made a ton of money on Tesla, and you said, well, why don't you take some off the table? And that was some great advice there. And, you know, keep some in, and that's how you do it. It's always great to see you, JJ. Thank you so much. JJ Keenan.
Thanks for having me, Nicole.
Thank you. Yeah, great to see you. Coming up next, the CEO of 3D Systems joins us here on the show to discuss its latest earnings and outlook for 2021. Don't forget, tune in 5 p.m. Eastern Time, Market Overtime. We'll focus on what you need to know for your long-term portfolio, Market Overtime, airing weekdays at 5 p.m. right here on the TD Ameritrade Network.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, ThinkOrSwim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today. Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade network.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on ThinkOrSwim for the full Options for Volatility course and a whole lot more.
Welcome back to the Watch List. I'm Nicole Petalides. 3D Systems released its fourth quarter and full year 2020 results last week. I'm joined now by Jeff Graves, President CEO of 3D Systems. Jeff, when you talk about the results, were you pleased? And tell us more about the outlook, because everybody always wants to know that.
Thanks, Nicole. It's great to be with you this afternoon. Yes, I was quite pleased. We did a lot of heavy lifting in 2020, not only with regard to 20, but in really restructuring the company and getting it heavily focused in additive manufacturing, which is our core of core businesses and what we've been into from the beginning. And we worked our way through COVID and came through that nicely and saw a really nice uplift in Q4. So that we're divided into two business units, healthcare and industrial. Healthcare was fantastic. We were up over 45% in both on a year-over-year basis and quarter-over-quarter basis. And that helped lift the entire company to growth year over year. Our industrial business was up mid-teens. We were also pleased about that. And most importantly for the future, we planted a lot of great seeds for growth in the future. We've been going through a restructuring activity to make sure we were profitable and generating strong cash flow that we could support the investments that are so exciting in this industry to make right now.
It's amazing how you're in all these different areas. And when we talk about the medical part of it, where do you see the most growth? You mentioned industrial, medical. I mean, you're making 3D parts, basically, right, for everyday life.
Absolutely, Nicole. And I got to say, of everything we're doing right now, healthcare is absolutely amazing. You know, the whole industry is evolving. There's much more availability of digital information to assist in surgeries and medical devices that are implanted in your body, and even when changes are needed in bone structures and things from tumors and other trauma and breakage. Additive manufacturing plays a key role in this and being able to deliver better patient outcomes very quickly and very customized for each patient. So you improve the probability of success for the patient, the risk of infections reduced, and you play a key role in generating that value so you can actually turn it into a very good quality business. So we do a range of things for medical, from dentistry to customized dental straighteners and things to help with teeth and other implants, to medical devices and surgical simulations. It's all fantastic. It's evolving very quickly. And the key element, Nicole, is that it's all customized to the individual patient to improve their outcomes and probability of success. So we love that. Industrial, obviously, it's matured to the point now where we're able to print real parts for real operating systems in very demanding applications like aerospace and defense and other high-end automotive applications, electric vehicles that are really exciting in their own right. And we're leveraging basically the same fundamental technologies to do both.
It's amazing how, I mean, this is a stock we followed a long time, and I think 3D everything has been a hot topic, but your stock is up in 6 months, 350%. And I know you've been doing some restructuring to curb costs, and I mean, why does the stock move like that? I mean, I know you don't comment on stock price, but what do you think the euphoria was, And what are people most excited about for the company going forward?
Nicole, I would tell you we delivered two things that were really important to the market. And number one, we had spread ourselves very thin for several years, looking at a lot of digital manufacturing technologies. We became very focused, and when I joined in May of 20, we became very focused around additive manufacturing. And the two objectives, and this is really what drove the market value to where it was, is number one, can you restructure the business to really be profitable and generate good operating cash flow so you can afford the reinvestments to make in the business for growth? We demonstrated that in spades in Q4, and there's a lot more to come in the future. And then secondly, can you do that restructuring while delivering growth? Because a lot of the restructuring was around, reducing SG&A costs, driving efficiencies, and quite frankly, Nicole, it's very easy. Anybody can come in and reduce headcount, but to do so in a manner that preserves growth, that's what people were looking for. And we had an excellent Q4, both consecutive quarters and year over year, beyond the effect of COVID, frankly. And I think that's really what folks were looking for to get excited about our company, but also as a bellwether on the industry.
I thought it was interesting that even the analysts are on board with what you're saying as well. Loop Capital, for example, upgraded the stock from a sell to a hold now, and a new price target of $31 a share. So certainly some upside potential there when it's sitting around less than $24. So that's exciting. And how do you differentiate yourself from your competitors? Because obviously you mentioned so many different areas, right? Even electric vehicles is something that could be in the future. So how will you say 3D is it, not the other guys?
So to be a leader in this industry, Nicole, and I think there'll be a lot of winners in this industry, but to be a leader in it, I think there's a couple things you have to have. Number one, you have to have both metals capability and plastics capability, because our customers, both in healthcare and industrial, they want the availability of both solutions from a supplier. They want you to come in as a knowledgeable 3D printing company, if you will, and help them demonstrate applications and define the workflows and deliver that solution so they can implement it in their manufacturing processes. So you have to be somewhat agnostic to the materials of construction and how you're printing. You also have to have all the basic capabilities, printing, software, and materials. At the end of the day, it's the materials element, and it's one of our particular strengths that customers really feel the most, because that's what their components are made from. It's not just the geometry, it's the material of construction. That's the value proposition for people. And I think the breadth of our technology, we've been in this business from the beginning. Our Chief Technology Officer, Chuck Hull, invented the business and the industry. And we've got the broadest range of technology offerings to date. Our magic is bringing them together specifically in certain applications that will drive value.
Yeah. I'm out of time, but are you worried about rising rates, or do you think the economy is improving? What's your overall feeling at this point?
Oh, certainly the economy is improving, and the faster it opens, the better. Healthcare, you already see a resurgence. Industrial investment, I think the amount of liquidity in the world today, the projections for CapEx spending, very good for our industry and our company and specifically. So I'm excited. We're paced by COVID opening, but the current projections for the vaccine rollout are very encouraging. And our customers have found, very creative ways to work through this period. And I think by the time we get to the second half of the year, you're going to see some really exciting things happening in the economy.
All right, Jeff, great to chat with you. Come back soon and give us some updates as well. Jeff Graves, President, CEO, 3D Systems. Thanks for joining us on the show. Thanks. Still ahead in the second half of our show, we'll preview Dick's Sporting Goods. The company will report its earnings. They're expected to be released tomorrow morning before the opening bell. Let's head to break. Here are some winners and losers in the S&P 500.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets, before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Welcome back to the Watch List. I'm Nicole Petalides, coming to you live from New York City. Today is International Women's Day, where we recognize and celebrate all the amazing women and girls around the world. That's why I'm wearing my purple. So happy to do so today. Congratulations to all the amazing women. And just 2.5 hours left in today's trading session, so let's check it out. Mixed bag. The Dow Jones Industrial Average new highs. The Dow Transports, by the way, new highs as well. Here's a look at the Dow. The Dow is up 611 points, gaining 1.9%. The NASDAQ, though, is down 1 full percentage point, and the S&P 500 up more than 0.75%. We're watching Dick's Sporting Goods. It reports earnings tomorrow morning before the opening bell. Stephanie Lewicki's been combing through the numbers for us to take a look at this one, contributor for the TD Ameritrade Network. So what's up looking at the Dick's numbers?
Well, Dick's is having a good day so far today, Nicole, up almost 7%, really with the broader market and on the news of the Senate passing of the $1.9 trillion stimulus bill. But if we look at the earnings, so they have recovered from that year ago, that pandemic low. They have come out pretty strong with the pickup in sporting goods, home exercising equipment, outdoor fitness, really driving the company's earnings from the lockdowns and really driving earnings and revenue sharper. Since then, they're likely to register top and bottom line growth on the EPS, $2.21. That would be up 67% year over year. On the revenue, $3.02 billion. That would be up 15.8% year over year. In the last reported quarter, the company beat the Zacks estimate by 113%, and it delivered an earnings upside surprise, 34.7% on average in the last trailing 4 quarters. It is Dick's Sporting Goods is expected to have witnessed positive sales trend in this quarter, a solid product portfolio, and strength in the online platform. Now, healthy demand and improved omni-channel capabilities, including curbside pickup services, are also likely to have helped that online performance. Also, they have a newly launched omni-channel services like mobile checkout and return stations, shop, click, pay app at a few locations. That's something new they just added. They just added same-day delivery service using Instacart to about 150 stores, so that could strengthen the comparable sales growth. And in the last reported earnings call, the company
what they were saying
noted that
about
the
the
strong comps momentum continued into
airline
the
stocks and
fiscal
the
fourth
reopening
quarter,
stocks.
and consolidated
Good day for
comps
those
grew in
things.
the
Another
high teens
rough
in the
day
first
for
3 weeks of the fourth quarter.
tech stocks, but
However, I think like a number of other retailers, the company predicted adverse impact from
you know,
weather to
today I
partly
think the
hurt
big
their
movement is
results.
the
Also, the
these
company
stocks,
continues to
GameStop,
witness
AMC,
COVID-related
Express
expenses.
cost,
That's been
the
weighing
meme
on the
stocks,
bottom
Reddit
line.
stocks,
In
whatever you want to call it. I
the
haven't
third
looked at the
quarter, the
market
company
yesterday.
incurred
Let's see what
$48
profits
million
look like. I
of
put
extra
CCIV over here.
compensation and
I think
safety
CCIV has
expenses
just kind of been a
associated with the
little bit of a dud
COVID-19
over the past
crisis.
couple of
And
weeks,
also the
ever
bottom
since the
line included
merger
$124 million of
quoted,
COVID-related
or the
compensation.
merger was confirmed with Lucid. I put in a sell over here, or buy over here at $20. So if it gets down there again, I'll buy 4 more shares. The other one that's having fun lately is Rocket. Do I have it? Rocket. Ooh, it's RKT, right? There it is. It's a spike this morning. It's been going down ever since. It's 25 right now. Rocket's a tough one. I got in on the day it spiked last week and made a few bucks, not much. I got in at 30-ish and sold 39, I think, something like that. So made a few bucks within a matter of an hour or so. But I think it's a good long-term buy. I was surprised to see how shorted it was, but I don't think it's worth what it is now. I think it's down to 17, 18 again, 19 maybe, below 20, let's say. I'll probably buy back in. But even at its price right now, I think it's a little overinflated, just because of the surge of the Redditors and whoever else was investing in Rocket, getting it spiking last week.
Few weeks, we've seen a lot of volatility. For example, today the Dow hits new highs, but the NASDAQ's down.
Well, Nicole, first of all, International Women's Day. I love that you're honoring it, and it's great to be on. In terms of now, I'll go right to the market. NASDAQ, totally still overextended. Don't try to catch a falling knife here. I do think that Apple recover. Apple's a great play right now to do some options in. Anyone who wants to play, it's 117. It could bounce back to 119. It's be really, really great short term. But over the long term, there's a clear rotation that's taken place. And even if we have some variant that occurs with COVID-19, there's just such a sense of, right, the market hates insecurity. There's a sense that we can handle it. We know what we need to do. And that's why the rotation has gone into the financials, engineering and infrastructure, of course, because, we have a Biden White House. There are so many companies that you want to be in. I've always talked about Ingredion, that's the old corn products. One of the first Dow, it was a part of the first Dow companies. And that's everything. That's your sugars, your starches. And Ingredion had a real hiccup here because of their food service business. And then there was no food service needed at the stadiums. But Ingredion is in almost every product that we use. And has a dividend yield. Companies like that will keep going up. There are companies like Big Lots, BIG. It was a $10 stock last March, and now we're near $70, but it could still go to $100 because we're going to see that race, right? Because we have so many people who are trading and investing. We could see these companies that were value trapped, so to speak, really keep catching a bid and could have 20 or 30% more upside.
I see. So I know that you have different sectors and stocks you liked. You mentioned Apple. I know Microsoft was something you're watching. That's pulling back a little bit today with the rest of the FANG group for the most part. Also, Bristol Myers, SNY, some of the utilities. What do you think is a best bet?
Well, on my Bristol Myers BMY, Bristol Myers has been dead in the water pretty much. I mean, okay, sure, it's tripled in 20 years, but that's nothing in comparison to what everything else has done. Certainly, Bristol Myers, with their pipeline, could go from the $60 range to $100 within the next 6 months. This is going to be their time. We also still like Sanofi, excellent in terms of vaccines. They're going to be, front and center in the global vaccination market. They're already in it with everything from tuberculosis to malaria. We also, I think that Microsoft will come back, even though it's part of the big tech. But Microsoft is so popular now, doing so well, especially with their gaming business. And they really have only retraced because of this 65,000 people. There was the data breach. And that's really spooked so many because Microsoft shouldn't have had any kind of data breach, but it's still a company that could certainly go a lot higher from here. But we also think that some of the restaurant chains, that consolidation that's taken place. Yes, Ruby Tuesdays is gone, and it's so sad for me to see that. But, we're going to see companies like Texas Roadhouse, which has tripled since last March. Texas Roadhouse, the right price point in indoor casual dining, line dancing by the waitresses and waiters, butchers.
Right, a lot of fun.
So that's where you want to be. Those kind of companies that are post-pandemic and that have been out of style for the last 2 years.
I also wanted to pick your brain on the electric vehicle space because it seems so many companies are trying to get in. I'm not sure that they're all going to survive. Tesla's certainly been a leader. Do you have a favorite in the EV space?
There's a reason why Ford and GM keep moving upwards and they keep going higher. At the same time, yes, I love those players like the Fiskars, FSR, Microvision. You can grab here. It's down 50% in the last 10 trading days. These are all the companies that have this LiDAR technology, which is like holographic, so to speak, or you've heard of heads-up display. That's really very much the future with electric vehicles. And as long as oil is $70 a barrel, it's like this relationship. It's just so obvious. You know, green tech, clean energy is hot the minute oil goes to $70 a barrel. So I am also happy to see like an ExxonMobil, XOM, but that's because so many people have lost money or have missed opportunities being in it, that I'm glad it's hitting 52-week highs. But I think it's going to be the traditional players, you know, the GM, Ford, that are going to really be the winners in the end in this space because they have the distribution. Ultimately, I'm very, you know, Tesla has, you know, they've first mover advantage, but there's no way they would have to sell more cars in a year than are sold globally in order to justify their valuation. That doesn't mean it's not a great trading.
So that's why you mentioned some of the others. Sure.
Right.
And finally, obviously, you mentioned it right at the top, International Women's Day. So I'd like to say congratulations to you, Hillary. Clearly a leader, successful in your own right in the world of finance and everything else you do. And so I think it'd be very appropriate for you to maybe give a thought to women or girls who may want to be starting their careers. And it could be for any young person too, right? Advice?
My advice, find a mentor. Find a mentor, and a mentor is someone that you can help and help them advance, and then they can help you. It's that symbiotic relationship. You're nowhere without it. And the world has gone, the world seems to have advanced so much in terms of CFOs and CEOs, but at the same time, I know that women are struggling and that women take care of the house, the home, and they're out there trying to earn a living, and it's all stacked against them. And I am like here to support everyone all the time. But, you know, remember, at the same time, we have a long way to go. It's really exciting. We have days like this, and we will ultimately make it. And that there are those bright spots. 20 years ago, a billionaire, 25 years ago, a billionaire gave me a chance, a Latin American billionaire, to manage $5 billion. He said, I know you can do it. And we're going to see more and more of that take place because women can be better investors. I'll argue that any day of the week because we can multitask and because we take consensus. We don't just decide that, you know, Tesla's going to keep going up or that Amazon is never going to go up. I know someone who's been shorting Tesla for the last 10 years and almost brought one of the greatest hedge fund managers in the world down because he was too smart. He was so smart. No, we know what we're doing. Right, Nicole?
All right. Well, I certainly would like to promote women in this moment. And I think that, you know, I think you make a great point about having a mentor, and that's good advice for everyone. And have some reciprocity, right? You help them, they'll help you learn as well. Hillary, thanks so much. Hillary Kramer, founder, Chief Investment Officer, Kramer Capital Research. Thanks. Still ahead, we'll bring in our panel to discuss some of the big box retailers, catalysts driving the weakness in stocks such as Walmart and Target. Next on the watch list.
I added futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it.
If you have questions about retirement planning, then you don't want to miss Investor Education Day hosted by TD Ameritrade. It's a full day of free insights from TD Ameritrade education coaches and experts who can tell you all about honing your retirement strategies. And the best part, it's all online. So technically, you can enjoy the webcast from the comfort of your retirement pants, also known as sweatpants. Register for Investor Education Day at tdameritrade.com/education day.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Evelyn Baker here with a few stocks in the move this hour. Harley-Davidson is up nearly 5%. The motorcycle company will begin selling used motorcycles next month in an effort to produce new revenue streams for dealers and attract a younger demographic. The program, called HD Certified, will position used vehicles in good condition as a substitute for low-margin, entry-level models by Harley-Davidson. This comes after the company's U.S. sales fell by 15% year-over-year last quarter to levels not seen in decades. United Microelectronics, ticker symbol UMC, reported February revenues increased by nearly 10% year-over-year to just below $15 billion. Despite the uptick in sales, ADRs of the Taiwanese semiconductor company are down more than 5.5% today. The loss is in line with the broader sector as the semiconductor index is down about 2.5%. Over the past year, UMC has gained more than 230% to its stock price. And shares of the computer security company McAfee are up nearly 13% on news the company has sold its enterprise business to Symphony Technology Group for $4 billion. The deal, which is expected to close by the end of the year, will turn McAfee into a pure-play consumer cybersecurity company. Symphony Technology Group is a private firm that bought another enterprise-focused security company last February for $2 billion. This has been your TD Ameritrade Network Market Update. Now back to the watch list with Nicole Petalides.
Evelyn Baker, thank you. Big box retailers have benefited from the pandemic, no doubt. Now the year-over-year comps. Let's see what we're expecting. Could it be hurtful? Patrick McKeever is with us, president, founder, The Daily on Retail, and Steve Brooks, CEO, founder, Pop-Up Retail Expert. Patrick, I'll start with you. What's going on with these big box retailers? They've come under a little bit of pressure, but we know everybody was shopping.
Yeah. I mean, the stocks have come under pressure. Costco, for example, is down about 15% year to date. So it's actually one of the worst performing retail stocks, but they just reported numbers for their most recent fiscal quarter last week. And, they were out of the park, so to speak. Their same-store sales are trending very consistently in the low teens, the mid-teens. That continued in February. I think Costco is very well positioned, but yes, they have very difficult comparisons ahead.
Okay, and tell me also, Steve, what do you think?
Yeah, Patrick's absolutely right about Costco. If you look at Walmart as well, I mean, Walmart's e-com sales grew by 69% in the last quarter, and their same store sales were just over 8.5%. Going forward with the vaccination programs and stimulus checks, all of these big numbers that these guys have been coming out with, they might be under pressure to continue to see that grow. But a lot of that's going to depend, I think, on their e-commerce and online strategies. But as time goes on, we'll be able to see, I think.
So, Patrick, ultimately, do you think it's a win in the long term, even though maybe some of the comps may be tough and the stocks have been down? Do all these retailers survive and do well going forward? We hear of a lot of them now talking about opening a slew of stores, too.
Yeah, no, things are definitely looking much better today than they were 6 months ago, 9 months ago, or of course a year ago for retail. We track store openings, the announcements very, very closely. We actually published on that this morning. And so far, just this year, there have been close to 3,000 store opening announcements by U.S. retailers. And Dollar Tree is the big one there. They're planning on opening 600 stores this year. So, and year to date, there have been about 1,700, 1,800 store closing announcements. So the openings right now are way ahead of the closing announcements. So that's a big plus, and I think it tells you a lot about what retail's thinking for 2021 as we get more stimulus and probably a big recovery in the economy.
Yeah, we heard from the Gap too, saying that they're adding more Old Navy stores and Athleta stores. Steve, tell me about some of the other areas that have been very popular. Obviously, curbside pickup, but e-commerce has been a big part of it. Does that continue to drive certain names? Which names do you think will be most successful and why?
Yeah, I think take a look at Target in terms of their in-store fulfillment process, and they're opening, smaller format stores as well. I also think the watchword maybe going forward through 2021 is collaboration. Obviously, Target have got Ulta already in a relationship. They're trialing 17 Apple stores within store, and I think that will drive more consumers in. But the integration of that online experience, curbside pickup, click and collect, easy pay will be the difference, I think, that drives the consumer with a bit more confidence as we go forward.
And Patrick, you talk about the shopping behavior and it tends to be sticky. Tell me more about that. Do you see success for all of these big box retailers, or some going to struggle?
No, I think the leaders, Walmart, Target, Costco, Home Depot, Lowe's, the bigger boxes that have done so well amid the pandemic, they'll see their businesses continue to be very strong. The business and retail does tend to be sticky, so consumer behavior doesn't change overnight. I mean, occasionally it does if there's a real shock to the system, but otherwise, consumers, they've migrated into these big boxes. Some of that is one-stop shopping. They want to get a lot done in one place and not make too many trips, consolidate their trips. That's very sticky. So that bodes well, I think, for Walmart and Target and the other big box retailers.
All right. Great to have you on. A great conversation, gentlemen. Patrick McKeever, the Daily on Retail. Steve Brooks, the pop-up retail expert. Thank you both. And thank you, friends, for joining me here on the watch list. I will see you at 5 p.m. Eastern Time for Market Overtime. We will help to plan your long-term portfolio. And a happy International Women's Day. Beautiful afternoon. I'm Nicole Petalides. Thanks for watching, and I'll see you later.
24/7 access to diverse global markets. Right here. That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready. Well played.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
NASDAQ in Chicago. Good afternoon, everyone, and welcome to Midday Trade. I'm your host, Kevin Hinks. I'll be taking you through the next half hour. We got a really interesting day today, but let's take a step back. We're late in earnings season, so let's take a look at two names that are surprisingly moving up the boards and really outperforming the rest of the market. First, Alex Caulfield stopped by the show, my co-host from Fast Market. He'll look at what the risk-off assets are doing today, and then we'll look at Ford, the company that's outpacing Tesla in the last few months. And then Jenny Horn, Ken Rose will stop by the show. We'll look at GE, my old stock that I used to be the specialist in and traded for 20 years. We'll look at GE and their news today about unwinding part of old GE Capital. All right, now, before we bring in Alex Caulfield, let's take a look at where the four major indices are at 1 o'clock Chicago time. The S&P 500, the S&P 500 is up 0.2%, 8.5 points to 3850. The NASDAQ 100 down 1 7/8%, 238 points to 12,429. The Russell 2000 up 9/16%, 12.25 points to 2,204. And the Dow Jones Industrial Average up 1.5%, 465 points to 31,958. Think about that. The NASDAQ is down 245 points. The Dow is up 460 points. What an unbelievable market we're having here today. All right, now let's bring in my host from Fast Market, Mr. Alex Caulfield, to the show. He's going to look at the risk-off assets and tell us what they're doing today. Alex, what are you seeing? We got things all over the board today, don't we?
We certainly do. And Kevin, even though there's some big numbers on the board, particularly when you look at the NASDAQ, all things considered, it's actually relatively quiet. And it's certainly pretty quiet here in the risk-off space in terms of the high to low range for the 10-year yield. It's been pretty tight. Given the volatility we've seen in this space, this is probably welcomed. Up 4 basis points, though, pushing 1.6 for the 10-year yield, 1.594 right now. So yields continued their ascent higher here, and we'll continue to watch that. Volatility is starting to take an uptick here. It's turned positive. That's up just under 1 point to 25.42 as the market has kind of taken a downwards turn over the last hour. Gold can't get out of its own way, Kevin, down $21.10, opening a little bit higher yesterday evening, and then it's basically been a one-way direction to the downside here. Basically sitting on the lows, about $4 off the lows, 1673.30. And we always talk about gold alongside the dollar. Well, look no further. You see the dollar up 36 cents, 92.35. Another strong day for the dollar, putting pressure on gold as well as on crude oil as well. Crude oil down $1.36. That's 2%. Now down to 64.72. Crazy to think, Kevin, that we're down 2%. And that leaves us at $64.71, just to show how crazy this move higher has been in crude oil. We can even take some steps backwards, and we're still at pretty lofty levels relative to the recent trading history.
Yeah, Alex, strong dollar, just not giving the gold market any oxygen whatsoever, weighing on the other commodities as well. But crude oil might be sort of a microeconomic story as we keep waiting for some inventory to come on the market. All right, Alex Caulfield, always a pleasure to have you on the show in this most unique day in the stock market. Have a great day, sir. All right, now let's look at our first trade of the day, and that is, I'm going to put up a chart, and it's pretty interesting. Look at that chart going from bottom left to top right, and look at that chart going from top right or top left to bottom right. And it would be interesting, or would it surprise you to know that that purple line is Tesla and this bar chart is Ford? And so look at the actions between these two companies in the last, since 1, 2, 3 weeks ago. Look at this right here. I mean, sure, obviously, Ford's a much cheaper stock than Tesla, and Tesla is multiples times larger than Ford. But look at the price action over the last few weeks between these two companies. Why? Well, let's take a look at Ford. Ford has recovered based on their commitment to electric vehicles. Sales of their F-150s are basically sold out, and the strength of some of their cars, and just the overall idea that Tesla had run too far, and Ford is starting to make a little comeback here, and their commitment to electric vehicles. So really interesting. But when we talk about a stock like Ford, we always like to look at the covered return strategies and how you would trade them. And what do I mean by that? Well, there's a column. If you look on the board here, you can hit up under theoretical and Greeks covered return right there. And so if you hit up that column, it shows you basically the return on investment if you were to trade the at the money or just slightly out of the money covered call for the entire year. And look at some of the numbers. Let's say you were to consistently, these numbers will be a little blown up because this is only 4 days. So if you look, selling the out of the money call, which is right now the $13 call, a 70% probability of finishing out of the money, and look at the covered return, 92% covered return. What does that mean? Well, think about it. In 4 days, right, with the 13 call, you're basically selling more than 1% of the price of the stock. If you do that every 4 days, think about what you're going to collect in terms of cover return. If you go out 11 days to next week and sell the 13 call, let's take a look at that one. About a 76% return on your money. So what even helps these before? The last time we did this, last time we covered this on this show, Ford was trading considerably lower than this. So what helps your covered return? The stock going upward as well through your short strikes, and you having to adjust the short strikes and things like that. That'll always help a covered return. So really, let's go to the Analyze tab and take a look at 2 ways you can play the covered return. First, we'll do the stock first. First, if let's say you were to buy 500 shares and sell 5 this week at the money, 13 calls. Let's open up our price slices and take a look, and you can see that you're collecting about $15 a day. You are long 500 shares of stock. You are short 5 calls. Obviously, at expiration, you extend duration on these and keep doing it, creating that enormous covered return. Now, you could do this on 100 shares, which is about, do the math, $1,200, under $1,300. You could do that one. You could also do it, though. Even something as cheap as that is cheaper to do via the diagonal. You go all the way out till next January and buy the 10 call and then sell the same this week's call. Only spend $3.50 all the way out till January and give you the same basically shape of a graph as you would with only a fraction of the risk on the downside. So many ways that you can use options. Think about this. If you buy the 10 call, right, with $3.50, you've only got $2.60 in intrinsic value, which means you've got less than $1 to make up in terms of premium. So what we're going to do, as we're running out of time, unfortunately, is we're going to do the diagonal. Can you do the cover call? Yes. But remember, Ford no longer pays a dividend. It used to pay a big dividend, which it was better to do that now. Based on them not paying a dividend, definitely do the less expensive diagonal play that you can go out all the way out a year and then continue to chip away at that trade. All right, now let's take a quick break. Come back with our second trade, our featured trade of the day, and that is General Electric. We'll have Jenny Horn and Ken Rose on to talk about that. Take a quick break. Come back in 2 minutes with more midday trade. See you then, everybody.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I added futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it.
If you have questions about retirement planning, then you don't want to miss Investor Education Day hosted by TD Ameritrade. It's a full day of free insights from TD Ameritrade education coaches and experts who can tell you all about honing your retirement strategies. And the best part, it's all online. So technically, you can enjoy the webcast from the comfort of your retirement pants, also known as sweatpants. Register for Investor Education Day at tdameritrade.com/education day.
Welcome back to Midday Trade, everyone. Kevin Hinks back here for the second half of our show. Now I'd like to bring in a contributor across the TD Ameritrade Network, Miss Jenny Horn, to the show. She's going to talk about our feature name of the day, and that is the old big blue General Electric, the stock that I traded for 20 years. Jen, this has got some news today. It's up 4.5% today on some news about the old GE Capital. Tell us something, Jen.
Yes, basically they're moving away from GE Capital, Kevin, and the street really, really likes this. You just mentioned they're up 4.5%. They're nearing a 3-year high. So really good day for them. They've gotten some positive analyst calls sort of following the news. But what this news really was is they announced that, or they didn't actually announce this, was according to the Wall Street Journal, reports that they're going to combine their aircraft leasing business with the Ireland-based AerCap. So for about $30 billion, no small amount. Now, GE, to go over some of their recent price activity, they've seen 4 straight days of gains. They're up about 30% year to date. They saw a record quarterly surge of about 73% in the fourth quarter. And in the last 12 months, it's even more significant. They're up about 50%. And you compare that with the S&P industrial sector, which is up about 30%. And then the S&P just index is up about 29%. So outperforming really its sector and its subsector. So that's phenomenal. Another thing is in this aircraft leasing unit, which is called GE's Capital Aviation Services, it's sort of the biggest piece of GE Capital, which was once sort of their mecca, their sort of famed financial services unit. Now they're moving away from that because it's absolutely crushed their bottom line. In 2020, GE Capital suffered a revenue loss of $1.5 billion, due largely in part to its aviation unit. So that's been seeing some, weakness since about 2007, 2008 in the financial crisis. But it's also seen a ton of weakness, of course, related to the 737 MAX grounding. So really, they've been trying to shift their balance sheet and sort of reinvent themselves. They've been working on their light bulb business, their sales in their biotech company, and really their oil field services, which have been sort of their money makers, moving away from what was once sort of their traditional General Electric. And I think it's kind of interesting, Kevin. GE Capital Aviation Services owns about 1,600 aircrafts. So you combine that with AerCap, which has about 1,400, all of a sudden this company, or potential company, I guess you could say, will have about 3,000 total planes that are either coming or they already have in their possession. And that's not a bad-sized company. All of a sudden it gives this new entity that's proposed, just more power with, say, a Boeing or an Airbus, because just that scale that they could potentially have here, I think is a really good thing going forward. And I think it just shows, sort of where this company is headed, which is really cool because, of course, this is one of those like old timers you traded for 20 years. However, they're really doing a good job staying relevant in today's markets, Kevin.
Jenny, there was a day when I was trading GE where GE Capital was one of the top 5 largest banks in the world and gave 43% of GE's bottom line. And then in the 2008 financial crisis, it almost took the company out, GE Capital. So they got out of that business at the lows, of course, and now this is some of the scraps from GE Capital, but really interesting story that they're getting out of this. They're basically going to become an aircraft engine and healthcare and a little bit of energy is how they want to see the future of GE. Jenny Horn, always a pleasure to have you on the show. Thank you so much for coming on and talking about a stock very dear to my heart, General Electric. Jack Welch, where have you gone, Jack Welch? We need you here now with GE. All right, now let's get over from the fundamentals to the technicals. Bring in live from Salt Lake City, Utah, Mr. Ken Rose to the show, and he's going to talk technicals on GE. And Ken, this chart looks pretty good, sir.
Right, Kevin. You look at the chart, this stock has had a very nice move to the upside. From a technician standpoint, one aspect of the chart that really stands out is the ascending triangle that GE entered into in late January. An ascending triangle is a situation where the stock maintains a consistent level of resistance while the stock is starting to make higher lows. And when the stock breaks out of that ascending triangle, you have a target related to that. That's going to be the distance of the bottom of the triangle to the resistance level, then you extrapolate that to the upside. When you make that extrapolation, we get to our most significant price point on the chart, which is at $13.26. Now, not only is this the target for the ascending triangle, this was also the pre-COVID peak that the stock was at. And in addition to that, last week this held up as resistance over about 4 or 5 days. We broke above this resistance level about 2 days ago. We actually came back down and tested that as a support level, and we bounced off from it. So the most significant price point on this chart is the current support level at $13.26. Remember that old resistance becomes new support. The stock is currently moving to the upside, and right now it's banging up against the Fibonacci 138.2 extension level at $14.27. If you look at today's candle is what's called a hanging man, which does indicate a potential reversal and move to the downside. It'll be interesting to see if that plays out or if we're able to break above that resistance level. If we were to move to the downside, if we were to break down below that significant support level at $13.26, the next lower support level would be at about $12.44. That's where this stock gave us a bounce back on $2.26. Then below that is another very significant price level on the chart. That's $11.88. That's that resistance part of that ascending triangle. It's also interesting if you look at the bottom of the chart, the volume oscillator was moving to the downside as this triangle was being formed, which is typical. And the volume oscillator exploded and moved to the upside as the stock broke out of that ascending triangle, which is a positive with regards to continued price movement to the upside. It's kind of what we're looking at here, Kevin. It'll be interesting to see where we go as far as banging up against that resistance level that we have here at 1427.
Now, Ken, just go over real quick again, just so I get it and our viewers get it. This 1188 level that you touched on, I really see that as a pretty significant level. Is that where the stock broke out of that ascending triangle, or what's that relationship to the ascending triangle that you were talking about?
Right, Kevin. So that is the resistance level that the stock broke out of. You know, at the time that 1188 was hanging up at resistance, it was moving up, making higher lows, and that is the point where it broke out and ran up there and hit that target at 1326.
Got it. All right. I just wanted to make sure because, yeah, that you can tell that is a significant level that it broke through. Ken Rose, always a pleasure to have you on. As always, thank you for coming on and talking about GE, a name we don't get to talk about that much anymore, but we do today. Have a great day, sir.
Thanks.
All right. Now, a similar idea when we look at GE is the covered return with a stock like this. Why? Because there's a lot of ways to trade GE, obviously, but there's the most efficient, the one that jumps out at you is the covered return, while GE is trading at such low levels. Like, look at this week's 14, the 14 called 14.5. Look at the covered return, 136%. If you go next week's number, go 11 days out, look at the recovered return at 14.5. 84.5%. Now, what does that mean? That means if the stock stays right here and every 11 days you sell that just out of the money call, that's the projected return. Now, that is a moving number, right? Obviously, 4 days, it's even a higher number, but you're constantly going to be chipping away at if you buy the stock, it's the price that you paid for it, the net debit. that lowers your break even every single week or 2 weeks, however you choose to do it, that you want to do that, you could extend it. Obviously, the stock's going to move both up and down. You adjust that price as it happens, and you can see the effectiveness if you're looking for returns. Now, Ford, like GE, was a stock that was really beat up over the last few years. However, this is starting. You see these two names with good news out in the past with Ford, with good news out today in GE, as they're slowly but surely cleaning up the mess left behind by the previous CEO, Jeff Immelt. It looks like GE is starting to firm itself up, firm up its balance sheet, and firm up its future going forward. So a lot of people were talking very negatively about the stock in the past. And as you can see, it got down to $5.50. That is incredibly ironic for someone like me who has seen this stock trade over years and years and years. And to see it trade $5 was just pretty incredible during the pandemic. So how do we trade this? Well, very similar to how you trade Ford. And that is, first trade, covered call strategy, right? Buy 500 shares, sell 5 this week at the money, 14.5 calls. You see it's trading about 25 cents. Well, if you look at 25 cents, it's almost 2% of the stock, right? And that's 4 days. If you go out next week, look at that, 38 cents and a 30 cent out of the money. That is, think about that. 38 cents is almost 3% of the underlying in the next 11 days. 3% would be 42 cents, right? So incredible, the returns that you can get on GE right now. How do you trade against it? Well, you could, but the problem is this, the obvious question is, can I sell the put and then sell the call? Well, you're short units, right? You got to be careful there. You'd have to hedge those units because you're not long an underlying against that short call. You'd have to either hedge it with one of the small out of the money calls, or you've got to do something to get units against that other one. If you're going to be short the call, you've got to have the underlying or another call. Here's the other way you can do it. If you don't want to do the stock, remember, a less expensive way to do it, and that is the diagonal. The diagonal is only $3.20. It looks like a very similar outcome than the covered call. You're collecting money each day. This time I went out all the way to January and bought the 12 call. You could raise that level of theta if you switch this to the 10 call. But remember, you're going to pay more. But that's all intrinsic value. See, you'd pay another $1.50, but then your theta went up and it didn't go up by much. I would still trade the 12 option against that. So even though, see, you save money on the net debit, the direction is the same, but the theta comes down a little bit. But if you were going to do this, let's say 10 times, it's $3,000 and you've got 325 shares of stock on, $3,200. So really efficient way to trade GE. And like I said, if you do this 10 times, you're collecting $35 and you can do this every week. The return on capital is outstanding on this name when you do that. Now, it helps because this is a covered call strategy or a diagonal strategy. You've got downside exposure. If you notice, the stock can still go down there. So that doesn't insulate you from losses on the downside, right? A covered call strategy is a short put. A diagonal strategy has risk on the downside. So make sure you understand where the risks are. Both these strategies that I talked to you about today are bullish strategies. If you don't have a bullish tint to your view on Ford and GE, these aren't the strategies for you. You could do range bound. You could do calendar spreads to do that. They trade very cheaply on the side. So there's a lot of choices. But this one uses theta, uses the covered return strategy to really help you out there. All right, we are going to send 10 of these diagonals away. And off they go. All right, that's our show for today, everyone. Ben Lichtenstein, he's the host of Midday Movers with Ben Lichtenstein, coming up next on the TD Ameritrade Network. Ben, what do you got for us today on Midday Movers?
Hey, Kevin, happy Monday. A busy day today in terms of indices. We've got 3 of the 4 majors clawing their way back into positive territory, coming off lows from earlier this morning. And while the Dow, the Russell, and the ES are in positive territory, it's the NASDAQ that's still negative. Dow actually posted a new all-time high today. We'll also continue our look at futures with energy markets, which are sharply lower today after spiking up in the overnight session. We'll look at that big move. And in addition to that, treasuries, which are coming off, so rates are further to the upside. Dan Sheridan joins us. He's joining us from Sheridan Options Mentoring to take a look at the retail names. We've got Dick's earnings preview for you, and then also a couple airlines on his radar. And we'll take a look at Disney today, and then the chart master is going to dial up that retail look again with Target, Lowe's, and Wayfair in terms of a technical look at a few stocks he thinks we should be watching. So some futures from some stocks.
Bringing out the big guns with Dan Sheridan today. Bringing out the big guns with Dan Sheridan. That's our show for today, everyone. Ben Lichtenstein coming up next. Then I'll be on with Oliver Rennick for all of us here at the TD Ameritrade Network. Have a great day, everyone. We'll see you in a few minutes with Oliver Rennick, and then tomorrow on Fast Market and Midday Trade. Have a great day, everybody.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on ThinkOrSwim for the full Options for Volatility course and a whole lot more.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Good afternoon, ladies and gentlemen, and welcome to Midday Moves with Lichtenstein, the show that packs 60 minutes of stocks, bonds, ETFs, and futures into a 30-minute slot, the show that brings you your double dose of energy right here on the TD Ameritrade Network. I'd like to kick things off and look at the indices. First and foremost today, the Dow into new all-time highs, up and through the 32,000 level, and, well, there you can see it, 32,148 is that new all-time high. They're leading the way to the upside here today, ladies and gentlemen, and, well, take a look. They're up by 1.75%, and just want to cycle through. The Russell also positive by 1.25% here. Take a look, ladies and gentlemen, as the SPX also, and, well, which one's not playing along? Which one is not like the others? The NASDAQ, ladies and gentlemen, as you can see, tech is taking a hit here today. We're talking down on the day by 1.5%. We're going to talk about why with Dan Sheridan. He's joining us this afternoon, and, well, he's going to help us take a look at it. He's joining us from Sheridan shared in options mentoring, ladies and gentlemen. So keep an eye on the indices, a volatile session, and mostly the NASDAQ lower here. But hey, last week we had energies which were bid and a focal point for many. Crude was up 5%. They added to those gains in the overnight session, but sold off since, trading all the way, ladies and gentlemen, up to 67.98 in the WTI, and well, we're talking 71.36 in the Brent. You've got the WTI on the left, the Brent on the right here, ladies and gentlemen, and you can see the move. Now, keep in mind, the bid that we saw in the overnight session was in response to that Saudi oil facility attack by drone, and this was one of, or I should say, the largest facility in Saudi Arabia. It's responsible for roughly 6.5 million barrels per day of production, so we're talking about 7% of the world's crude output, and this was a response to, well, we've seen this kind of back and forth with missile attacks on the Iraq and Syria border, so something to keep an eye on there, ladies and gentlemen. Feeding into the bid here, this even comes with a stronger U.S. dollar, I think, is what's weighing on crude right now, and the fact that, again, it didn't look like production was going to be disrupted from that facility. Hey, let's take a look here, ladies and gentlemen, at treasuries. We've got the 10-year, we've got the bonds, which are coming off. They're lower again today, which means rates to the upside. That pattern continues to play out. Here you can see the trend environment that has been intact, and, well, no rejection of here at this point. Bonds on the left, the longer dated, have been selling off. You got the 10-year on the right, the shorter dated, which have been joining in, and, well, this has rates to the upside. It's raising some eyebrows, ladies and gentlemen. The rate at which we've seen them climbing here has been staggering, to say the least here. Some key hurdles up above still at this point. We're talking the November highs that we saw up around 2.45, so we'll watch that, and still below that 1.6% level here right now in the TNX, but something to keep an eye on in terms of the economic data this week. It could be a market mover here, ladies and gentlemen. Potential to see rates, treasuries, we're talking indices, we're talking energies, ladies and gentlemen, and all of the above. Even the dollar with the CPI, with the PPI, I think that's going to be the major focal point. Don't forget, for the grains traders, though, we do have the WASDE report tomorrow. Beans and grains have been doing very well. They've been holding on to that trend pattern that we've been seeing to the upside, ladies and gentlemen. That's a couple data points this week to keep an eye, to keep an eye on. Again, I think the focus will be inflation. And that's a look at a few futures markets on the move. Let's shift our attention on over into a couple stocks. First, one to the upside, we've got VF Corp, ticker symbol VFC. Let's get right into the chart first, the daily, so you can see the net change and the range. They're up by about 4%, and, well, have been holding above 75, below this $90 level, basically since gapping up back in November of last year. I do want to point out here, ladies and gentlemen, that, well, if you take a look here, you're going to notice today they traded all the way up to 82.77. Now, this move comes after Pivotal Research upgraded VFC to buy from hold. They have the stock with a 94. That's a $94 price target. That's up from 86. The stock, if you remember, took a hit back in January after missing third quarter revenue, and well, they missed not only revenue but provided weak guidance. Pivotal expects VF Corp to earn $2.98 a share on $11.37 billion in sales. Consensus is for EPS to come in a little bit below that, around $2.96, and for revenue of $11.35 billion. Analyst consensus, that is. Now, not sure if you remember, but in those quarterly results, they actually revealed sales for the Vans brand were down around 6%, and this was a big part of Pivotal's comments. They said that they are still a very relevant youth lifestyle brand, and Pivotal, again, expects VFC and that North Face brand, with some of the colder temperatures that we've seen, to benefit, but they actually said they thought some of those bigger benefits would come further down the road in 2022 for VFC and that North Face line. Ladies and gentlemen, next, look at another big mover here. In this case, we're talking one to the downside, another retail stock, and, well, Apple. Ladies and gentlemen, let's take a look here. Down 3% here, and, well, as you can see, I guess, I don't know if everybody would call Apple a retail stock necessarily, but certainly ties into the discussion here and the focus that we do have on some of the retail names today. And, well, take a look here, ladies and gentlemen, at the daily first and foremost here. I want you to see the net change. They're down by, as mentioned, 3%. The range that they've been in, and the slide off that 145 high. This range has been in place, ladies and gentlemen, since they gapped up back in, well, all the way at the end of July last year, and that 102 level got breached. You can see the move here and the trajectory that they saw up to the 145 level and how they've come off since. Take a look here, ladies and gentlemen, at the weekly time frame in terms of Apple, because I want you to see here, if lower this week, that's 5 out of 6 or I'm sorry, that's 5 in a row, it looks like, and 6 out of the last 7 after posting that high today, ladies and gentlemen. They got down to 116.76, and not a lot of news on this one. Just tech in general is really taking a hit. Now, at the top of the show, we took a look at how the tech-heavy NASDAQ was, well, all the weakness we were seeing there, the only one of the foreign major that's negative on the day. That's tied directly to rates to the upside. So, actually, I want to bring in our first guest here to further this discussion in terms of tech taking a hit and some of the retail names that we've got to keep an eye on this week, and investors are going to be keeping an eye on as well, ladies and gentlemen. We've got Dan Sheridan joining us. He's the founder. He's the CEO of Sheridan Options Mentoring. Dan, welcome. We're starting the week out with a focus on retail stocks. I just looked at VFC and Apple. I see you have your eye on a few names as well, some retail names. But first, I wanted to talk rates on the rise and the impact that it's having on tech.
Well, I just think, again, I think of the word valuations. When you think of, like, you were bringing Apple's up 80%, last year? And so it's down, 12, 13, 14% this year. I just think there's better, with the rates up, there's, better choices for some of these funds, especially like maybe banks or something like that. But I look at Apple, Ben, and since you brought it up, and that's one of the things I'm looking at here. I'll tell you why I like Apple versus some of the other techs. I like Apple probably is the most liquid option, right, in the history of civilization. Agree? I mean, Apple is liquid. I mean, it just means I like things I can get in and out without a lot of slippage. And so what I'm looking at is somebody who might say, you know what, Apple's been beaten up. I like it long term. Something I'm looking at, Ben, is instead of selling a put, like a cash secured put, which eats up a ton of capital, sell like the April 9 108 puts, which is quite a bit lower than we are right now. And then for 40 cents against it, buy the 90 puts. So the April 108 puts, April 9 are going for about $2. So if I just sold a put, say I can buy stock, 108 minus 2, about 106 with the stock at 117 by April expiration. Why do I want to tie up, almost, $12,000-$13,000? I'll go buy a put for 40 cents against it, maybe the 90 put, and now I've got a put credit spread for $1.50, much better yield. And so something like that with the stock beaten up, I think is a reasonable expectation, very low probability that will be under 108 in Apple by April 9 expiration.
Okay, I like that in terms of a pretty good explanation here and a pretty good look at, yes, as mentioned, with rates to the upside, assets such as are being looked at a little differently than they were a couple weeks ago. That's definitely the case. We'll continue to watch Apple, some of the tech names, but let's talk retail. And the retail rally that we've been seeing, we've got big names. We're talking Hanes Brands. We were talking Ross last week. We've got Tapestry. We're talking TJX, Ulta. I mean, these are the best performing names in the SPX today, and certainly a lot of focus here. I mean, on retail in general. It seems like 4 weeks now into this, Dan.
Oh, yeah. And now with the stimulus, everybody's excited about these things. I just picked, Ben, I was looking at the expensive one here, Ulta, right? That's the, trading much higher than the rest of them. Ulta's about 346, which is up about almost 4% for the day. And it was basically in a range for the most part before today. And what I'm looking at, again, how do I take a shot or a spec play in a very high price stock without, excuse the bad analogy, getting my face ripped off? And something I'm looking at on a $346 stock, a cheap directional butterfly. I'm buying one March 19, 350 call, selling two 370 calls. So I'm kind of placing my short bend near the expected move, buying one 390. And that opens the wind gates for me. It gives me an area of about 350 to 390. As long as we don't 350 to 390, here's a chance to make, 50 to 100%. If we're in that, in another week, if we're kind of in that spider web, that profitable area of this butterfly, it can do real well. And again, I like it. because they're relatively cheap. The way I play these, Ben, I'm looking for about 30 to 50%, and I'm only going to carry them at the most. This is a March 19 11-day trade. I'll probably carry this about 5 days, around half the duration, because I don't want to lose all the debit if it goes against me, and that's usually a good time to get out. But anyways, that's an idea for a high yield trade over the next week or so.
Okay, let's talk about Dick's, because we've got earnings coming there, and you've got your eye on a cheap butterfly for DKS. It looks like EPS expected to come in at $2.21 a share. Dan, we're looking for revenue of $3.02 billion. What do you have your eye on in terms of a potential trade?
Yeah, and again, I hate to duplicate a trade, but I was just looking at this thing. Again, looking at the expected range in here, and again, Dick's is it really rose here, and you could say, well, usually maybe the earnings will go the opposite. But again, this has been down a little bit. So what I look, again, a cheap butterfly, I mean, really cheap. So I'm looking at March 12. This should be going for the homer, right? This is not a singles or a double. This is a spec trade around earnings. I'm looking March 12. It expires Friday, buying the March 79, selling the 82s, not too far off the expected move, and buying the 85s. That trade is going for around 23 bucks, right? So if I wanted to buy 20 of them, if I wanted to risk $500, I'd buy 20 or 25 of them. And commissions are pretty cheap these days. So that's a cheap little shot that could hit a homer. I mean, 100% or more on Friday expiration. But again, the way I played these spec trades, which I've been talking about today, is, hey, what if I were to lose the whole thing? When I look at a spec trade, hey, if I'm going to throw $500 into this and do 20 of these things, I'm expecting, hey, if I lose the whole thing, am I okay with it? That's how I do my sizing on any type of spec trade. Mm-hmm. And so that's what I'm looking at for Dick's, going for a homer, no doubt about it.
All right, swinging for the fences in DKS. Let's talk about how we've seen, some strong TSA data the last few weeks. Airlines have rallied after the stimulus, the Senate passing. It's now headed over to the House, and some positive individual news on a couple airlines, American Airlines and Southwest. American actually announced the offering of senior secured notes to repay all sums of outstanding debt under the term loan facility they received. That was from the U.S. Treasury. Let's talk about what you're seeing in terms of some of these individual names. Looks like we're seeing some positive territory in the airlines today.
Yeah, and I'm looking at LUV, which is trading around $60. You had a 5.5% move today, which is a big move. Yeah. And so I'm just looking at this and say something I don't normally do, but it's an in-the-money call vertical, and saying, look at March 19 is about 11 days away. And I'm not even saying that we're going to be up a lot, because we had a good move today. But if I think the stock's going to at least stay here or be up, right, 60 or higher, I'm looking at March 19 buying the 55 calls and selling the 60 calls. And as long as we're over 60, everything over 60 at expiration, that trade's going for about $3.65. And if we close over, $60 or higher on the upside, you're looking for a chance, on a $365 trade to make about 130. So you're looking at about a 30-some% return, just if it sits here or goes up. Again, it's a $5 trade. We're paying $3.60. I don't normally do that type of thing, but because of my thinking on this, if we could just stay at $60 or higher, a nice return. So that's something that popped out at me.
All right, well, we'll see if we can get these airline stocks to continue to take off. They've certainly started the week with the trajectory that the bulls want to see. Dan Sheridan, appreciate you joining us here. A couple practical approaches towards trading some of the names, some of the retail stocks, and again, a couple names that Dan has his eye on, airlines as well. Dan Sheridan is the founder and CEO of Sheridan Options. Ladies and gentlemen, coming up next, the focus on retail continues with my chart of the day. Ticker symbol BIG is up lots to a new all-time high. Stay right here on the TD Ameritrade Network. Midday moves at Liechtenstein. We'll be right back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our portfolio management webcast series breaks down key concepts like retirement planning, income generation, ETFs.
All right, guys, let's see what we have got going on here. About an hour, hour and 15 minutes until close. We stop back up to 184, not bad. Dipped down into the 160s, but back up to 184. Let's see what we're looking like here. Up to 188. Hey, not a bad little second surge. I am super pumped about Express. Express had a huge day, 68%. Peaked at 433. Again, I've got quite a few shares in Express, but we're still pretty far away from where I want it to be. My sell orders here at 749, so quite a bit of way from where I want, even though it's up a lot from 2-something, but 2.5 pre-market up to 4.3. So pretty awesome day, but still pretty far away from where I need to go. AMC, just a slow day. Just nothing spectacular. Went from mid-8s up to 9. Nothing crazy. Costs went up, down, up, and it's still down. RKT is continuing to slide after it spiked early in the morning, 27. Not great. Let's see what CCIB is up to. CCIB man is 22.9. I mean, I'm gonna be somewhat excited about getting some CCIB at 20 if it gets to. Yeah, I've got to sell or buy order in here 4 shares at $20, actually 20 to 1. I like to do one penny over, 1 penny less, just to balance off those psychological limits. I don't want to miss on something by getting it right at 20, something like that. So that's why I have those. Let's see what else is going on today. Oh, you know what? Another one that I was looking at. I'm gonna break DDS Village. This is one of those that I also got in on at the wrong time during the surge in January, and I only got 3 shares. But it's been such a struggle to get back to where it was. I'm super excited though that it's been up over the past couple of weeks, and now it's just at about 90. It's bouncing off of 90 right there, so there's huge resistance at 90. Probably other people like me that their numbers right there at 89 something. So haven't got anything hit 90 all day. Barely hit 89 right here, but that's about it. But yeah, my sell orders at 111, so that's how far away I am. But I've made up tons and tons of room in the past couple of weeks. GME back on the screen here. Express again, super excited about that one. Another one that Genius Brands. This one's been frustrating to me, quite honestly. Also, another one of the meme stocks that had a very quick surge and then has just not done anything since. Not this one. Let's do a couple. Let's also go do BB and BBY. Actually, I had a BB, no, not BBY, BY. Best Buy's probably doing okay. Bed Bath and Beyond. Also, Bed Bath & Beyond's done okay, up 9% today, but still pretty far out. BlackBerry up 5% today, but still quite a ways out. So half of where I think it needs to be, up towards 20. Genius, so I'm having fun here with Genius. GNUS. There we go. Yeah, just Genius just having that. It's a dog today. It's slightly in the red today. Not great. So of the meme stocks, Nokia is sucking. Genius is sucking. I actually owned BBW, Build-A-Bear, for a period of time during their surge, and then sold it off. They're up 2% today, so they're not doing too poorly. But yeah, it's
it's interesting time for many of these. Let's go back to where are costs. This was Express. Let's look at Nokia and see if it's doing anything afternoon. Probably not. Just no movement from Nokia. None. Kind of annoying. It really is. Um, Naked Brand Group. Let's see here. Back below one. Still up 11.5% today, but kind of frustrating. Let's look at Express real quick. Express is here. Express is my winner for the day. It's up 73%, up to 4.26. Might see a little bit of the squeeze, huge gain today. So I'm super excited about this. Of course, probably my buy over here at 225 would have been awesome if I had gotten it at 240 this morning because I would have brought that cost basis down a ton. But it's still a great day, up to 4.33 right now, and I'm still quite a ways away from that sell order of 749. So if this same day happens again tomorrow, percent-wise, I think it might be there, pretty close. But that's how far we are. So we still have quite a ways to go with Express. Express also just generally, I don't know if it's a long-term good investment. I mean, GameStop can be pivoting. Same with AMC, not just pivoting, but also in just it being a decent stock to buy in pandemic diseases and restrictions and people go back to the movie theaters. They can stay cash. They can stay with cash, like keep cash in the bank. I'm going to say cash flow positive because I'm not. If they can keep cash through the rest of this pandemic, and the movies start coming out, people start going into the theaters, then I think AMC is a good place to get out of this mess and still be a decent investment. Not the greatest of all time, of course, but decent enough to at least survive as a company. Look at Express. A great day for Express. To me, Express is one of those where it also got completely over leveraged, similar to what I did with GameStop, and had to buy myself down through some dollar cost averaging, and it's just really high. It tanked a ton after the meme surge, just like GameStop did. GameStop went from obviously 500 to $40. Express went from like 11 or $12, I think, down to 2. So that was a big cost, another huge one. But luckily, cost and naked, I got it and got out, and I sold half of my shares at a higher number, which allowed me to just play Monopoly money for what I have left. So those two also saw huge dips. Naked went from 3 down to 0.8 again. Cost went from cost had like the biggest percentage wise gain per day. I think it was on the 26th or 27th January. It went up from like $20, which was what I originally got in at like 18, 19, $20, all the way to somewhere just insanely like 140, 150. And then, of course, came crashing back down. And I sold some of it when it was over 100, kept the rest. It's play money. So now it's way back down, like what it was before the whole mess started, like 18. I actually had a really good earnings report, the last earnings report from a couple of weeks ago. Surprisingly, I think it's everybody that are profitable because even with costs, it's just dying business. But the reason why they were profitable, what I understand, they had over a year up to 2020 because a lot of large institutional buyers, such as school districts, buy cost supplies or buy from suppliers that use costs. So, like headphones, for example, when all their kids are working or going to school from home or remotely, or even in the classroom, they have to be separated. They're having to buy headphones for kids. What better place to find cheap, terrible headphones than costs? So they would buy, schools would buy thousands of headphones, Bose headphones, like $5 each, to hand out to their people. So they actually had a huge surge in revenue because of it. So that's why costs actually had a decent year. They can then use that as a catalyst to get better in the future. Also can pivot, but I don't think long term cost is like the headphone brand of the future. I think we're going to see too many offshore competitors. It's too easy and too competitive for someone from China to make something and sell it on Alibaba. You see companies like Raycon. Ray J is the guy that started Raycon. Raycon basically is they branded something off of Alibaba, just like a dropship headphone, and they're selling tons of them, and their supply cost only $2 or $3. They're selling it for $50, $60, $70, and the rest is all marketing expense. The cost of customer acquisition. So, it's an interesting one with cost. I think it's one of those where unless they do something massive to it, which I do not expect, they are probably eventually going to die or sell or merge or something like that. So I can see cost getting out of this as a real dominant player in the technology business in years in the future. But again, I believe AMC and GameStop have a future. I think both of their stock prices are a little overinflated right now, especially GameStop. I think they do have a future. Express probably does not have a great future. Naked Brands, they should have a good future too. So even if you're underwater on some of these, buy and hold them. Or sorry, if you're underwater on some of these because you want hold them. There's a decent chance that it might take a year, 2 years, 5 years. I don't know. Don't sell a massive loss. You can see now from GameStop where if you get sold at 20 or sorry, at 40 or $50, you miss out on the surge where it's at 210. So don't just sell to sell.
On the TD Ameritrade Network. I'll see you guys tomorrow morning for futures at 8 a.m. Eastern. Have a wonderful evening. See you tomorrow.
Why did I add futures to my trading strategy? 24/7 access to diverse global markets, like wheat. Can you say growth opportunity? We should probably harvest that.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it.
But still, earlier today, all-time high there. S&P 500 not moving up so much. Going the other way is the NASDAQ, as it has been, as large tech is seeming to have trouble overcoming the specter of rising interest rates. Not the specter, the reality. Seema, I was speaking earlier today to a travel agent in Florida, and she said, I think one of the key reasons here is people are done with the pandemic. They want to get back. They want to travel. This travel agent said she is booking cruises for 2023 because the ships are booked up in 22.
Fascinating. A survey from Jefferies says 27% of people who are vaccinated have already booked travel for this summer. So you look at Disney, best performing name on the Dow. That really tells you the story that this reopening trade, it's heating up.
Frank, final thought is yours.
I think we got to look at GameStop, Todd. I'm surprised we haven't talked about it all show. Shares up about 35% right now. The transformation announced today seems to be resonating with investors.
All right, Dow up about 500 as we enter the last hour of trade. Tyler and Frank, great to be with you for this hour. And thank you for watching Power Over Lunch. Closing bell begins right now.
As well.
Seema, thank you, and Frank and Tyler, and welcome everyone to Closing Bell. I'm Sarah Eisen, along with Wilfred Frost. Strong start for Wall Street following last week's turbulence, at least for the Dow. The blue chip index soaring to a record high, building on Friday's gains. But it's another ugly one for the NASDAQ, down 1.5% as we head into the close. Let's look at what's driving the action. 1 hour left of trading. The Senate passing the $1.9 trillion stimulus package this weekend along party lines, with a House vote and a presidential signature expected during the week. More on that in a moment. Comments from Appaloosa's David Tepper helping boost sentiment this morning. The hedge fund manager saying it's hard to be bearish on stocks right now, and yields should be stable over the next few months. But bond yields are marching higher yet again today, and that is weighing on big tech. Apple's down 3%. Tesla tumbling again, and the FANG names are mostly lower. 59 minutes left to go in today's session. Wilfred.
In fact, increasingly lower, Sarah, down 1.8% on the NASDAQ composite as we stand. We've got a big lineup coming your way today in just a few minutes. The woman who's captured the attention of Wall Street and the investing world, ARK's Cathie Wood, will join us in a First on CNBC interview to talk about the sharp pullback in some of her key growth names like Tesla. Another down day for some of those stocks of hers. Plus, DraftKings inking fresh deals with Dish Network and UFC, helping drive that stock higher by 30% or so far this year. We'll speak with the CEO, Jason Robbins, about those latest moves. And today is International Women's Day, and we've got a great voice to talk about the outlook for women in the workplace going forward. Melinda Gates will join us with thoughts on that, plus the global vaccine rollout and very much more. But first of all, let's get straight to the big stories we're watching. Mike Santoli's tracking today's market action, and Eli Moy has the latest on the stimulus bill and where things stand on that. Mike, let's start with you, and quite a pronounced difference in performance, Dow versus NASDAQ today.
Another day, Wilf, yeah, some stark divergence here. You know, this excitement over an economic acceleration, it's flattering the Dow, it is battering the NASDAQ. Capital just keeps moving from growth into value and cyclicals. On the S&P 500, it's netting out to a little bit of pressure, a little bit of kind of a failed rally from this morning. Just to put this all in context, the bounce that we got from the lows last week, twice around 3,700, a little above there, you gained about 100 points, so about 3% from those lows. Now, a lot of folks would look at that and say, is it just a bounce, is it just a reflex, or is it the sort of a more enduring recovery and a trip back to the highs? Well, the levels that people would be looking at is more like 38.80, 38.85 to say that, okay, we've kind of mounted that and gotten back into that uptrend. So that's something to keep in mind, that we're still within the bounce zone, even though market has not had very much net damage to it. Here we go. It's really an anti-momentum move. The momentum ETF, this is the stuff that's been working the best in the past 6 months, has fallen apart here in the last little bit, whereas value as a factor, large cap value, obviously has recovered. This is a 1 year look. If you go back 5 years, there's still a massive spread here, like 50 percentage points between momentum and value. So there's more to go. By the way, the momentum ETFs are all going to rebalance, and they're going to own a bunch of reopening stuff. Momentum is going to be financials and energy and all that. So that's sometimes a lagging indicator, not a leading one. Take a look at credit. It's something that is held together okay. This is the performance of the high yield ETF against the high grade corporate debt ETF. So when this one is outperforming as it has been, it means the credit conditions are relatively strong. It means there's still good risk appetite out there. Speculative grade debt is doing fine. This is really moving with treasuries, prices of treasuries, although this has, you know, it's worn down a little bit, so it's not necessarily stellar, but it's still holding in the right direction for that cyclical enthusiasm, guys.
Mike, when you see something like a momentum ETF pullback like that, how important is it to watch inflows and outflows? And have we yet had outflows contribute to the pulling back, or could that be something that compounds the misery if it materializes in the coming days and weeks?
There certainly have been outflows. It's kind of part and parcel of that. So it's partly, you know, people don't like these stocks as much as they did before. They're selling the stocks, the prices of the ETFs go down, and you do get some outflows. ETFs, it's a little bit less of an issue in terms of flows when it's a passive index like this. You can create and redeem those shares relatively easily. But yeah, it tells you that money is fleeing from that part of the market. And so in a short term anyway, it can become self-fulfilling.
NASDAQ down 1.9% now. Mike, thank you. We'll see you soon. The nearly $2 trillion stimulus bill has passed through the Senate along party lines, could be signed into law early this week. Elon Moy with more on what comes next here, Elon.
Well, Sarah, Democrats have planned to hold the final vote on the COVID relief bill tomorrow in the House, though it's always possible that timeline could slip. The goal is to have it signed by the president before the end of the week, when enhanced unemployment benefits will run out. Also critical, making sure those $1,400 stimulus checks start hitting people's bank accounts as soon as possible.
2 weeks, approximately 2 weeks, these checks will arrive. Not months, not years, not wait for your tax returns back next January, right away.
Now remember, Democrats were forced to limit who could receive a check after pushback from moderates. Now anyone making over $80,000 or couples making more than $160,000 won't be eligible. According to one estimate, that cuts out about 9 million people. Ultimately, though, how quickly the checks are delivered will be up to the Treasury Department. The White House said today that Secretary Janet Yellen is focused on this like a laser. Now, no word, guys, on whether President Biden's signature will appear on the checks. The White House said its focus right now is on getting the bill across the finish line. Back to you.
Elon, wanted to ask you about Senator Manchin's comments on infrastructure spending, which is likely to be the next one that the Biden administration takes up, and suggesting that he's not going to pass another multi-trillion-dollar package without Republican support or under reconciliation. Does that change the expectations for what Wall Street and everyone else can expect?
You know, I think Senator Manchin did a couple of interviews around that same day, and my take on what he said was that he wanted to have a good faith effort of getting Republican support first before they considered this reconciliation process that they could use with only Democratic support. How quickly he turns toward reconciliation, how much of an effort the administration and Democratic leadership need to put forth before they say, all right, this isn't going to work, we have to, go it alone once again, that will be a critical question. I don't think he was ruling out reconciliation altogether, but I do think that the focus for both the administration and for moderate Democrats is going to be on trying to find a way to work with Republicans on this, because let's be frank, this was supposed to be an easy lift for the Democrats. The template for COVID relief was already there, and yet we saw at the last minute it hit this snag over the concern from moderates. So, the contours, the shape, the size, even the structure of the next package right now are all in play, and everyone is trying to make sure they can put their stamp on it.
Elon, thanks so much, as always. Still to come, DraftKings on a hot streak, the company inking new deals with the UFC and Dish Network, helping add more fuel to an already strong rally over the last year or so. We'll speak with CEO Jason Robbins about those new partnerships and what they mean for his company next. Plus, don't miss our first on CNBC interview with ARK's Cathie Wood, as her flagship fund comes off a brutal week of performance. Doesn't look like it'll bounce back today. We'll talk to her about her top holdings, her outlook on Tesla, her top picks from here, and if she's taking profits in any names. You're watching Closing Bell on CNBC.
I'd say DraftKings is probably one of the I don't. It's probably one that I wish I did. Thought about it maybe at least a year ago, maybe longer, and I just never did, and probably should have. But I do think it's got a good outlook for the future as well. I mean, we're seeing more and more mainstream adoption of sports betting. Just in the All-Star game last night, the NBA All-Star game, they were talking about. They had an advertisement. I think it was for DraftKings, like a little advertisement they were talking about. It's just normal now. Sports betting is just normal with companies like FanDuel and DraftKings. So good for them. I still think it's something that's going to continue into the future and be a good business. So yeah, I'm feeling good about DraftKings.
The 7th of March.
Wow. Pretty amazing.
Is that yesterday? Yeah, Sunday.
So people are moving again. The numbers are adding up, and then some of the theme parks are open. And we talked SeaWorld chart this morning. The chart master brought a SeaWorld in. Hey, it's breaking out. Disney kind of looks similar.
Yeah, and you know what? You could put another one of the roller coaster, Six Flags, also up 5%. So SeaWorld, Six Flags, Disney, all gaining about 5% each. And this is all about updates on theme parks and sporting arenas. And so now over in California, they're talking about Disneyland and getting it reopened April 1st. It'll be at limited capacity, roughly 15%. But that brings the stock to a new high, all-time high, and that's helping to lead the Dow Jones Industrial Average. Now, the Dow Jones Industrial Average hit a new all-time high, as did the transport. So we are seeing all up arrows. Again, this goes to the parks and sports stadiums that will now be able to have this limited reopening. So little by little, we're getting there. Even today, I was reading an announcement about the high schools in New York City. March 22nd, kids can go back to high school, and that also has some rules with it. But this is what we're seeing here. And a winner, 199.76 right now, but it did hit an all-time high today.
Okay. All right, so Disney just continues to move 5%. The stock has extended its early pop as trading goes on. So while the NASDAQ plumbs new lows of the day, you've got Disney sitting near the highs and the airlines hanging in there. So clearly this market is a very different experience where you are. We got the Dow at records at one point today, Nicole, while the NASDAQ's getting beat up.
And the cruise lines too. So it all goes together. And Ben Watson can get his Mickey Mouse ears ready. I know he has those. So you know, I'm willing. I'll put on a pair. I'll be the first one there. So I think it's exciting. And you are seeing the reopening trade, at least for today. It's a winner. But the NASDAQ really not participating at all.
Okay. All right. I'll let you guys do the Mickey stuff. I was never a big Disney kid. We did Magic Mountain in California with Warner Bros. So that's more my alignment. But I like the spirit here. Appreciate it, Nicole. Thank you. All right. We'll see Nicole ahead by the closing bell. Right now, let's talk volatility. Let's talk options and how to trade in a market that's moving quickly with some preference on small caps. Ariane Crickey joins us from SIBO Global Markets, head of derivatives and global client services. Ariane, your team recently launched the Russell Minis, right? New ways to trade. So walk us through what you see right now and how these work.
Yeah, no, just playing off your intro, you know, small caps, you've been talking about it all day, you know, continuing to rally this year, up 14% compared to the S&P, only up 5% in QQQ, is now down for the year. Just what you've been referencing, you know, this sector rotation, which started out to play out in February, that is out of growth and into value stocks. And we're really seeing any growth name, especially in that tech sector, and even you're mentioning semis a minute ago, are feeling the pressure because of the rate moves, the stimulus spending and inflation fears. And several market segments are really leading this small cap outperformance, which has been super exciting for our launch. And as a result, you know, we've seen the RUT derivative family, which we're going to talk a little bit about today, experience 66% growth in daily notional trading year over year. That's outstanding. And a lot of this flow can be described as hedging or directional trading because of the themes I just mentioned.
So right now, the demand seems to be there for small caps, obviously, as we see the index really powering up. And then it seems like you're also seeing volumes pick up. How are you kind of gauging the interest in some of the Russell tied contracts as opposed to more traditional ones? I mean, obviously they're new. I would expect the volume to be a little bit lower. How are you kind of gauging the demand, you know, relative to everything else?
Yeah, again, so, you know, this is initial stage of this product launch. Again, what we launched last Monday, was what we're calling the MRUT contract. It has a notional value of 1/10 the size of our big RUT. That's our Russell 2000 contract. And what we're seeing is that we're seeing growing demand initially, not only from our retail firms, but a lot of our proprietary or market-making trading firms. Quote quality has been very good, strong to start, but as we start to see volume grow, which is expected, we're going to see these spreads tighten even further. You know, this initial demand is really encouraging. It's creating a dynamic or a framework that will gain even more traction when we start to see more and more investors get comfortable with this new product, this mini contract, and expectations are that they're going to utilize it not only to hedge the market views, which you were just discussing, or even bet on small cap implied volatility.
So, Ariane, right now, for those that trade the ETFs, or they look at, you know, an IWM, for example, how does the experience differ? I mean, obviously there's a lot of deep liquidity in these highly traded, high volume ETFs. Is there a trade-off? Is there a risk reward, an advantage, disadvantage to going to use the minis?
Yeah, no. You and I have talked about this a lot on this show, and I think you're asking a great question. Again, similar to our mini SPX options, these contracts offer several advantages over the IWM contract or an ETF contract. Again, easy, cash settled, simple credit debit into your account. European settled, which means no early assignments or an underlying ETF gets assigned into your account. And lastly, tax treatment. You're being 1256 and 6040 eligible are key differentiating factors and advantages for this new contract and even some of our existing contracts. Again, this one being the mini RUT contract.
Okay, the MRUT. 1 week in, it sounds like you guys are getting some attention on it and getting some traction. Ariane, thanks for the update. Appreciate you being here.
Thanks, Oliver.
Thank you. Ariane Crickey, Head of Derivatives and Global Client Services at Cboe Global Markets. When we come back, let's talk some more about the action. Kevin's going to join us to walk through where the pain is as it extends here over the last 30 minutes. Chinese stocks, especially the tech and online plays, are really getting hit, even more so than those here in the U.S. We'll be right back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I added futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it.
If you have questions about retirement planning, then you don't want to miss Investor Education Day hosted by TD Ameritrade. It's a full day of free insights from TD Ameritrade education coaches and experts who can tell you all about honing your retirement strategies. And the best part, it's all online. So technically, you can enjoy the webcast from the comfort of your retirement pants, also known as sweatpants. Register for Investor Education Day at tdameritrade.com/education day.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Welcome back to Market on Close. Let's bring in Kevin Hanks for some help assessing today's intraday moves, especially here over the past hour. Hey, Kev, as the market takes another leg lower, no headlines, no real news flow, right, Kev? It just feels like we're discovering the path of least resistance, it seems.
Yeah, these numbers, these corrections on some of these big tech names are getting substantial, Oliver. It's not very often. Take a picture of your screen today. Not very often you see the NASDAQ down 2.5%, the Dow Jones up 1.5%. The Dow Jones was just up even more than this before it's starting to leak away now. But the NASDAQ, Oliver, is such a driver of this entire market that it's not surprising that it's starting to weigh on some of the other indices. I mean, the SPX, which, the classic characteristic of a rotation is when one of the indices is up, like the Dow, one of the indices is down like the NASDAQ, and the S&P is basically unchanged. And that's what you're seeing today, which really lends toward a rotation. However, that being said, Oliver, if you're in some of these names or you're trying to buy some inexpensive names, the pain is real on some of these names because you're talking about some big percentages on not only the FANG stocks, but Tesla, and it's starting to leak into these other names. You and I are coming on to talk about Chinese stocks and what's going on with some of them. The numbers there are worse than they are here in the States. I mean, some of these names, I'm looking at the chart on Baidu. Baidu just traded $354, and now it's trading $230. I mean, it is the percentages that they're taking out of some of these names. Alibaba, the same thing. It has, it was just, this was more the end of the year, $319. It's $226. So it's lost a third of its value. Baidu's lost value. Tencent is down 5.8% today. I mean, they are hitting stocks all over the place and buying those names that were beat up and selling these names that rallied during this pandemic. And let's face it, some of these names are going a lot farther than a lot of us traders thought they could, but that has always been the case in moves like this, Oliver.
Kev, to see Tesla at the lows of the day down 6%.
Yeah.
The wipeout from the highs, that one's one of the few that's close, that's alongside some of the China pain that we're seeing. Tesla down about 37%. But it's fairly unique here. To your point, the China stocks are getting hit a lot worse, but they're kind of cut from the same cloth at the end of the day, right? And as their economy bounces back too, now there's also rumors of more just kind of global tightening through bonds and bond yields, where none of these central banks want to hike. I mean, there actually have been a few kind of hikes in some of the developing countries, but when you look at the big two, U.S., China, and all the growth markets that they're behind, you can clearly see here that this is a global phenomenon of economic recovery driving this. So if that makes anybody feel better, right, there's, guess what, 8 other sectors, and they're all higher today, besides tech and comm services.
Yeah. Oliver, the comparisons to the U.S. markets are real simple. If you think Alibaba and Baidu and you compare it to the U.S. stocks, think Amazon and Google. And those are the equivalents to Alibaba and Baidu. And they're taking big numbers out of all of these stocks. So really incredible. And we were looking at some of the numbers today on Tesla, Oliver, and it's getting back. Remember when they announced this in about November, on or near about November 16th, they announced it would go in the S&P 500, and it went from 408 to 440, and then it went right to $695 between that date and the 18th of December. So it is pretty incredible, the percentages that they're taking out of some of these names, including a high flyer like Tesla. Obviously, that ARKX ETF is going through some interesting times because they're heavy into Tesla, as long as some of these other growth stocks. That doesn't mean eventually that some of these aren't a buy. I'm sure at some point they will be, but boy, the pain, the percentage numbers, the corrections that these stocks are going through is not insignificant, Oliver.
And Kev, what do you think about, from a trading perspective, strategies that make sense in a market that is dropping this quickly? Okay, let's say, for example, let's just go with Tesla. Let's bring up the chart for Tesla here. I would argue that some of the China stocks look like they might be hitting a little bit more support levels. But for Tesla, it's hard when you move so quickly to the upside, right? That's kind of what I've learned from the technicians is you think about areas where things went sideways that then become support later on, or areas that were tested previously. For Tesla, you don't really get a ton of that until we're kind of back in the 4-handle range. So let's say if you're waiting for a time to get in, let's say you've got your target in mind around some of these areas, what kind of trades make sense? Sure. Do you need to approach it in a way where it's braced for deeper downside, looking at diagonals, spreads, et cetera? I mean, how do you kind of go about that if you dare to catch a falling knife?
I think you just touched on it right there, Oliver, and that is the diagonal spread. That diagonal spread is basically a calendar spread strategy with an embedded vertical spread inside it, right? It's the calendar where you're buying the longer term, selling the shorter term, but different strikes, which is giving you a little bigger delta, a little more directional lean in that number. And then what I would do, Oliver, is average in. right? Don't get all in at one price. Buy it over a couple days, and if this keeps falling, just average your price in to the amount that you want to invest. But if you look at Tesla's chart like you were just doing, Oliver, it looks like this gap when they announced the move into the S&P 500, like November 16th, 17th, that's in the low to mid fours. That looks like an interesting area where this stock could get back to around 450. A lot of support down around that level. Besides that, boy, you've got some room here in terms of filling that gap and working a way to real technical support. It went up so fast, it's hard to determine what support is on this chart now. And the price discovery going on in Tesla right now is vicious.
Yeah.
Oliver.
Yeah. Okay. Kev, thanks for the thoughts here. Appreciate it, Mr. Hanks. Co-host Fast Mark. Good stuff. Let's talk some options trades that have already happened. Tom's got a few for us, and we're going to shift gears a little bit. Talk about the stuff that's working. Because even though the NASDAQ is dragging, and that's where a lot of folks have been trading, there's some serious upside happening and major bounce backs in some of these reopening trades.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, ThinkOrSwim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today. Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
After getting caught up in some of the downside last week, we are seeing a pop in airlines and reopening trades. Tom White joins us with some options here this afternoon. Tom, let's go to Delta first, as you saw a bullish trade happen here. Delta did get hit on Friday and Thursday, slipped last week, but now the whole group is bouncing. Delta's up about 3.5%.
Yeah, and if you look at the TSA numbers over the last 6 days, Oliver, I think three of those days were over 1 million travelers, and that's good news for the airlines, along with all that support they're getting out of Congress and the additional dollars. With the reopening trade taking place due to the vaccination footprint starting to widen, everybody wants to travel, Oliver, and you're seeing that reflected in all the airline stocks today. And if you look at what they were doing in here in Delta, there was a lot of call buying in every name, whether it's American, United, Southwest, also above $60. They were in there buying short-term options in most of them, and Delta was the same way. In the March 12th weeklies that expire this Friday, buying just out of the money calls to the upside. Trader came in and bought 7,000 of those 49 strike calls for an average debit of only 45 cents. Now, that takes a break even up to $49.45 over the next 4 days. It's about $3 above current share price. Call volume's nearly double the normal daily average volume that we see, but A lot of inflows, and we typically see this anytime the airlines are up. Everybody comes out of the woodwork expecting more gains for this name. And with Delta up already 18% this year, it wouldn't be too far-fetched to see it trade back above 50, which it did just about a week and a half ago.
All right, so look, 49 strike. I mean, you're not asking for a lot here. Just got to get back to where we were on Thursday. But it seems like a pretty straightforward buy the dip.
Buy the dip, and if we start or continue to see these TSA numbers, you got to remember it's spring break time. People got vaccinated. They're comfortable with traveling now, and that's only going to pick up pace the more people get vaccinated, Oliver. So, I think it's bright, next 6 months for these airlines as people start getting back to traveling, and also these airlines are going to start increasing capacity. One of the headwinds might be fuel costs rising. But I think the demand is out there and the optimism that travel is going to really pick up quickly.
All right. And kind of per usual, we see some of the similar dynamics where among the airlines, you've got American doing really well. Southwest in particular still is kind of that first stage we imagine to be domestic focused. Southwest trading today at the highest now in a year. So it's really breaking out as opposed to a Delta that's still below the highs from the past week. But it does seem like this group continues to follow the direction of Southwest in general. So you got a bullish trade, Tom. However, on a similar kind of demand notes and recovery notes, you've got a trade in USO, the crude ETF, but it's in the opposite direction. Someone's going with the drop today, the first kind of real sell-off we've had in crude in a while.
Yeah, and if you saw that crude almost hit $68 a barrel overnight, and I think somebody's trying to pick a top here in crude over the next couple of weeks. And if you look at, just some of the data that came out, we saw some draws finally in inventories, or actually some builds in inventories last week. The missile attack out of Yemen against Saudi Arabia, that was a concern, which popped it. Oil hit 2.5-year highs. And if you look at what this trader is doing, he's going out to the March 26th weekly series. So you've got 18 days until expiration. They were in there buying the 44 strike puts, which are just out of the money to the downside here, or at the money basically. They bought 60,000 of these puts for an average debit of about $1.58, Ollie, and that takes a break even where they start making money at expiration down to 42.42 over the next 2.5 weeks. Put volumes over 3 times normal daily average volume. And if you look at this oil ETFs, already up over 30% so far year to date. So somebody picking a top here in crude, expecting us to some weakness over here in the next 2.5 weeks.
All right, looking at USO to drop below $42, which will take us, back a few sessions. Crude's been moving quickly higher, and WTI at $65 now. The breakout around that long-term downtrend was back at like $60.5, $61. So it seems like we could easily kind of go back and test that without breaking down in this big rally we've had. But someone's certainly betting that we do at least kind of test a pullback here for that trade, it seems like. Tom, last one, let's go to tech. Let's talk some Apple here, where the NASDAQ's down, tech's down, and Apple down 3.5%. I mean, it's not Tesla percentages, but it's the most important company.
Yeah, it's pretty astonishing, the slide that we've seen in the stock. I think it's pulled back about 18%, 19% from those all-time highs that we saw earlier this year, and that's a concern. But if you look at the volumes here today in trading options, call volume's still over 1.1 million. So there are still some people trying to pick the bottom here in Apple on this slide that we've had over the last couple of weeks. But I thought what was interesting, the trade that kind of stuck out to me, was somebody trying to sell cash-secured puts or just out of the money puts to the downside, collecting pretty hefty option premium as the credits are pretty big because implied volatility is expanding in this name. And it was in the May series, so you've got 74 days until expiration. Trader came in and sold 5,000 of the May 115 puts, which are basically at the money at this point. They collected a credit of $6.20 on that 5,000 lot. That takes a break even to 108.80 over the next 74 days. They're collecting $3.1 million in option premium. That's a max they can gain. But Oliver, this might be some big money manager that wants to buy the shares cheaper, and he can, because that break even where he'd actually have to buy those shares by collecting $6.20 is going to be 108.80. So somebody betting that over the next 2.5 months that we're going to see a bottoming in Apple and it's going to reverse. Now, if it doesn't go through that strike at expiration, you just get to collect that premium that you sold it for, and that's quite a bit of premium. As I said, over $6 that they're collecting. And, the flows are still positive and bullish in Apple, but the stock is not over the last couple of weeks as it is pulled back nearly 20% from those all-time highs.
Okay. Apple right now, 117. Remember the summer gap higher in Apple right before the September kind of blow off the top. That brought us up to $108, which is right where that break even is. So an interesting kind of way to view it on the chart, where this person is essentially betting that Apple doesn't go back to where it was in August. We're back to where we were in December. So we've definitely erased some gains. Tom, like the perspective here. Thanks for the options trades. Tom White's our contributor here on the TD Ameritrade Network. Let's talk more about crude in the commodity space. So we're going to check out the dollar's role in today's market. Then we're going to get details specifically on WTI. Be right back on the TD Ameritrade Network. NASDAQ stabilizing after making new lows about 30 minutes ago.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on ThinkOrSwim for the income investing course and a whole lot more.
What do you look for when you trade?
I want free access to research.
Yep, TD Ameritrade's got that.
Free access to every platform.
Yeah, that too.
I want to know what I'm paying up front.
Yes, absolutely.
Now offering 0 commissions on online trades.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
I'm Maria Schrader. Here are a few stocks moving this hour. Viacom CBS reported that Meghan Markle and Prince Harry's interview with Oprah reached 17.1 million viewers. The 2-hour special was the most watched non-Super Bowl Sunday primetime event in over a year. The CBS app hit #1 in Apple's App Store, and Viacom CBS shares hit 52-week highs today. The stock is up over 12%. Ross Stores announced plans to open 60 new stores in fiscal 2021. 40 will be Ross Dress for Less stores, and 20 will be DD Discount stores. The company currently has 1,866 stores and sees the number reaching 3,000 in the long term. Ross's CEO, Barbara Rentler, said she believes Ross and DD's are well positioned in the off-price sector. Ross Stores is up almost 7% today. And Kelsey Advisory raised Ulta Beauty's price target to $375 from $315 and kept an outperform rating. JP Morgan also maintained its outperform rating and raised Ulta's price target to $350 from $315. Ulta's fourth quarter earnings are scheduled for after the bell on March 11th. Ulta hit a 52-week high Monday and shares are up over 4%. This has been your TD Ameritrade Network Market Update. Now back to Market on Close with Oliver Rennick.
back to Market On Close. Let's talk about the dollar as the U.S. greenback finds buyers today and now looks to be establishing maybe a little bit of reversal. Chris Robinson is joining us, head of Robinson Ag Marketing at TJM Investments. Chris, is this dollar for real? Should we be thinking about where it can go to the upside now instead of the supposed reliable, definite downside?
Yeah, it obviously looks like, for better or for worse, we've caught a bottom here. A lot of people are looking at the fact that we did have a 15-cent break, right? From this time last year, we were at 18-year highs. We dropped to 3-year lows. So now we're on the correction mode. We've pulled back and corrected about 25% of that. So guys are looking up now. And I'm a big believer in the Fibonacci's. Anybody that's followed me or read my stuff knows that more often than not, those things come into market, especially in the widely followed markets. You just saw a lot of technical influence in the gold market. You're seeing it in silver, and you're certainly seeing it in the dollar. So what does that mean? We play these retracements, right? So we've had a big down move. We've recovered 25%. The next level guys are looking at is 38% and then halfway back. But, it's not that it's surprising. I compare it to, what happened last year. We threw a bowling ball into the kiddie pool. So the markets are now repricing that. And it's not surprising to see that. The nice thing I like to see is, we're always taught since the time we're in high school or college that, the rising dollar is bad for commodities. Well, the commodities are shaking that off. Here's one of those crazy cases right there where the dollar is rising, but it really has not had a tremendous negative impact in a lot of commodities. So all in all, I wouldn't be surprised to see another move higher. Again, we did get very, very oversold after what we just went through here in the past year.
Chris, what's so interesting about the dollar, to your point about the correlation breakdown with commodities, notably crude in specific, right, as the dollar bottomed out, basically right as we started the year, the dollar bottom was like the first day of the year, right around there. Since then, obviously, we've had really impressive moves in crude oil. We've had a sustained rally up until the last couple of days in copper. You and I have talked about some of the ags as well, which are now a little bit more of a mixed bag as they pulled back. But it seems that we're touching on something really important here, which is that the dollar is correlated with some of the same things that are pushing some of these ags and commodities specifically, which is rebounding economic growth, right? So for about a year, the dollar was the only place people went to when things were getting bad, and the dollar was kind of safety player. Are we seeing that change a little bit, where the dollar is now kind of moving with economic prospects?
Yeah, I believe so. Like I said, it was a lot of waves came through from that move. And first you had the panic. Now you're having people reassess where they want to be. So you've seen money come into commodities. And so I think that we're probably in for a rebalancing. I wouldn't be surprised to see the dollar move up a couple more pennies. And then at that point, then you're going to start people start yelling, oh, the dollar's too strong, the dollar's too strong. Again, just a month ago it was 2 weeks. So it's you look for that Goldilocks market. I think sometimes people can put, in my experience doing this for 30 years, people can put too much blame and give too much credit when the dollar moves. We've got a real commodity market for the first time in a decade across the board. And I think the dollar may actually become a secondary issue here. This is a demand-driven market across. You've got the worldwide economy rebounding. You talked about copper. That's a great indicator of what's going on in the rest of the world. Take a look at Malaysian palm oil, 13-year highs. We just had a really nice rally in crude oil. And so all in all, I think that the dollar may actually kind of get out of the driver's seat and move into the passenger seat here for the next 3 to 6 months.
So it sounds like you believe some of these correlations could continue as commodities rally. Maybe the dollar doesn't have to drop. Very interesting. Chris, crude specifically, if we zoom in there for a sec, last week we were watching really carefully the breakout from a chart that you first, I think, brought to my attention. I should probably give you credit. I think it was you that just drew what seemingly is like a simple, obvious line, but nobody else is really talking about it, Chris. And crude broke on through. Is this downtrend from highs that date back like 2 decades? So was that a for real technical break, or how do you view this right now?
Yeah, I think so. I mean, we got to that 63.50 level. I mean, it's not rocket science. Anybody with a ruler can figure it out. It's especially older guys like me that used to do our charts by hand with the paper and pencil. You just look for simple lines like that. And 63.50, 62, 63, They're not precise, but boy, you got right there. And now it looks like a lot of people, if you pull that chart up, or if you can take a look at yourself at home, a lot of people have now bought that new high. So we're in for a kind of the next 2 or 3 weeks is going to be interesting. Everybody that just bought this on the high, did they make a mistake and get in too late? Or is this really something where we're going to go head back up and be around that $70 level? I think a lot of people have got $70 kind of on the brain. Everybody knows that that's a level that most of the frackers in the U.S. need to be profitable at. And so, again, I'd watch that very, very carefully. We may have gotten a little bit overdone. There, you can see that there on the chart right there. But, in the meantime, that's a very key level to watch. Bull or bear, you got to watch that trend line. I don't care if you're a bull or a bear. If you're long, if you're betting we're going to go higher, you better have a sell stop. And if you're short, by all means, you better have some calls on or a buy stop, because if this thing has another leg to go, you don't want to be short this thing if it keeps going higher.
Okay. So right now, $65. Certainly some drama building, as I like to say, for WTI, potential break of a very long-term downtrend, but clearly something weighing today and a little reversal of that. Chris, thanks for the perspective. Really good stuff. Always really good conversation talking commodities and the role of the dollar, and I think an important message about the greenback moving in line and not derailing some of these moves. Chris Robinson from TJM Investments, the Robinson Ag Marketing Group. When we come back, let's get specific on one particular company. One of our recent guests and contributors here on the network running an active ETF called me last week and said they were short DoorDash. Sorry, I didn't get them on earlier. Dash is now at the lowest that it's been since their IPO. We'll hear the short case for why there's more to go.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade network.
Welcome back to Market on Close. I'm Oliver Rennick. We've got about 11 minutes until the final bell. The NASDAQ still deep in the red, down over 2%, but we're seeing a broader washout across a lot of different styles of investing that have worked, and that includes recent IPOs. We're going to hear the case for going short. One of them now, Vince LaRusso, joins us from ChangeBridge Capital. He's a co-founder and portfolio manager. Vince, you guys called me from your team last week and said you were getting ready to go short Dash, or that you had already in the ETF. So apologies to my viewers. I should have brought you guys on earlier. Walk me through the case here now that we're at the lows this thing has ever traded at.
Yeah, hi, Oliver. No need to apologize. And to the contrary, thanks for having us on your show.
Thank you.
ChangeBridge long-short equity ETF does have a short position in DoorDash. Your viewers can see that on our website, changebridgefunds.com. We list all of our holdings as of the prior day close. And frankly, we still think there's an opportunity to be short DoorDash. The recent sell-off probably driven mostly by this rotation from growth to value. But our positions are more driven from a fundamental security analyst perspective. And as it relates to DoorDash, frankly, they've had a remarkable run since the company's founding in 2013. They now represent almost 50% market share for the online delivery segment of the U.S. restaurants. And we think the headwinds are about to build for this company. The reopening trade, the reduction of some of the restrictions on restaurants are going to drive consumers back into restaurants. And we think more difficult times are ahead for the business. That's not to say they haven't created a great network effect and a wonderful partnership with, frankly, so many of the restaurants and consumers, but it's going to be really difficult for them to grow into the valuation that the market's currently ascribing the business.
Well, it's definitely getting revalued right now, so maybe not quite as much to expect. We actually just dipped right before you came on another $5 to 130, so down 13% on the day. Dash really just getting tossed out right now. So about that network effect, Vince, I'll try and take the other side here, which I hear a lot about this pandemic period as being sticky in nature for those who had to change their business models. I have noticed that as
All right, guys, we're down to about the last 10 minutes of the market today. So far, been a decent day for Dallas with the news of the stimulus. Looks like we, at least at one point, increase it out at a record high. NASDAQ still taking huge hit. It's just this rotation toward stocks or tech growth stocks, I should say, and just kind of your standard stocks that are going to come back around for both stimulus reasons and for vaccine get back to normal way of life. So these are airline cruises, travel, other consumer goods coming back in the past week as those things rotate out. Huge number for people that have invested heavily in growth tech. I'm one of those. I've got about 2/3 of my portfolio in this growth tech markets. So it's been a difficult ride the last couple of weeks. Although there are some individual stocks that have hit much harder the last couple of weeks that I'm not as heavily invested into. Tesla's going down a significant amount. I have 3 shares in Tesla, so crazy about my cost basis analysis or my cost basis average, and then I've made money in the past off of Tesla selling some. So what I currently hold, I'm even, but overall up on Tesla over the past week. Kind of what I was saying earlier in this live stream about Zoom as well. So Zoom is obviously just going to be destroyed today and over the past couple of weeks. It's really quite unfortunate, especially after its strong earnings shot. It's down another 8% today to 309. Peaking over 300 points today. I don't think so. No, it's at the lowest point right now. So, geez, man, last time it was below 300. Might have been below those earnings in the fall. Looks like it was. It was below. It's lower now than it has been all the way since September when they had a huge earnings finish after the summer. It went from 300 to 450 in one day. So, in fact, it's 450 back down to 300 barrel into 3, 4, 5 days is very, very, very interesting. So that's another one. If I sold those earnings at $250, let's say I've got 26 shares. So 26 times, let's say, it's just $3,900. $3,900 I lost. That's what I lost. I not selling my released earnings just 5 days ago. So yeah, it really sucks. It really sucks. I expected to tank the day like it did. So one of my favorite stocks over the past year is TQQ, which is a leveraged version of QQQ, basically also heavy stock, and it is down with 3% today, only 77. That is a fantastic stock to have, both short term and long term. Really, most people would never recommend a long leverage stock like that, but it has just been so historically fantastic. ride the downs, and then stay on for the ups or buy the dips as well. It can still be very, very beneficial. I own it currently. I bought it so many times in the past. I currently own it only $70. So even though it's gone down insanely from 100 down to 76 right now, I'm still profitable in its current version. So that's how good it's been over the past. See, Snowflake's way down. AI is way down. Both of them had a good day last week after, so it's interesting. Um, Bed Bath and Beyond is back up 10, 11%. Express is flirting $4 again. So overall, fantastic day for Express. I obviously want it to keep going up a lot more so I can get back to a break even point with them. And a pretty darn good day on crypto. All major cryptos. So interesting day. Anyway, let's see what happens here in the next 1 minute.
Is really dumping all of the quarantine stuff, rallying, reopening trades. Expedia is one of your guys' big long holdings, and as this stock is up today in a down market and it's breaking out, I mean, are these reopening trades not also getting a little bit extreme here? I mean, Vince, there's still not a lot of options for me in terms of what I can book. This is like, how many months in the future now are we looking?
Yeah, it's a fair question, Oliver. And frankly, the valuation case on Expedia doesn't look like one of those kind of parabolic moves that we've seen from some of the other businesses. If you look at that valuation relative to Airbnb, still quite cheap. One of the big consumer structural shifts that we think has happened during the quarantine is the shift to vacation rental by owner. So Expedia, with a big presence in the VRBO space, continues to take share, continues to grow even during the lockdown period. Our sense at ChangeBridge, and it's the reason that Expedia is a holding in both CBLS, our long short fund, as well as CBSE, our long only sustainable equity fund, is that as consumers reemerge and reopen and get back to travel, VRBO and vacation rental by owner are going to take a higher interest. You see millennials and younger demographics moving towards that option. It tends to be more economical, more enjoyable, more flexibility. So we think they're a long-term gainer, and the near-term lift that we've seen in the share price, we think it's warranted.
Okay. Vince, thanks for the explanations here. Short case and a quick update on the long one, too. Thanks a lot, Vince. Good stuff.
My pleasure, Oliver. Nice seeing you.
Thank you. Vince LaRusso is a co-founder and portfolio manager at ChangeBridge Capital. Dash at its all-time low. Equities pushing lower into the close. We've got 3 minutes. We'll come back and sift through some of this rubble in tech. Man, what a rough day. After $2 trillion, markets can't stay higher. The S&P 500 also heading into the red.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our Active Trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
"24/7 access to diverse global markets. Right here. That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready. Well played.
I want free access to research.
Yep, TD Ameritrade's got that.
Free access to every platform.
Yeah, that too.
I don't want any trade minimums.
Yeah, I totally agree. They don't have any of those.
Interesting end here to the day. Bell just rang. S&P 500 actually finished down for the day. The last 30 minutes of trading was terrible for the S&P. Dow was down also, but it stayed above the mark. So it ended one percentage point over 305 total points. A couple things worth noting also. We see crypto going up here through the afternoon. Oil's going down. It's kind of interesting that oil's had a massive surge over the past month and really over the past week even more. And then this morning it peaked out at $70 or $67 and something, nearly 68, and it quickly has sharply gone back 4% down to only 64. So I don't know if that signals some sort of a lower shift in the market, but it is a pretty significant downshift after a pretty previously significant increase. But we're seeing some huge increases. Dogecoin up, for example, 13% today to 5.8 cents. Since let's see, the past week or so, it's up nearly 15%. So I think that even Dogecoin is starting to get a little traction here. Treasury interest rates have stayed pretty much the same all day today. Hasn't changed. 1.56%. Sorry, 1.596%. Hasn't changed yet much today, but in the past week it's up nearly 10%. So, very, very interesting day with the Dow hitting an all-time high at one point today. Meme stocks going up, but tech still getting crushed. So it's just a tough one overall. But overall, hopefully, you guys have more winners than losers. I am very excited about getting my money back on GameStop and Express back on significantly today. And of course, if I can earn money on one, lose money on one, just gives me the cash to go reinvest in some of these others and buy at a discount. I think huge decreases Zoom and Zillow and TQ continue with AI. Huge opportunities to buy at a discount. So if you have a little cash, you can always look at those. That's where I'm looking at. Again, I'm not advising you on what to do. I'm just letting you know what I'm doing. Lemonade also down a ton. Lemonade, I think, is a huge value opportunity here. Its peak was at 188, and now it's down to 86. Just 2 months later. So I think it's a good opportunity to get back in now and ride the next wave. And it's going to ride the wave of tech stocks going back up. It'll be a good one, I believe. Looks like they're talking about GameStop and some others here.
Be more e-commerce, more technology. And don't forget, they hired out an executive from Chewy to do that, and he will head this board to do this transition for GameStop. So are people really believing that GameStop could be the next great thing in e-commerce and sliced bread, or is this more of the frenzy? So they did appoint a chief technology officer for this, and you did have Ryan Cohen to lead this shift, and he came from Chewy. He was a co-founder there to move this company away from physical stores and focus more on online. Is this enough? It certainly contributed to the stock's wild rise, and you can see 41%. I'm not sure it's worth 41% worth.
Yeah. All right. Hey,
right?
there's
come on.
Clearly some people still are not on the wrong side of this. Who is still trying to short GameStop? It's just why try and get in the way of something that keeps, burning you if you try and get short. I do think that still plays a role whenever we have these big gappy moves. The stock is not going to go down without a fight. It seems, Nicole. We've got Roaring Kitty tweeting out exciting stuff. That he's still got an army of traders. It's just don't expect this thing not to be wild in both directions.
And then we knew it was wild, and we even said when it was getting down to 70 and 60, I said, when it starts to get around this level, I said, what stops everybody from doing this again? And the cards had changed, right? Because you didn't have the same number of shorts that needed to cover. It was completely different, but they did it again. And, so you got to watch some of these names that are, on the Wall Street Bets and Reddit and all that. So beware, but you can see the volatility is certainly existing here. 41% at 194. The other name I'm watching is Gap. And it's interesting, right? Working on a deal with Kanye West, the Yeezy partnership for apparel and all that. So that'll be happening in the first half. But a few price target hikes from Deutsche Bank and Barclays on the Gap. They've been closing some of the unproductive stores or underproductive stores, Gap, Banana Republic, and they're going to be opening up some more Athleta and Old Navy stores. Those seem to be doing a little bit better for the company overall. And so you do have now Deutsche Bank $31, hold, Barclays $32, and they have an overweight, which isn't a huge move because right now it's around $29, so they think it has a little bit of upside. But it's pretty decent considering we've heard some mixed reports from the Gap over the years, right? We always hear that the namesake's struggling. Banana Republic was doing a little better, but it seems that Old Navy and Athleta are now the best parts of the Gap these days.
I will say, as a longtime Banana Republic consumer, well, I should shift that, as it was an aspirational product for me for a long time, but now it's much more affordable. So some of these things, they're cutting their prices, and it seems like Gap is trying to kind of get in line where that store's average price tag now is much lower than it used to be Banana Republic. To your point, the real success story has been in Old Navy, but then you throw the Kanye thing into the mix, and all of a sudden it's kind of got this cool vibe to it the last 8 months, and suddenly Gap is like one of the best reopened trades out there, it seems.
I can't get over it. Right? I can't get over it. And I think you make a great point because I was in the same position. You know, when you were, young and walking, you went into Banana Republic, and they had a lot of things that were a little bit dressier. You could wear to the office, but it was a little bit out of the price point, unlike the Gap, which was a lower price point. So that's something to consider. It was a little bit dressier. And then you have the other side of the coin, Old Navy, which is the most casual of the three. And now you have Athleta, and you use the word cool, and that's exactly what they're going for. Coolness. I mean, if you are out of touch and have nothing to offer younger folks, you're out. So you better bring something in that's cool. So we think that now we'll have to watch what Kanye West and his team bring for apparel and Yeezys and all that with their collaboration with the Gap. So that's something to watch as well. I mean, the stock itself, as you talked about the reopen trade, just to give people 6 months up 63%. The Gap, 63% in 6 months. I mean, that's a big move.
That's amazing. So Gap,
I don't even know how to quantify it. I mean, to say it's a big move, it's like it doesn't even quantify. It's an unbelievable, astronomical, unprecedented, who could have thunk it move.
It's like the most hated companies turn into the favorite. Every day it's amazing to see it at the top of the list. So we're going to wear Gap while we take United Airlines to go to Disney World, and that's the story of the day, basically, as those are your biggest winners. We also had TJ Maxx, nice day, and Ross stores too, but yeah, just a pretty amazing clear message being sent by this market. Nicole, appreciate it. Thanks for the update. We'll see you ahead of overtime. Let's bring in Alex Coffey and Scott Connor for some more sartorial commentary here. Alex is co-host of Fast Market. Scott's the director of trader education at TD Ameritrade. Okay, Alex, this market clearly is sending us a message, right? We're getting ready to shop for clothes, travel, and have a party, baby. Just make sure you're not in growth stocks, apparently. So is that going to ruin the party?
Potentially it actually will, and I think the reason is we know that there's so much exposure to this space. I mean, you look at the S&P 500, you look at the NASDAQ. The NASDAQ's really taking it on the chin right now because of its exposure to mega cap tech. Over 50% of the index is comprised of 5 names. You throw Tesla in there, I'm sure it even gets to a greater percent, probably pushing 60%. And so the S&P 500, it's closer to 20-25%. But at some point, not simply just because of the mathematical weight, but we know that, investors are interested in these names. These are the names that have done the best. And so there's an outsized exposure to them. And when you start seeing parts of your portfolio, potentially the core positions of your portfolio underperform, it's not necessarily the time that you're expressing greater risk. And at times, maybe that is the case. And maybe this is simply, not to oversimplify things, but investors rotating out of those positions. I'm not a huge fan of using that because I think it oversimplifies the issue. But at some point, though, there is an analysis taking place. It's taking a look at the environment that we're in, one that is perceived to be one of higher interest rates and greater economic growth. Although a lot of the growth is just getting us back to where we were, it is a little bit more of a cyclically driven time period, at least it seems, and we know the market's looking forward. So while you had NASDAQ outperform, maybe looking ahead to now, as we've seen the tech names have done so well for so long and their numbers continue to be great, now we're looking ahead to a time where maybe names like the airlines and retail stores start to outperform.
Okay. Scott, what about the idea here that maybe you can just kind of go through this painful period of valuation correction, and then once tech is a little bit depressed and back to something more normal, the market can continue this kind of traditionally economic-driven rally? I mean, I know this is a very difficult question. Everybody's trying to figure this out. We don't know the answers, but the point Alex brings up here as well, there might be so much corrective pressure that tech needs to go through that may not be an obvious bull case for the overall market. What do you think, Scott?
Yeah, I think that's true. I mean, it's early, and it's difficult to say. You mentioned just earlier how it's a very difficult market to read right now because of the choppiness and intraday volatility. And you mentioned the Dow Jones hit an all-time high this morning, and that's absolutely true. But at the same time today, if you look where the NASDAQ finished, it's in a full-fledged correction. It's down 11% now. If you go back to the highs on February 16, down 11 point something percent. So there's really some divergences going on here, and I think that's why a lot of people are finding this a very difficult environment to make decisions on, and which sectors are going which way. But, you know, there shouldn't be any big surprise. We've been talking about this rotation out of tech and into small cap value for 3 or 4 months now, and maybe it's just kind of crescendoing. What's the word I'm looking for there, Oliver? But anyhow, that's what we're seeing. And again, it's difficult because we get these snapbacks every once in a while, but the overall trend seems to be continuing. Right now, anything that could suffer from higher interest rates is suffering, and anything that could benefit from that is benefiting. And again, look at techs and financial. Put them back to back and pretty much paints the picture. But I think it's interesting what you were saying before is that, you know, you thought with the Senate passing the 1.9 trillion stimulus that it would be all the coast is clear going forward. Well, it kind of started out that way. But I'm like you. I did not like the way the market finished today. Very indecisive. Shows me there's still some uncertainty in the marketplace. So that's one thing I think on a day-to-day basis concerns me. But there was an interesting fact that came out, and Oliver, stop me if you've already talked about this, but Goldman came out and they look at their demand for equities next year or this year for the rest of 2021 from homes, households, meaning retail traders like you and me, and then what about corporations? And in terms of the demand for equities, and pretty surprising numbers. They're looking at equity demand for stocks this year to go to $350 billion, and that's from $100 billion last year. Now they're looking for corporations to go to about $300 billion, and that's almost double what it was in 2020. So they're really looking for a lot of money coming off the sidelines from both corporations and the buying public, if you will, to support stocks. Now, that's the kind of thing that can really help stocks stay afloat as long as earnings don't plummet and something unforeseen doesn't happen. So I think that paints kind of a positive picture going forward. But right now, there's just a lot of short-term uncertainty, Oliver.
Well, I will say also the Goldman team put out a note from their economists estimating that we get back to unemployment of 4% by the end of the year, 4.1% to be precise. So we're currently above 6%. So certainly a bullish economic case being made there. We're going to get stimulus on top of it. How important is that context, Alex, as we analyze today, that this is on the back of the much-awaited, months-long buildup for stimulus that we now know is going to get passed later this week, and that this is going to be working its way into the economy? So the fact that it's telling us it's fully priced in to NASDAQ and what else? Dollar? I mean, isn't this a little bit troubling for many people's theses about what's going to drive this market?
Yeah, it possibly is. And Oliver, I'm going to answer your question. I know you're a cards player, so I'm going to use some concepts from the game of poker to kind of.
I'm familiar with this game. Yes, I've heard of it.
And so one of these is one that we've talked about quite frequently, which is really just a fancy way of describing risk and reward, and that's pot odds. So when you talk about some of the movement you've seen in the NASDAQ and Apple and some of these mega cap names, they're certainly discounted to prices that they traded at months ago. or even in some cases weeks ago. That makes them a little bit more attractive potentially to investors, particularly when you look at some of the reports that they've came out in recent fundamental updates. I mean, Apple, monster report. I keep talking about an $8 billion beat on the revenue estimate. That beat alone, just the number they beat the estimates from analysts is more than 99.999% of companies will ever generate in the history of those companies. So it's incredible for the stock to have still been significantly discounted. But the second point is actually one that I don't know that we have talked about much, and it's a concept that goes by the term of leveling or multiple level thinking, I think is another way to talk about it, where in cards, essentially, a level 1 player considers their hand, and a level 2 player considers their opponent's hand, and it goes down the line. The market is not a level 1 player. It doesn't just look at all of these pieces of information and then suddenly we reprice it because, oh, we got this COVID-19 bill that came out today and it was signed. That doesn't necessarily move the market. Oftentimes, this was considered and thought about 6-7 months ago, and it's not only been priced in, but it's been priced in for a long, long time. And so we're looking beyond. Are we going to need more stimulus? At what time is the market going to be, the economy going to be fully open? For Goldman to make those kind of calls, they're not even considering stimulus. Stimulus has been a factor leading up to their decisions going forward, but they're thinking 6-7 months down the road to get to 4% unemployment isn't $1.9 trillion coming in.
One of the things they have listed here on this, on what he's talking about is CRM. I mean, Microsoft's going through a crappy period right now, and then they had this security issue happen on Friday or Thursday or Friday, which might also hurt them. But Apple just doesn't have a lot of momentum. Of course, they're going. There's all the tech sectors going down. CRM, CRM is Salesforce. And Salesforce absolutely demolished their earnings. Also, about 6 months ago, that was great. I bought it after that. Okay, we're going to continue to go well. Then they announced the acquisition of Slack. That actually brought their price slightly down. I thought it was going to continue to have to do them to do well through the rest of this whole pandemic period. And it really hasn't. I tell you what, since I bought them, let me see what it's worth right now. Overall, it's down 1.4% in May. Overall, it's down 22.37%. I've sold some of it since then. I've sold some of it at a gain. So my overall, it's not down that much. It's only down $74, but on my current holdings, it's down nearly $300, which is 22%. So CRM just hasn't performed. And it's likely because that'd be like buying Zoom right after their earnings last week and seeing it take nearly extreme. Same type of thing. But after the earnings, boom, last fall with CRM, it's just been a dog ever since. It's really too bad. I think it's a great company and should thrive in this market, and it's just not working out. So I'm optimistic about Express. I was really bumming on Express here a couple weeks ago. It was down to the mid twos. Really hell, it's in the mid twos on Friday. Now it's up to nearly four again. Ford, I have one share of Ford. Shouldn't have sold it when I did. I sold in it when it was peaking in the fall. Should have held it as just a cyclical, come around because now it's up to 20. So I think Ford's in a great position. I think someone like Newsom or Cosar going to do well. Fisker, Fisker is FSR are going to do well in the market of the EVs coming up. But I think the smarter long-term bet is Ford first, GM second. I think both of them are actually they have the infrastructure power behind them to continue to do well. Even though they're not valued as high, I think they're going to do much well. I'm surprised I'm not as optimistic about Toyota or Honda or Volkswagen. Any of these guys, it's not just because they're foreign brands versus American. I feel like Ford and GM have really caught up and possibly surpassed Toyota as far as innovation in that space. And I think Tesla is helping push that being an American brand as well. But I'm just not that optimistic about Toyota. Not that it's a bad brand, it's a fantastic company, fantastic brand. Very, they will withstand bad markets very, very well. But are they going to be the next Tesla as far as growth and acceleration? No, I'm not as optimistic. I'm much more optimistic about Ford. And Lucid, FSR, Workhorse, some of these others, they'll do well in the short term. And you've seen that in the past. It's gone spike way up and really goes. So if you're in it for a short-term gain, a boost here and there, then great, go for it. I think that I think they're great. Long term, though, I'm not super optimistic. There'll be one or two of those companies that will survive. There will be stuff. I don't think you're going to get into another Rivian and think Nikola and think it's going to be the next Tesla. It's just not.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for
Wall Street today. The NASDAQ and technology tumbled while the Dow rose a few hundred points. Let's go back to Mike Santoli taking a look at the recent changing trends that we're seeing in investing. Mike.
Yeah, so we know that money chases performance. Money chases the hot story. That's going on right now in small cap value funds. This is the cumulative net inflow into those types of funds. This is 2021 to date, and this was for the full year last year. And you saw, of course, after the election, things just shot higher. By comparison, large cap growth, which is kind of the polar opposite of small cap value in terms of size and style, has lost more than $4 billion cumulatively to date right now. And you can imagine the same amount of money in small cap value goes farther in terms of driving those stocks up. So the concern becomes, where's the hot money going, and is it going to cool off? This is a look at thematic ETFs as opposed to all other general sector ETFs. Now, this is a left-right scale. This is actually not even an amount, but it's about 10%. It just shows you the fast growth in thematic ETFs. What are thematic ETFs? Subsectors and trends, and some would say fads, right? So things like, alternative energy or cannabis or even some kind of particular strategy out there. That's where the money is. And so people really want to latch on to the buzzy thing as opposed to just getting broad exposure. So we'll see if that gets cleansed a little bit with this pullback in some of those story stocks in those areas of the market that have had a hard time in the last several weeks, guys.
What's this being offset by? Their outflows elsewhere, Mike, or is this cash levels coming down? Or
Well, it's both of those things because the overall fund complex equity-wise is getting net inflows. But yes, it's coming out of large cap core. It's coming out of even vanilla index funds in some weeks. So it's essentially people are not looking for the generic. They're looking for the particular and beta and the stuff that's moving the fastest.
Mike, thank you. All right. Women have been leaving the labor market in droves during the coronavirus pandemic. Up next, Bill and Melinda Gates Foundation co-chair Melinda Gates on what the White House and Congress can do to help make it easier for women to return to the workplace. And March is, of course, Women's History Month, and we're spotlighting some of our CNBC contributors. Here is Sandhill Global Advisor CIO Brenda Vingello on her advice on taking risks.
For most women, we need to spend time investing in ourselves to find our own voice and to give ourselves credit for our own strengths and expertise. I think so often that men will raise their hand or ask for opportunity, even if it's at the fringe of their ability, while many women choose safety instead of taking a chance like that. But I think for many, it can be very rewarding personally and professionally to take that chance, even though there is some risk of failure.
From a technical standpoint, the price broken out to some of the multi-year highs. And then along that line, as we look at the chart, you notice that gold horizontal line that's going across the price action. We had a breakout last month, and with the scare in interest rates and some repositioning in the market, prices pulled back to that breakout point, even kind of blew back into below that level. But notice that 50-day moving average, which is still rising, representing that trend. The price was able to right itself. Strong bounce on Friday and a little bit of a follow through today. But again, kind of a fade as possibly some of the risk coming off, as you mentioned, with stocks like in the NASDAQ and money flowing into more of the value plays.
So this one's pretty choppy compared to its group, right? I guess that's kind of what comes with being a smaller company, a pretty gappy chart, but one that still has held the overall trend. It seems, your point here, John, as we've still gotten higher lows on this thing pretty consistently, and though we did kind of have that weird up and then down around their earnings, but now we've stabilized after their earnings, which were at the end of last month.
Yeah, that's correct, Oliver. A little more stabilization there. And, as I look at a lot of these overlooked stocks, I kind of start with more of the value proposition. As, we know that growth has been taking a hit. There has been a transition in kind of more traditional stocks and looking for some of that value. And in the case of TriPoint, they are actually fairly good compared to the industry, even though there's been a little volatility recently. But from a value standpoint, they do fall a little bit under on what the industry trends are.
Okay. So right now the stock looks pretty good. Obviously a little bit less than the overall group, but one that has certainly gone overlooked for sure, meeting the definition. John, the homebuilders group over the past year is up about 50%, where TPH, on the other hand, up 42%. Maybe a bit of a catch-up play here to some extent. John, let's keep going. We got a few others here. I want to go to LPG. Dorian up 5%, has been fighting to push back to recent highs that it made over the past couple months. It's an energy company. Walk me through it. What do they do?
Yeah, so basically liquefied petroleum gas is what they're involved with. They're basically a transport for LPG. And, as we recognize, from kind of the freeze out there in Texas, a lot of supplies were not getting out. And so, basically a lot of the shipping rates, did take a little bit of a hit. There's some speculating that now, as supplies are more free flowing, kind of those shipping rates have bottomed out, which would give more upside to stocks such as Dorian. And, from a technical standpoint, that momentum started on Friday. Great follow through today, as you mentioned, the stock up about 5%, and really hasn't pulled back compared to other stocks today. Now, technically, it's forming what technicians refer to as a triangle, so kind of a consolidation as it whipped back and forth, through the travails of the winter here, but potentially setting up for a breakout. And on the longer term, if demand continues building on the reopening, not only in the U.S., but across the world, some speculating look for a greater demand for LPG. And with a break, if we see a break above that $15 area, that would also be a multi-year high. And, if traders are looking for some of the more of those commodity plays and raw materials, then, this is an example of one that may benefit from that, Oliver.
So this is an owner of the shippers, right? The actual, this is a shipping industry. I mean, I know it's energy, but they, through their subsidiaries, own the actual shipping in containers within the very large gas carrier space, VLGC, an acronym I didn't know before today, John. So this is not like necessarily just a driller.
No, it's the movement. They're basically moving supply. So when we think about, people getting out again, this is going to be a matter of, are these supplies going to be moving much more freely? Also consider the Middle East. There's been some attacks over there. There could be different, businesses that are utilizing some of those fuels may make more of a demand on the LPG front versus on the crude side.
Okay. It's interesting because it is in the energy category, but just want to make sure that's very clear. Some of these shippers Yeah, sometimes they're classified a different way, but the S&P indices, it's actually classified as an energy company, despite being kind of more of an industrial transport company in a way. So, okay, John, the pop here and then the stock, just real quickly to remind us, still uptrending, even though it's made a few lower highs. Maybe the momentum slowed a tiny bit.
Yeah, absolutely. And, you know, a lot of these supplies are in demand over in Asia as well. And so, you know, as we look in emerging markets and, you know, seeing how things are happening over in China and South Asia, you know, we can see a lift if we're seeing more growth in those areas, would put a demand for those shipping rates to rise and moving that supply overseas. And LPG would have a tendency of benefiting from that, and Dorian.
Okay. Hey, John, last one you've got, looks like the best chart to me, PBH, Prestige Consumer Healthcare, breaking out to the highest in at least a year, and the stock is the owner of a bunch of different types of over-the-counter medicine, Dramamine, stuff like that.
Yes, I guess saving the best for last, you know, from a technical standpoint, when we look at the chart, yes, the strongest trend, the price went ahead and broke out of what we refer to as ascending triangle. What's kind of ironic as far as overlooked, a lot of the maladies that this stock attempts to cure, Prestige Consumer Healthcare, such as Compound W, Beano, you know, things that we probably should overlook in the first place, right?
Dry eyes. They also have dry eyes too.
That's right. Yeah. So from a technical standpoint, you know, we broke above 45. That was the higher range over the last month. Notice the averages below continue to rise. We had a golden cross of the 50 crossing the 200. That's a sign of more of that longer term reversal of the trend. And, you know, these are the types of stocks that are going to have a tendency of benefiting, you know, when there's more of a risk off, kind of rotating in some of that value. And with the size of this range recently, about a $5 range in that pattern, you know, that would project a potential technical target upwards near around $50, which would be taken out some of the more recent highs over the last few years.
Okay. Really like it, John. A pretty interesting one here to think about on the radar as we find one breaking out to the upside. Healthcare stock, the whole group has been a little bit sluggish. So a winner here relative to the sector as well. Thank you, John. Nice work, Mr. McNichol, on the overlooked stocks. Let's talk more about the energy situation here. John, a little tease into this segment as well. After Saudi oil storage facility was attacked, we are now talking about geopolitical stories as well in the crude rally. But today it took a break, down 2%. Thought this was supposed to be good for WTI. We'll get the details next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, ThinkOrSwim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today. Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade network.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on ThinkOrSwim for the full options for volatility course and a whole lot more.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
WTI taking a dip today, despite what seems to be some pretty constructive news on the supply side after attacks on Saudi storage facilities. Let's bring in Ellen Wald, who's going to help us sift through both the demand and the supply side and the rallying crude that suddenly kind of stopped today. Ellen's the author of Saudi Inc. and the president at Transversal Consulting. So, Ellen, this seems like a story that would pop crude, but instead today we got a downdraft. What happened?
Well, I think what happened was that the market was definitely primed to go up after OPEC Plus, the meeting where they decided not to increase production despite the fact that everybody thought they would. And so there's this general feeling that the market is pretty tight right now. And then you have news of an attack on Saudi facilities, and immediately the mind jumps to last September when that attack on other Saudi facilities did leave the Saudis unable to export crude for a brief period of time. And so I think that's where everyone's thoughts went, and that's why we saw crude oil jumping initially. But then there came this realization that the attack didn't actually do that much to the Saudi facilities. They're still exporting oil just as regular, and so prices did come back down.
Okay, so right now it seems like we've got this still, even after this sell-off, right? I mean, not a lot of people expect us to be at $65 where we are. We were talking to technicals earlier on the show, Ellen, this kind of downtrend from years breaking. Kind of give me your overall take here for how reliable this momentum is.
Well, I think that I think it's actually more tenuous than people think, and we really need, I think, to look at what we're seeing coming out of OPEC. We definitely had some people who were saying, this is, we're in an upcycle. Prices are going up. The oil market is really tight, but there are signs that the tightness may be somewhat artificial at the moment. And I think that the Saudi oil minister and also the Saudi CEO of Aramco both alluded to these concerns when they spoke last week. The CEO of Aramco, Nasser, said that really they don't see demand returning to pre-pandemic levels until into 2022. And the Saudi oil minister is really looking at this with caution. Of course, he's got the benefit of kind of heading OPEC Plus, and they're going to be meeting again in a month. So if he feels that their decision to not increase production is causing prices to go too high, he can certainly reverse that within a month.
So what's our timeline here that we should be working on for the next update? When they tell us something, OPEC, how long does it last for right now, Ellen? It seems like maybe what you're saying is we should expect a little bit of high frequency kind of data and inputs here as they might change their mind if suddenly this thing really starts ripping.
Exactly. And OPEC has kind of moved to this every month or once a month meetings, which is really a big break from where they were meeting, twice a year and the adjustments. They weren't looking to make such adjustments every month, but they've really kind of embraced this idea that they're going to be reacting to the market, which is, I think, why part of the reason why people assumed that they were getting set to increase production by at least 500,000 barrels per day, possibly another million million on top of that for the Saudis to bring back this extra production they're holding off the market. And that's why everyone was very surprised when they basically decided to scrap all that. And a reason prices are really rising and look to go higher despite the kind of blip we saw with the geopolitical incident. Now, it does raise the fact that a tighter oil market means that geopolitics can play a bigger role in prices. And I think that we saw that in the brief jump up. People then realized that it really wasn't going to affect prices, but there is now this realization that the geopolitics of the region can really have a greater impact on prices than before, when the market was very well supplied or even more oversupplied.
So clearly we're going to have some pretty reflexive kind of moves in the WTI. Is there a level of crude, Ellen, where it's just impossible to imagine the Saudis not wanting to pump more and OPEC just looking at a WTI as too seductive of a scale play and volume? Where is that? Is it like 70 is your point here? It might be very close to where we are right now, or is it something beyond that where, okay, if they start pumping at $80, then they can enjoy a crash all the way back down to 50 and make money all the way? I mean, what's kind of the point where they can go, okay, even if we top the market here, it's still in our best interest?
Well, I think that's the question that everyone wants to know, because the prince basically said, the prince who's the Saudi oil minister basically said, well, you know, the era of drill, baby, drill in the shale oil market is over now. And I'm not sure that he's necessarily correct in that. We've definitely gotten a lot of messaging out of the big companies that they say at least that they are looking to maintain discipline, production discipline. They're not looking to increase. But you have to remember that the oil is in the ground, and if there's money to be made on it and people can make money on it, they will. The question is just, when can that production come back online? Right now in the U.S., we're down to about 11 million barrels a day. That's about 2 million barrels a day down from the height, which was 13 early last year. And so the question is, you know, even if that 2 million isn't going to come back, another million could possibly come back. Or then you have to start looking, well, could that production come from other sources? Will other sources be more motivated? Say the diplomacy efforts between the U.S. and Iran get moving, and suddenly Iran is able to put another 1 million or 2 million barrels per day in the market. How are the Saudis going to look at that? Are they going to see that as, this is our time, we better move on this? And I think that's something that we need to keep in mind, that it's not just the U.S. that has the capability to put more oil on the market if it wants to.
Okay. So WTI down here today, finally taking a step back, and a little bit of a heads up that maybe some of the supply promises could be arguably more fragile than we think. Ellen, thanks for the input as always.
Thank you.
Thank you. Ellen Wald's the author of Saudi Inc. and the president at Transversal Consulting. All right, definitely lots here to keep in mind. A lot of news flow for crude after this big break. Certainly some sensitivity as we learned today. Chartmaster's up next. We actually have a few earnings coming up. Two companies, at least during the quarantine, have had a great proposition as folks went outside and bought RVs from Thor. And also on the cloud side, for those businesses that were still operating remotely, they also got a big quarantine bid, but now they're going two different ways. Also in the mix is Dick's Sporting Goods, pushing up today to the high. Technicals next.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets, born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on ThinkOrSwim for the full Options for Volatility course and a whole lot more.
Evelyn Baker here with a few more post-market earnings releases. Del Taco was higher in after-hours trading after the company reported better than expected EPS and sales results for its fourth quarter. The company saw profits of 20 cents per share on $156.7 million in total sales. While profits grew by 2 cents per share year over year, the company's revenue fell slightly. However, it did see a nearly 4% increase in system-wide comparable restaurant sales during the quarter. Car Parts is also up slightly in the after hours, following the stock having lost more than 1.7% in Monday's trading session. The auto parts retailer posted a narrower than expected loss on higher revenues. It reported a 7-cent loss versus estimates calling for an 18-cent deficit, and total sales of $119.7 million, which topped consensus and is a 90% increase year over year. And shares of the clothing subscription service Stitch Fix are lower after falling an additional 6% today. Stitch Fix reported a 22-cent loss per share, which is in line with analyst estimates, but down from the 11-cent profit it saw the same time last year. The company's revenue fell short of estimates. Analysts were expecting sales as high as $512 million, and the company reported second quarter revenue of $504 million. Additionally, it said that net revenue per active client fell by 7% year over year. This has been your TD Ameritrade Network Market Update. Now back to Market on Close with Oliver Rennick.
Okay, it's time for the Chart Master. Oof, ugly Stitch Fix report. Ben Watson, get on in here since Evelyn left us on the bear note in the after market movers. Let's go with MongoDB and our analysis first, because while they couldn't be more different companies, Mongo and Stitch Fix both did great during quarantine, and it just seems like investors are throwing out everything that was reliant on the COVID trade. So this software company, Ben, just totally blowing up. We traded at 428 at the highs just a couple weeks ago, about a month ago, Ben, and now we're shaving off 32% from Mongo.
Yeah, very similar downtrend we just saw on Stitch Fix and others, breaking that diagonal trend line, and I think that's what becomes significant here. It broke it at 380. We broke the horizontal support at 331, came all the way back down and tested near this horizontal support right around the 274 mark. Now, we might get a little bit of a bounce here. It might start to move back to the upside. If it doesn't, I think what you see potentially is this back, maybe even as far down as the 224 mark before it stops this downside momentum. You see these candles, these bearish candles are really moving almost in an unabated fashion. A couple of little gaps down to the downside as it moves down. Long-term sentiment falling well out of overbought. Intermediate-term sentiment, though, maybe this is the little bright spot, starting to flatten a little bit deep down in that oversold range. So we'll see if it can find some support here, catch itself at the 274 mark.
Whew. If it doesn't, Ben, then what do we think about next?
Well, then you've got to look at that 224, which is off of those lows just before the last earnings announcement. And I think that's where, again, there's some horizontal support, but you got to think those are levels. I mean, it quickly took out 2 or 3 levels on this last little week-long some odd move to the downside. It could take these out just as quickly. That old adage that stocks climb up the stairs and they fall out the window, certainly true here with MDB.
All right. So Mongo really just giving back a lot of gains. I mean, we've now returned back to that earnings level in December. So, that last COVID wave basically pushed a lot of these stocks back out in front of the market.
Yep.
As we saw how rough that winter period got. It seems like maybe just the narrative went too far in terms of the permanence for some of these businesses as the market's now reevaluating those, at least in terms of the scale.
All right, boys and girls, we're going to wrap up today's live stream. Let's see, there's 2 people currently watching, so hi to those 2 people. Have had a total of 14 people log in at one time. Most concurrent was 3. I appreciate it. It's the first time I've done this live stream, and of course, if you haven't figured out, also working and doing my regular job at the same time. So that's why I'm not on here all day. I'm just listening to it in the background as they're talking on TV. So if something comes up, I would come over here and chime in. So I appreciate everyone that has logged in. The average watch time, just in case you guys remember, the average watch time of someone today was 34 minutes, which is super exciting. I never expected that to be that long. So if you watch this maybe later, you find it on YouTube and you watch the replay. Awesome. Thank you for that. If you have made it this far and you would like to subscribe, absolutely subscribe. I plan on doing this much more often. So definitely subscribe and share this with someone. Ideally, this is my strategy, is to have my TD Ameritrade ThinkOrSwim account up there. It's not my full account, obviously, but just with the charts, and then talk about something grabs my interest that they're talking about on the screen, and I have some time in between meetings or other things that I'm doing on my other computer, which is over here. So anyway, thanks for joining today, and I'll see you guys tomorrow morning. Have a great night.